Did you know there are over 4,000 job openings in investment banking in India? And on top of that, the average salary for an investment banker here is around 34 lakh per year. Yeah, that's right. But it's just not about the paycheck. Investment banking is much more than that. It's about shaping the financial future of companies, launching IPOs and handling mergers worth billions. So what exactly is investment banking and who is it for? It's a specialized field where businesses, government and high net worth individuals turn for financial advice and to raise capital. As an investment banker, you will be involved in billion-dollar decisions that can impact the entire industry. If you have a basic grasp of financial concept, strong analytical skill and a bachelor's degree in finance, economics or related field, then you are just a perfect fit for this. So to help you land your dream job in investment banking, Intellipaat offers a comprehensive course that covers all the essential concepts. But before we dive into today's session, make sure to hit the subscribe button and click the bell icon so that you don't miss out on any further updates. Here's the agenda for this course. We will start with introduction to financial system and how it works. Then we will study about the structure of financial system and different ways to raise capital. We will further see types of bond and collateral basis, interest rate and its impact on bond. We will deepen our understanding by looking at the features of money market. Moving ahead, we will see the difference between capital market and money market. Lastly, we will see some of the commonly asked interview questions on investment banking. So without any further ado, let's get started.
Hello everyone and welcome to this video on investment banking. Now, what is investment banking? It is a specific branch of banking that helps businesses raise funds and provides them with financial advice and support. It provides a substantial financial advising, capital raising, government and financial institution services, financial and risk management services, and help to enterprises. An investment bank is a type of financial services firm that serves as a middleman in large and sophisticated financial transactions. When a new firm is ready to launch its initial public offering, or also known as IPO, or when a company combines with a rival, an investment bank is approached. For large institutional clients like pension funds, it also serves as a broker or financial advisor. Now let us move on to what does investment banks do. Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or say middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now, the sell side shares of newly issued IPOs, provides market making services, places new bond issues, and assists customers with transactions. Coming to the buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds, and pension funds. Now let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast-paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
So before we get into descriptive details of investment banking, let's first turn the clock and understand how this banking field got incarnated. From the early 19th century, commercial banks in the US performed the functions that we now associate with investment banks. But during the period of Civil War, everything just suddenly changed. The US federal government needed more money to finance their military initiatives. However, they had no bright idea about how to raise that substantially large amount of money. That's about the time the man named J. Cook, the Philadelphian financier, stepped up. In 1861, this guy laid the foundation for the first ever American investment bank, aiming to help the federal government. That means the US government became the first ever client of investment banking. Governments wanted money to fund their multiple projects. But why would someone invest their hard-earned money without any sort of security, right? That's where the idea of releasing securities, or what we commonly call bonds, came into existence. Governments started issuing the bonds to gather investments, build infrastructure, and more importantly, to support its growing economy. Initially, what investment banks did is they bought all those bonds from the government and sold them to the private investors for profit. Today, they function in pretty much same way itself, just with different sets of parties involved. Now, this might lead towards another question: from where those billions of dollars are pouring into the business? Well, the business model is quite straightforward. Investment banks purchase the assets that hold monetary values, otherwise known as securities, and sell them to the private investors for a certain amount of fee. This whole process is termed as underwriting. Now, why would these third parties want to take the help of a middleman like investment banks and spend money doing so? Why won't they deal all by themselves? The perks of making this kind of deal is that the middleman is responsible for the risk of distributing all the securities. If they are unable to locate new investors, they'll be forced to keep those securities. To intuitively put this forward, investment bankers are the risk takers who take all the risk for secure transactions between investors and clients. But risks are not only entitled to the investment banks. Commercial banks also take risk. However, there is huge degree of difference between those risks. The commercial banks deal with the common individual and small to mid-sized companies, giving out smaller sums of money like personal loans, business loans, vehicle loans, home loans, etc. These financial firms benefit from the interest they charge on the lump sum of lent money. Whereas investment banks deal with huge companies and high-risk startups, acting as a bridge between corporations and investors. In the process, they can earn huge amounts in fees, as there is adage: higher the risk, larger the profits. I hope that you guys have a clear picture of investment banking in your head. Moving forward, we'll understand how these investment banks function. Well, by now we made it clear that investment banks act as a bridge between the investors and the project owners who require money. Well, the other way to put this around is investment banks are the bridge between demand and offer. They are bridging the people who have capital and are eager to invest and the people who need financing for their own projects. In the initial days, government entities were the main clients of these investment banks. Governments took support from these banking institutions to build highways, railroads, to improve infrastructure, to fund military operation and whatnot. Now what these governments used to do is they used to issue some bonds and approach investment bankers or middlemen to produce some sort of financial solution. The reason behind approaching these so-called middlemen was pretty simple. The government did not know how to price their bonds, how to sell them in the market. They were not at all unbiased in the negotiation of proper terms, and individual investors did not think that their investments will be protected without having the higher bargaining power. These facts tell you how important our middleman or investment banker was. Now, from this point on, the investment bankers used to take on the business. Their main task was to negotiate great deals with government to sell a fraction of their bonds to their investors. And before even doing that, they used to visit the investors and create a list of those who were ready to purchase the bonds the government had. Just to be clear, that they could resell all the bonds issued and would not be stuck with any of those. Now, all this sounds quite easy, but wait, there is more to this. Actually, there are two types of scenarios both the investors and investment bankers can face. The government can default and stop repaying its debt, or it could try to renegotiate the terms. I mean, both of these scenarios are not good for investors, hence use the middleman. Now, let me give you an example where this scenario happened for real. In 1842, 8 American states defaulted because their economies relied heavily on the production of cotton, and the price that year was too low. These states could not repay their loans and refused to pay it. Now, this puts the capital of investors at substantial risk. The middleman who arranged this sale reacted in a decisive manner. All the attempts of these states to raise a new capital were unsuccessful. James Rothschild was the name of this famous middleman. This famous investment banker was quoted saying to a federal state representative that you may tell your government that you have seen the man who is at the head of financier of Europe and that he has told you that they cannot borrow a dollar, not a single dollar. As a result of these Rothschild's actions, the defaulted states agreed to a restructuring plan, which satisfied the investors and repaid them their capital. This scenario proves how important it is to have a reputed investment banker in deals like this. Now, this is a scenario of past. What about now? Well, the thing is, investment banks still do work the same. It's just they offer a variety of services now. They definitely still do raise capital, but besides that, they have specialized in areas like mergers and acquisitions, underwriting, private equity, and venture capital. These banks hire quite a number of employees every year in roles such as banking analyst, investment banking associates, portfolio managers, private wealth managers, market research analysts, investment strategists, investment consultants, and many more. And using these sets of people, they run the empire of money. Different teams work on different sets of deals in the particular demographic areas. And the presence of these top investment banks is of global level. They have rooting in almost every industry and every country possible. Also, these financial institutions have been around for centuries now. Hence, people do put immense amount of trust in their names. Now, just to give you an idea, here is the list of notorious investment banks across the globe. We have Barclays, JP Morgan, Citi, Credit Suisse, Goldman Sachs, Deutsche Bank, Merrill Lynch, and Morgan Stanley. Now, the youngest of these banks is 88 years old. And if we talk about their average age, it is significantly higher, that is 187 years. I hope these statistics help you contemplate the huge market experience these financial institutions bring to the table and how big of a deal they are. Now, moving forward, let's look into the career prospects that you can look out for in the field of investment banking. It is crucial that you understand the world will always need companies that could drive innovation. Those innovative companies will always require huge investments, and also the people with money will always look out for opportunities to invest and savor their future. which clearly depicts the need for our middleman, that is, investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of 113,000 US dollars in the United States of America, whereas in India, you can expect the average salary of 12 lakh rupees, which could also go up to 70 lakh Indian rupees. And the best way to climb the ladder of success and gather lucrative offers is to learn the intricacies of investment banking operations.
So, what are corporate actions? Any event that brings material change to company and affects its stakeholders. And corporate action is an event initiated by a public company that affects the securities, equity, or debt issued by the company. So, material change to company and affects its shareholders or stakeholders. Tell me one thing. The moment you got hired in one of the company, don't take it personally, it's a more practical example. The moment you get hired for another company, will there be an impact as a part of the corporate action as per this definition or anything, or as per understanding of this definition on company's financial statements? Anyone? Because it's a part and parcel, it's part of operations. These things happens on day-to-day basis, but corporate actions does not take place on daily basis. They take place as per the management decisions. Could be announcement of the dividends, could be stock splits, buybacks, issue of shares, as well as debt repayments, early repayment of the debts, and so on. Many more things, even issue of debt. So we will be seeing. So examples of corporate actions are split, dividends, bonuses, mergers, acquisitions, spin-offs are all examples of corporate actions, and bondholders are also subject to the effect of the corporate actions, which might include calls or issuance of the new debt. Right. So these are the few examples of corporate actions, friends. Corporate actions, split, dividend, bonuses, M&As, and we'll also come to know the difference between these two. So impact of corporate actions. So a call, early redemption of a debt security is another company action that could have direct financial impact on the shareholders or the bondholders. So if I'll just say in this way, call or early redemption of a debt. When I say early redemption of a debt, it means simply that company is planning to redeem the debt immediately. It will have an impact where, of course, the cash flows will come down, the current cash will definitely come down, and also the debt burden will also come down. There could be some reasons that why company would be doing it. There could be one of the reasons that company has sufficient cash they want to repay. Like we have sufficient cash, we repay our debt. There could be another reason that another debt they want to raise, and that another debt is available at a comparatively lower cost than the existing one. So if the current is issued at say 8 to 9%, the other is available as 6 to 7%, then it will be a cheaper debt for you. So these activities includes dividend payments for equity securities and coupon payments of the debt securities. So one more effect would be, friends, not only the debt will be repaid, but also in near future, your fixed cost of paying an interest will also come down. Right? Okay. So some corporate activities such as stock split could indirectly affect the prices of the stocks, and because of the increased shares, liquidity, and so on. And certain companies act such as name change and have no direct financial impact on the shareholders. So if there is a name change, or like from one name to another name, has a direct impact on the financial statements, answer is no. Recently, I'm sure we all are the part of the same company, one or the other way. Recently, a US listed company also, not recently, I would say that previous year, the company also changed its name, and that's one of the famous company across, and it starts, it's a social media thing, or I would say, to connect people socially. It is nothing, it is just a Facebook. What's the new name of a Facebook?
Let's have a quick quiz question, guys. What is a stock split? Your options are: a method used to increase the overall value of a company's stock, a process of dividing a single share into multiple shares, a financial maneuver to reduce the number of outstanding shares, or a way to eliminate the need for stock trading. Please mention your answers in the comment section.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Today, the company changed its name or updated its name from Facebook to Meta. Have an impact immediately, and is it a part of the corporate action? Answer is no. It's not a part of corporate action. It's more of a behavioral thing, how people are going to perceive. But a company would be working the same way. Even Mark Zuckerberg is still there. There are many more people who are. So we need to understand what is a corporate action and what not. Corporate actions processing, life cycle, announcement collection. I'll just read the broader headlines. Announcement collection, announcement validation, identification and notification, election processing, elections settlement, and reconciliations. All things put together, it says that yes, at what level it gets announced, means what is the corporate action, when it got announced, what is the validity of that particular announcement. So please don't get carried away with the fake news. And there are many more which people get carried away. But yes, basis the technology, people must double check that whether the news is correct news or not. And also see the identification of the notifications, whether that's the same thing is available on the website. The website is, of course, the best source ever. Trust the website of the company, because if the news is there, also it must have been there on the website and then it must have come here, rather than the vice versa. Because anywhere, wherever the news is, it's a secondary source. It's not a primary source. And accordingly, whether you are particularly eligible as per the part of the corporate action or so, and do the reconciliations. We are not supposed to do reconciliations, but yet we are supposed to match that how much we are supposed to receive as part of the outcome of the corporate action. I'll come to those particular parts. What is corporate action? I mean, what is a corporate action which is being announced by the company and so. But before that why corporate actions are so important, because of this thing, which is enterprise value. Returns profits to the shareholders. Cash dividends are classic examples where a public company declares a dividend to be paid on each outstanding shares and so on. And again, the cash dividends are also friends. Influence the share price. So this is theoretical, but anytime, whenever you get the time, please read it through. But influence the share price, that are corporate actions such as stock price and reverse stock price increase or decrease the number of outstanding shares as the case. I'll come back to the buyback also. So there is a corporate restructuring also in order to increase their profitability. What is corporate restructuring, friends? Restructuring means that is, I am going to restructure my existing, existing capital structure. Generally, it is known as debt and an equity combination. So it is known as what? The debt and the equity combination. So when I say the debt combination, when I say debt means how much we have raised funds through debt and how much we have raised funds through equity. Is there any convertible debt also, which will definitely get converted to equity, and so on. So this is known as restructuring. Could be. Mergers are examples of the corporate actions where two companies that are competitive or complementary comes together to increase the profitability. Okay, now what do you understand by the word mergers and acquisitions? It is more than 50. Let's just say this way. So for example, I have say 100 million shares, and suppose Dharni acquires 60 million shares, 60 out of 100 million shares. So she holds 60%. My company will become the subsidiary company of her company. And if she acquires the whole company, it means if she acquires all shares, then my company will become what? The wholly owned subsidiary company. First is known as the subsidiary company, company in which parent company has more than 50% stake. So the company will become a parent company provided they have a subsidiary company. And if the company has a subsidiary company, it could be a normal subsidiary company, or it could be a wholly owned subsidiary company. Wholly owned means in which you have a 100% stake. The third important information is if the company has more than 20% but up to 50% stake. Suppose instead of she being acquiring 60 60 million shares. Suppose she has acquired say 40 million shares. Now in that case, what I'll be known as, instead of 60% stake, now it is 40% stake. It is lesser than 50. I'm sure you must have heard about that word, and that word is none other than an associate company. So parent company, subsidiary company, wholly owned subsidiary company, and an associate company. Perfect. So mergers and acquisitions takes place basis to make the company a subsidiary company or a wholly owned subsidiary company. So friends, the purpose of whole exercise, whether a merger or an acquisition, is to talk about a statement or the financial statements which are not the standalone financial statement, but which are consolidated financial statement, means statement which are in totality, right? For example, so like I take my same example in which Dharni has invested. Suppose she has invested 100% and she has taken 100% stake in my company. Now, these things, like for example, it is 100 million shares she has already taken. In this case, if she has taken 100 million shares, my company has become wholly owned subsidiary company. At the time of preparing the financial statement, she will be showing what? Not the balance sheet, but she will be putting at the top of it consolidated balance sheet. Perfect. So the word consolidation comes the moment there is one or more subsidiary company. Otherwise, there is no word, namely consolidation. So the restructuring could also take place, could be using mergers or acquisitions as the case may be. So greater than 20%, but up to 50%. That is an associate company. So types of corporate actions, there are three types. One is mandatory, another is voluntary, and the other is mandatory by choice. So if the company wants to make a choice, and then it becomes mandatory corporate action. So one is known as the cash dividend. What is the cash dividend, friends? Cash dividend means dividend to be paid in cash to the existing shareholders. And this doesn't get paid immediately, right? So there are parameters, there are things which takes place at the time of making a payment. So as we know that the corporate, I would say, the companies would be announcing a dividend. It is not mandatory. Dividend is something which is a part of the profits. If the company has earned profits, company may choose to distribute dividends among all the shareholders, and it is a choice. It is not a mandate. But the moment if it is declared, company has to make the payment of that particular dividend. So this gets paid from the existing profits which the company has generated. Now I'm writing one example. Suppose the share price is rupee 120, face value rupee 10, and dividend is equal to 20%. Number of shares is equal to 1 CR. Calculate amount of dividend. Okay, the value of the dividend would be 2 CR here. What would be the value of each share when they will get issued? The original value of each share would be the 10 rupees. So total dividend would be what? Which is 2 CR. And face value is equal to what? Which is 10. Can you now calculate number of shares which will get converted to dividends? So friends, first of all, though we have calculated it rightly, but yes, it's okay. Face value is 10, dividend payment is 20%, and the number of shares are 1 CR. If you want to calculate the dividend, you would be able to calculate the dividend basis the face value, not basis the current market price. Okay. So what is the dividend in this case? The dividend is coming out to be 2 crore, which is 2 rupee, which is 20% of 10, 2 rupee into number of shares, which is 1 CR. Hence the total dividend is coming out to be 2 crore. And now this dividend will get converted to number of shares with a face value of 10. Are you all with me? You divided it by 120, assuming that every share would have a face value of 120. Is it possible? Then why didn't we use 120 at the time of paying the dividend? At the time of declaring the dividend, the current market price was there. Why did we not multiply it 120 into 20%, which is 24? Why we calculated 2 crore? The reason is because the dividend is paid on the face value. Same goes, that same dividend which you have calculated would get converted into the number of shares with a value which is equivalent to 10. 2 crore is the dividend, Kumar. Everyone, please understand this. 2 crore is the dividend. Now, how many equivalent number of shares will be there which has a value of per share 10 rupee, which is 2 crore total in value. So total value of the shares, total value of all the shares is coming out to be 2 crores. Every share has a face value which is 10. So 2 crore by 10 coming out to be how much? 0.2 crore. Number of shares, number of stock dividends we call it. Dividends which are converted to stock at a price which is the face value. Confused basis this stock dividend. So stock dividend means that how many number of shares would be equivalent to the existing dividend. So these things I have already explained all of you, and hence I am going ahead. So stock dividend will increase the number of shares, but a dividend does not increase the number of shares. We have already talked about stock split. I'm just moving ahead with the slide because this is all theoretical. We have already talked about that something which is known as stock split and why it is being used, so on. So there's a small example which is 100 shares of stock trading at 50. It will be 5,000 market capitalization or 100 times of this. And a corporation divides its equity 2 for 1, which is 2:1. Now there will be more number of shares, which is 200 times. 200 shares, sorry. Of what? 25 each. And then we have the most frequent stock splits are 2 for 1, 3 for 1, 3 for 2. But any ratio is feasible, and hence some are less frequently used, some are more frequently used. Would like to give you one more information basis this at where we can find out the more detailed information of the corporate actions. So if we'll go to the website, which is nsenia.com, or maybe you can do a search which is here. So friends, you may do one thing. If you want to see the recent corporate actions of stock split in India, you may type it with Google. You can type it once. I'm already through it, and it will give you some results. Say you go to the website, which is the stock exchange website, and once you click on this page will open. I'll repeat. I'm just opening it on another page. I just clicked it. Okay. So this page will open, and this page says equity, debt, SME, and mutual funds, which is small and medium enterprises and mutual funds. So you will be directly routed to this particular website. You may click on download the CSV file, and CSV stands for comma separated value file, and you will be able to see that which companies have already done any sort of corporate actions. Corporate actions could be related to dividend, interest payments, and all. So for government securities, GSEC for government security, EQ for equity. And we have an annual meeting, we have an interim dividend, could be like that, to make it look attractive. And you will see that this file is here. Just closing it, and here you go. So SSWL, which is Steel Strips Wheel Limited. Is this Excel visible to all of you? Which has a face value of 1, and there's an X date, there's a record date, there's a book closure date, and book closure start date, and book closure end date also. What are these dates? Now just have a look at it, please. Thank you. Under the understanding of the life cycle of the corporate action, we could see that the corporate action has important dates. So declaration date. The declaration date is a date that the board of director announces and approves the payment of dividend and is known as the declaration. So a declaration date specifies the record date and the payment date, as well as the amount of the dividend being issued. So for instance, Coca-Cola declared a dividend on 18th October, which is declaration date, of $0.39 per share as the size of the dividend, payable on 14th December, which is the payment date, to shareholders of record as of 30th November 2020. So it will be paid, the dividend will be paid on 14th of December, basis people who holds even a single share on 30th of November. How much amount of the dividend? 0.390 per share. And when did they do that? They declared it today. So today's is the declaration date. It means in this case, 18th October is the declaration date. The payment date would be 14th November, and the payment would be done to whom? To people who would hold the share, which is as per the record date, which is the 30th November. So one is the record date, one is the payment date, and one is the declaration date. So X dividend and simply X date. What is the meaning of X dividend or X date? X date is the first day that a stock trades without a dividend. So the company does not set the X dividend date. The X dividend date is set by the stock exchange where the company's stock is traded. Okay, so keep the same thing in mind with X dividend or simply X dividend. So the X dividend date typically occurs up to 3 days before the record date. Purchasers of the share on or after the X dividend date are not entitled to a dividend. So on or after the X dividend date are not entitled for dividend. So who announced this X dividend date? Stock exchanges announces this X dividend date. Doesn't say this, and the X dividend date typically occurs up to 3 days before the record date. So for example, in this case, the record date is coming out to be 30th November. It will be 3 to 4 days prior to the record date. So for example, if an X dividend date of Coca-Cola is coming out to be 20, the X dividend date is 29th of November, which is 1 day before the record date. So it is saying what, friends? If it is up to 3 days before the record date. And this will make the particular stock or who decides this particular stock, that is a stock exchange. And a record date also known as the date of the record, that is on which day the investor must be on the company's book in order to receive a dividend. So a record date is commonly confused with the ex dividend date, but it should not be. I recall that record date is a set of the company and the ex dividend date is set by the stock exchange. And ex dividend date is earlier than the record date due to the fact that there is a settlement period for stocks trades on exchange. And there's a pay date. So payment date is the date that is made to shareholders, and payment account may receive, or shareholders account may receive a dividend payment via electronic transfer. For instance, Apple dividend is due on 14th. Before the ex dividend date on 14th April, the shareholder would get a dividend of this particular amount. So please have a look at it, friends. What does this saying to all of us? The symbol is there, maybe basis which just the particular stock will be known for. We have company name, series, purpose, face value, X date, record date, and we have book closure start date and book closure end date. Now, can you understand the differences in these? Since this is just recently downloaded, as we all know, now the X date for all these companies are same. And if I'll just filter it, basis equity, so there are how many? There are 18 in count. You could see 18 in count, and we have the ex dividend dates and a couple of more things for all the shares. So it is one is known as a buyback. So what is buyback, friends? For example, the company says that yes, 10% would remain with the public and 90% would remain with us. If it is increasing to 11%, 12%, or 13%, it would simply mean that yes, it is something which the company wants to control, and company wants to control in such a fashion that yes, they will start buying back those particular shares. If we all are the holders of the share, and suppose we all hold one share each, and there are 20 in total, so and company wants to buy 5, so company do a lottery system so that everyone will not get affected, and it will not be asked by you or me. Basis some random lottery system, those particular things gets calculated as a system generated things, that from whom those particular shares will be bought back. It could be in proportion, not every time in total. Suppose we all hold 100 shares, 100 share each, and company is buying say 50 in total. So 100 share each in multiply by 20 comes out to 2000. Company is going to buy back 50. Each one of us is eligible to give them another 50 shares, but company would randomly select it and could be proportionally driven. So in this case, friends, it will be something which will reduce the number of shares which the company holds, and hence it is known as buying back from the company point of view. And we have another things here, which is dividends annual dividends, interim dividends, annual general meeting dividend declared on that, extraordinary general meeting, and so on. Most probably, and majority of the time, it is known as the dividend particularly. And hence the things are here. So we have the X date, we have record date, the book closure start date, and end date. So this way, I'm sure you would be able to see that yes, the stock split has taken place, and basis that Netflix is one of the company which has actually announced the same. And I'm going to share one more example which is there in the PPT as part of the reverse stock split. So just have a look at it, which is what it says. So reverse stock split says reverse stock split with a ratio of 1:10. So share was initiated by ABC Limited in 2011. In April 2011, the stock price of ABC Limited has dropped to 4.5. Large investors frequently avoid equity trading below 4. The decision reverse separation had been made by ABC Limited in order to avert such feelings. There are now roughly 2.9 billion fewer shares outstanding than there were previously 29 million shares. So the number of shares comes down, the share price increases. We have also talked about something which is related to buyback. With a buyback, the issuing business buys back the outstanding shares on the open market and decreasing the stock's liquidity. And it is a management tactic intended either to boost shares value or dissuades any potential threats from the shareholder seeking a controlling interest. Yes. So companies, as I shared with you, if the number of shareholding is increasing with the public, companies buy back. Let's buy back shares. Okay. So it means those number of shares are removed from the market and there won't be any stock price, there won't be any market capitalization. So market capitalization comes down by that. Are you all with me? So basis issue, number of shares, market cap increases, basis buyback, the market cap falls. Are we good? So always keep the same thing in mind. If buyback is there, what impact you could expect on EV? Will the EV rise or EV fall? And we have some examples of the buyback. Here, the business may repurchase the shares up to 10% of the paid up capital and reverse at any point of time without shareholders' resolution. So for this, shareholder resolution is not required. So if, for example, of buyback, it was noted that the Sony stock had fallen below the market emotions in the final quarter of 2013. Buyback was initiated after the CEO Mark Ellison saw the decline, and corporation made a brave move by moving forward by the buyback. With the buyback in Jan 14, Sony bought shares of $14 billion over the course of 2 years. It's a huge amount, $14 billion. So it is not something which is very tiny in nature. It could be very huge, but means the value could be very huge. But yes, now the controlling is coming back to them. Are you with me? This way they can find out. This way they can see. So friends, this is consolidated balance sheet of a company, and it includes, of course, the data and all many other things. But yes, let's have a look at it. What it says. So first of all, that the consolidated financial statements gets prepared if the company has one or more subsidiary company. Okay, so this company has one or more subsidiary company, hence we have the consolidated balance sheet. Now you have the formula with you: market cap plus short-term debt, long-term debt, plus preferred stock, plus minority, plus leases, minus cash and cash equivalent. From where you will get, so first of all, the first column is the current year column, as you could see. So Kumar, you can take your cursor to the 31st March 2023. At the extreme bottom, friends, you could see, not extreme bottom, in the current assets, you could find, which is under the financial assets, the third point, which is cash and cash equivalent. So friends, you could see the first thing is equity, followed by equity attributable to owners of the company. Then we have a total equity. Then we have what? Do we have minority interest or non-controlling interest or preferred stock? There is nothing like that. We have non-controlling interest here, just below the equity attributable to owners, which is point A, B. After that, there is a non-controlling interest. Correct, friends? And we should also know that how many number of shares are there of the company. So till this part, the things are okay, right? From where you can extract the information. Now you could see that 31st, these are 31st March 2022 shares. Yes, on the right hand side, you could see balance as at 31st March 2023, which is 12240. We need to find, this is value or this is shares? This is value of the shares. This is not shares. From where we can get the shares, outstanding shares total. So now you could see there are issued capital. 1, 2, 2, 3, 4, 4, 1, 6, 5, 0 on the left hand side. Issued capital. You could see authorized, you could see issued capital. These are number of shares of a company which are issued till date. 31st March 2023, 31st March 2020. And we have these much of issued share capitals. Okay. And these are not in crores. We need to convert them. Okay. And let's take it forward. Now, what would be the share price of the same? And so what is the formula for market capitalization, friends? And we will be helping ourselves to calculate the market capitalization. This is the number which we have also got. And let's just help ourselves from this page to calculate the enterprise value of the company. This is the information which is given here. Market price, you may do a Google, find out multiplying these two, the market capitalization in crores. Okay. And because all the other numbers are in crores in the balance sheet. And after that, basis the formula of an enterprise value, which we discussed yesterday, help yourself calculate the enterprise value of the company today. 147485.89. Are we all getting the same? I'm sure everyone must have calculated it. Short-term and long-term debt. In this case, what is the short-term debt, friends? You will not get a word, namely short-term debt. But the thing is that here in the current, under the current liabilities, it is borrowing. Under current liability, Kumar, the second total, this is non-current. Under current liability, yes, borrowings. These are what? Current liabilities. Current liabilities means short-term liability. Short-term means to be paid in up to 1 year. So this is 2657.37. Are we good? So this is short-term debt. Long-term debt is the borrowing which is the above borrowing, which is non-current liability. The one which is at the top. Correct. This is long-term borrowing. So just sum up these two numbers, which is 26571 followed by 51446.33. Next is the leases. Guys, just have a look at it. You may add the numbers. I'm not checking the mathematics. I just wanted you to make sure that your concepts are clear. Then the lease liabilities, Kumar. So you may also select the lease liability, which is long-term, short-term, both, just immediately below the debt. So we will be adding it, which is long-term, which is 5811, and the short-term, which is coming out to be 1064. You may also select the same thing, Kumar, in the current liability. 2000. Okay. Then EV by sales would be what? The EV by sales would be 5x. We popularly call it 5x. Okay. 10,000 by 2000, it is known as a 5x. What does this mean? So we do not call it 5 times. We generally call it 5x, which means 5 times. So when I say 5 times is my sales, not sales, 5 times is my EV with respect to 1 rupee of the sale. It means the enterprise value is higher than the numbers which I'm generating from the revenue from operations, and it must be higher. It means how much sale has contributed to this. Now, this number doesn't talk anything. Doesn't say anything whether it is good or bad. For example, friends, when I say, excuse me. So for example, when I say I have scored 80% marks, is it good or bad? The answer is that it cannot be defined. The reason why it cannot be defined, because 80% marks doesn't say that whether I have, beaten the whole class or in totality basis, I have become a topper, or I have beaten the class on an average, or I am below average also. Even the class average is 90% and I have scored 8. So there are different possibilities also. So if I'll give you EV by sales of industry, which is 4x. When I say industry or a sector, it simply means that though there are 26 sectors which are available, but EV by sales or sector means that yes, as per on an average the sector numbers, this is coming out to be 4 times. On an average, everyone in an industry is generating an 4x as a multiple. What I am generating is 5x. Am I good or bad? I am better off. Are we clear, friends?
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
There's one more example related to bonus issue, and these examples are already being explained with the help of the example which we also took. And the bonus issue that is existing shareholders is the bonus shares and so on. So these are already being discussed in yesterday's session. So I'm not investing more time on these slides or so. Let's talk about something which is spin-off. An existing publicly traded firm spins off when it sells a portion of its assets or issues new shares to establish a brand new independent company. Before being issued to the new investors, the new shares are frequently first offered through a right issue to confirm to the current owners. And spin-off may a single or a corporation may signal a corporation that it is reorganizing or refocusing its primary business, or it may signal one that it is ready to take a new challenge depending on the circumstances as the case may be. So what is spin-off? For instance, when an equipment division of Hewlett Test and Measurement Packard was spun off, Alignment Technologies was born. So the shares of Alignment Technology were initially made accessible to HP's existing shareholders before being made available to the new investors. So when they spun off, they created one more company, namely Agilent Technologies. And Agilent Technologies were initially made, the shares of Agilent Technology was initially made available to the existing shareholders. So for example, if it is HP's shares, so first importance would be given to the existing one, and so on. Then comes one of the other thing that is known as the bankruptcy. So when a person or an organization cannot afford to pay its debt when they are due, it is said to be an insolvent or in default, and liquidation is not usually the outcome. So bankruptcy means the person is not able to pay its debts. So even if the assets will be sold out, even the person would not be able to. That's the thing that it's not usually the outcome. Reorganizing is an alternative where the company's responsibilities may be renegotiated, and reorganization attempts fails, the business files for liquidation. If the reorganization of the equity and the debt structure could be, or anything else, so that the trust of the people who have invested in the company for so long, and many more things, doesn't get impacted. Generally, it gets impacted as a part of the behavior thing. But to save what the company has also contributed, as well as people have also contributed in the company, both the sides, it works like. And the trained and specialized attorney is typically chosen to conduct the process, and then in terms insolvency practitioner refers to this attorney. So under the bankruptcy, any party that has unresolved claims may submit the insolvency practitioner will sell all the assets in the event of liquidation, and if anything remains after all the debts has been repaid, it will be distributed to whom? That is to the stockholders as proceeds. So suppose once the company goes ahead with the bankruptcy, so it's a dissolution part and so on. So when I say it's a part of the dissolution, it means every of the assets will be dissolved. But before dissolving it, what company try to do? Try to save it. Could be, but just by restructuring its debt and an equity combination also. Bankruptcy, they also give a chance to restructure it, but if it is not working out, or if it doesn't get works out, every asset to be sold out, and the hierarchy of making the payments is, of course, first are the taxes. That means the liability towards the government, taxes, salaries to the employees, and the debt repayment, and then the preferred stocks, and then the equity stocks. equity shareholders, if something remains for them. So this is something, and the guidelines are already there as per the Companies Act. Then comes the delisting. What is the meaning of delisting, friends? Delisting means that the stock will be delisted from the stock exchange itself. There are multiple factors of getting the stock delisted. It's also a corporate action from the company point of view. So, by what time the companies should announce their financial results? For example, today is the 31st March, which is an year end. So, by what time companies are mandatorily supposed to announce the financial results and should be there on the stock exchange, their website also, both the places. Is it something on 1st April, 2nd April, or is it something 5 days, 10 days after 31st March or so? So friends, it is mandatory for every company, every listed company to declare its financial statements up to 60 days from the close of the financial statement if it is an annual report or annual result, not annual report, annual result. So suppose from the 31st of the March, calculate next 65 days, not 65 days, 60 days. And those are not working days, 60 days straight. And if it is a quarterly reporting or semi-annual reporting, it is up to 45 days and must be audited financial statement rather than unaudited financial statement, which Richa mentioned. So if the company is not been able to, announce the financial results within 45 days or 60 days, as the case may be, stock exchange has a right to delist it. But first, stock exchange gives the company a warning and to submit the results, ask for a valid reason and to submit the results in next 9 working days. And if not submitted again in next 9 working days, then stock exchange has complete right to delist the companies, no questions asked, no political pressure. It's a choice of the stock exchange to delist it. Of course, it will have an impact on the the shareholders who have already invested in the company. If the stock is not there, how would they get a benefit, to exit from the market? But these things get declared, and yes, the warnings and many more things comes up. Even the company also loses its brand value and many more things which takes place. So delisting, the criteria of the delisting are there on the stock exchange, and it varies from stock exchange to stock exchange. There is no thumb rule, there is no hard and fast to that. Exchange may make this necessary, or the corporation may choose to do it voluntarily. So even a company can also do it. Like we have that we are buying back all the shares, and no share will be there with the public. Then why the thing is listed on the stock exchange? So they announced it that yes, now we are going to get delisted. So the company is completely removed or delisted from the stock exchange. There could be a possibility that there is a merger and acquisition. For example, my company is there, which is company A, and your company is there, which is company B. You have completely acquired my company, and now you have merged it with your company. Now my stakes are your stakes. My stocks are your stocks, right? In that case, you have formed another company named ABC, and now you have closed down this company name. So it means again this is delisted. So there are multiple reasons, friends, which delists the company. A stock exchange can no longer be trading on the exchange after it has been delisted, and no official exchange price building is being monitored. And delisting may occur for a number of reasons. Could be business no longer complies with the stock exchange listing requirements, business transform into private entity, exchange, the exchange it wants to delist has insufficient trading volumes to make the listing fee worthwhile. So we pay a fee, which is say 5 lakh, 10 lakh, 15 lakh rupee per year. So it's an yearly fee. So they say that yes, even you are not able to take a benefit of this particular exchange or anything, then why you are actually carrying it forward? So under the mandatory delisting, business, which is typically the legal entity, is being liquidated. For example, the owners of the subsidiary company that is listed independently on an exchange might choose to liquidate a subsidiary and bring all the assets into the parent company and have only parent company listed on the stock exchange. That's what an example which I just shared. and the business files for bankruptcy. That's another very important point, which we just discussed a few moments back. Entry parts, that is tender offer. So tender offer means an acquirer makes an open public offer to all the shareholders of publicly traded company to their shares for sale at a certain price within a predetermined window of time. So acquirer makes an open public offer to all, and a tender offer that the bidder gets in touch with the shareholders directly and asks them to sell shares for the predetermined amount. Like for example, I'm the owner and a bidder, so I can ask people to directly reach out to me and through a stock exchange, and hence it is coming up. So a sort of a takeover offer is referred to as a tender offer in corporate finance. So generally, takeover, it could be a hostile takeover, it could be a friendly takeover. Hostile means a forced takeover. So it means a company would have taken some debt from another company, and the other company has now offered them that yes, we are offering you shares against it. Your debt is now converted to share, and those shares are owned by us. So this is how we can exchange those particular things, but your company is now my company. And tender offer means acquirers offer price typically includes a premium over the current market price of the target business shares in order to persuade the shareholders of the target firm to sell. So generally, acquirer's price is typically higher than the current market price. So if I want to make it a tender means that I want to sell everything. I want to tender my trade. So it simply means that I am offering my shares at comparatively higher price in comparison to this particular part. Hence, it is known as a premium. And consideration for a tender offer in which securities are provided as consideration is typically refers to as exchange offer. But cash or otherwise securities may be offered to the shareholders of the target company. So either cash, securities, or a combination of these two would be offered to the target company. So that was related to the tender offer. So it may be an open offer. It may be basis some references. It may be basis to a specific people or specific institutes with whom you want to get it done. Now let's go to the right issue. I'm sure a couple of you must have heard about this word, which is known as the right issue. Suppose you are the existing holder of shares in one company, ABC company, and which is owned by me. You are already a stakeholder, a shareholder in that. Say everyone has some, say 1,000 shares each. Okay. The company is into existence since 10 years. Now, company wants to expand. Company wants to expand, and they are saying that yes, how we can expand? We can expand just by what? We can expand just by raising funds, and raising those particular funds would be like, for example, through equity, through debt or something. And when I say through equity, the first time offer is known as what? IPO, as we all know. But the second time offering the shares to the public, or post the first time offering the shares to the public, it is known as an FPO. FPO stands for follow-on public offer. Correct. So when I say follow-on public offer, the follow-on public offer is in the form of shares again, and it could be in the form of what? Right shares. Suppose the current market price at which I'm offering a share, it means at which I'm raising the funds from the public, is say 50 rupees. 50 rupees and number of shares. You all are existing shareholders in a company. I think so. You all should be given first right to invest more in the existing company. And when I say you all should be given first right to invest, which simply means that it will not be offered to all of you at a market price, rather it will be offered to you at a lower price in comparison to the market price. And it's your right rather than an obligation. For example, you will say, okay, Gaurav, we are also interested in buying more share of the company. How we would be eligible? When the moment we become the shareholder in a company, we are automatically eligible. It means it's our right, existing holders' right, rather than the new people who will get this particular thing. So if the requirement of raising the fund gets fulfilled among the existing shareholders, big deal in that? It is available at 50 in the market. I am offering to all of you, say at 45, 46 as the case may be, say 45 rupees. 5 rupee per share discount for you. Two benefits. First benefit is that the number of shares with you will definitely increase at a price which is lower than that. I would also see that yes, the number of shares which I wanted to share, now they are already rightly sold. Rightly sold means to the existing holders who are the investors in the company. The second advantage which you would get, in market it is available at 50, you are getting at 45. One more advantage you will get is that you can purchase those shares from me at 45, and you will get an opportunity to sell the same shares in the market at 50. But people will say, why we would buy it from you at 50 since it is available in the market at 50? Suppose you buy it from me at 45 and you will sell to another person at 50. The person will say, why should I be buying from you? I'll be buying from the market itself. Why you? But maybe you could be able to say that, yes, I have bought it at 45, which is your price itself, but you are ready to sell it comparatively lower price in the market, say at 49 or at 48.5 or 49.5, could be showing 1 rupee or 50 paisa or 1.5 rupee difference with the profit which you want to just earn from that particular deal. So even if you are not interested in keeping the shares, you could also buy it from the company and sell it in the market at a certain price. So that's why it is known as a right issue, issued to the existing shareholders as per their own rights. So an instrument that entitles the investors to purchase newly shares, and entitlement is based on the quantity of the shares already held. So if one person, so basis the right issue could be, there are a couple of things. It could be 2:10 is also, like everyone will get 2 extra right shares basis if they hold 10 shares, something like that. So it is referred to as share purchase rights or subscription rights. So investor holds 100 shares in a company which he has purchased from the secondary market. Company X offers him a right issue in the ratio of 3:5 at 90, which is at 25% discount compared to the market price of 100. Great. So if you hold 5 shares, you will be further eligible for 3 more shares. At what price? 90. Market price of the same is how much? 120. Find out the discount percentage. How can we calculate discount percentage? It means company is offering almost 60% shares. Not almost, actually 60% if you holds. So A will get what? 60 shares. Understand this calculation. A will get 60 at what price? 90. But if the A is an first holder of the shares, it means he will be buying the shares first time ever. It will be available at what? 120. Hence, 60 into 120 would be 70 to 100. The difference between these two is something which the person would be able to earn and see from the day one itself. So investor can choose to reject the right issues if he chooses to, and exchange takes place between the investor and the issuing company. Cash stock options means shareholders are offered the choice to receive the dividends in cash or in additional new shares of the company at discount to market. Reinvesting often carries a tax shield. So shareholders are offered the choice to receive the dividends either in cash or in additional shares. So and these are of course offered at a price which is comparatively a discounted one. So it is a choice. It will be mandatorily converted, but it will be converted either in cash or in stock. Another thing, merger with elections. Merger of 2 or more companies into one new company. So the shares of old companies are consequently exchanged into shares in the new company according to set ratio. So there is a possibility that I am offering an exchange ratio which is 0.5:1. So against my 1 share, you will get 0.5 shares. Simple. So basis that, the number of shares will be definitely being offered. Shareholders of both the companies are offered choices regarding the securities they receive. So shareholders definitely get what? And merger with elections. Perfect. So in this case, the moment the merger is taking place, people will get elected for what thing? They will be given number of shares, but according to what? Exchange ratio. It is as simple as that. Spin-off with elections. A distribution of subsidiary stocks to shareholders of the parent corporation without having cost to the shareholders of the parent issue, whereby the shareholders are offered choices regarding the resultant stock. So they will be offered. So spin-off, like we understood what is spin-off or spun-off. It means it will be another vertical which will get created, and people will be given a choice, to become a shareholder in that, and they are also the part of the parent company. So here, a distribution of a subsidiary company stock to the shareholders of the parent company without having cost to the shareholders of the parent issues, whereby the shareholders are offered a choice regarding the resultant stocks. So what are the number of shares which will be offered the moment that the company will become the subsidiary company? It will be something which will be offered. It's a choice of the investor whether they want to take those number of shares or not. That's a choice.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
It's the professional management of various securities and assets in order to meet specified investment goals for the benefit of investors. Specified investment goals, specified, which are specific to that, and involves securities like shares, bonds, other securities, and assets like real estates also. And asset management companies provides a range of traditional and alternative strategies. I want to be more financially free and more, investing in such a way which looks like a better and a controlled portfolio of my overall assets. I don't want to invest in those assets which are directly or which depreciates faster, could be vehicle or anything else. And I don't want to invest in those particular assets which investing in those something which is, the value rises, but liquidating them, encashing them, something which is comparatively not so easy. But yes, my investment should talk. So I want to make a portfolio which is, of course, with comparatively less riskier. This is my risk appetite, and I want to, take more risk. But yes, in next 5 years, I want to invest good, so that after 5 years, I will be able to do my own business. And I want to be financially free. Financially free means it's not that I should have, the n number of money to enjoy my life or so. No. I want to contribute to the society by keeping myself free, so that I start something and invest in that, so that I would be able to contribute to the best possible I can after 5 years, till the time which I would be able to contribute to the best possible way I can. I don't want to retire. So just for bread and butter, and then contribute to the society. That's the whole thing. The financial freedom is to start something. Sorry, I cannot disclose the business plan, but yes, to start something which will help contribute in the society to the best possible it could be. And what are institutional investors? Okay, so first let's talk about institutional investors. These customers represents sizable assets in the pool of the endowment, foundation, business, or pensions. Could be endowments, foundations, business pension funds, government pension funds. And sophisticated investors is also used in industry And according to the estimate, they accounts for around 75% of the AUM. Yes. So these are 75% of the asset management companies across Europe and US and so on. Retail, just like us, typically trades in what? Smaller amounts than the institutional investors. And we trade in such mutual funds, pensions, university endowments or so. Universities endowments are in US, that's it. And HNIs are classification used by financial service industry to denote an individual or a family with HNI. Most commonly quoted figure for an HNI club, which is nothing, which is the net worth, which is club of $1 million in liquid financial assets. Liquid financial assets means something which can get converted into cash immediately or within a certain period of time, which is say up to 30 days. Okay. So these are known as HNIs in India. An HNI is anyone who has a net worth which is more than 1 year. Now, meaning of asset management companies. Example of asset management companies. The biggest example of these companies are this. So the world's largest companies. The full form of GAFA is Google, Apple, Facebook, Amazon. 4 companies. The father of these companies are none other than 2 companies. One is BlackRock and another is Vanguard. These 2 companies have invested in almost every big company in different sectors. Every big company, different sectors. Their $1 billion worth is something which is 4 to 5 times of all the GAFA companies. So they have invested in all the big companies. That's why these are one of the biggest asset management companies. So they do not have their shares. It means they have purchased the shares, majority of the shares, and at a good percentage in different big companies. That's why the worth of BlackRock and Vanguard is increasing. So these are the world's biggest companies. Asset management they are into asset management, but they have all the shares with them too. Okay, so mutual funds, hedge funds, and their structures. Services offered by the asset management division. The following services are offered by the asset management divisions, which is portfolio management, mutual funds, hedge funds, extra. And let's have a look at it, what the portfolio management actually do. So portfolio management services offered by the asset management division, that is portfolio management, and it directs the investors in a way of choosing the best assets that are readily available in order to both mitigate, lower down the risk, and provide expected rate of returns for any given degree of the risk. So portfolio management, managing the portfolio altogether. So you will be able to see some details when you do CFA or any FRM courses. But yes, friends, basis the portfolio management, what we do is we try to find out the different investment avenues, even different assets in one investment avenue. For example, stock markets. There are 50 best stocks. In which stocks we should invest and which one to be chosen, and as per the risk which is there already. So if you want to invest $1 lakh in one stock, how would I be able to help you? But if it is an MRF, your 1 lakh rupee is even less, because one share you won't be able to buy one share. But if there are some stocks which is up to 10 rupee, 50 rupee, 100 rupee, you would be able to buy in bulk. So portfolio management helps us to get us invested in a right stocks or right investment avenue as per the risk appetite which you show us. So what are mutual funds? Funds in which we invest and we become a unit holder rather than a stock holder. While investing stocks, we become what? The owner in a company, the proportionate owner in a company. So one stock, one thing. But in mutual funds, these are not stocks, these are units. So it could be a tax saving mutual fund. It could be growth. It could be fixed return. It could be anything. Any mutual fund could be. But what are mutual funds? Let's have a look. Services offered, which is mutual fund, is money pooled in by the large number of investors. So, for example, all of us, all 20 people, including me, invest 1 lakh rupee each in a fund. It means it's a 20 lakh rupee contribution. So with 20 lakh, we would be able to invest in more number of stocks rather than only one or two stocks. If I'm investing in individual, I could be choosing one stock, two stocks, max three stocks, because I will not be able to get the number of stocks. I would be able to invest in it. Same goes with all of you. But if you want to make a portfolio, we should have a right amount of the funds. Okay. And with the right amount of the funds, we would be able to put it. So it's a pool of investments. This money is then collectively invested in securities such as stocks, bonds, money markets, instruments, etc. And this is how the pool of the investments actually works. We invest in different markets, and they invest funds capital and attempt to produce a capital gain and the incomes for the funds investors. And the mutual fund portfolio is structured and maintained to match the investor's objective and stated in its offer document. So if you want to buy a new house, instead of investing it today in any of the house, there is a real estate fund also. The REITs fund, we call it REITs, Real Estate Investment Fund. You may also choose to invest in that instead of buying a house. It means it will help you to buy some units of this particular fund, and the moment you become a unit holder, you'll be able to see that yes, how it is helping you to enhance your portfolio. Let's take it forward. Mutual fund benefits, of course, these are professionally managed. Qualified professional manages your money with a research team that continuously analyzes the performance and prospects of different investment options. And moisturized mutual fund offers a variety of the schemes that will suit your needs over a lifetime. So as per your objective, you may choose the mutual fund, or you may take a professional services also, but as per your choice, you may choose a particular mutual fund also. Mutual fund benefits, diversification. One of the most important benefits is this. If I have only 1 lakh rupee and I want to invest in the stock market, I would be able to invest in one or two. Say generally one, because I need a quantity of the funds also, quantity of the investment also. I mean, quantity of the number of shares. But it will put me in a risky situation that I have invested only in one. If this is a highly risky stock, it means it has a good probability also that I will lose money from this. Right? Important. If we have right funds available. So mutual fund would do what? Mutual fund will invest in different stocks. It could be at a higher risk or a lower risk, or could be a combination of a stock or a debt. Generally, debt is come with a comparatively lower risk. So my risk is divided among different investment avenues. Hence, it talks about something which is more of a diversification, various bonds and securities, combination of these two. And I will also be benefited with different risk, with different returns. Then comes the tax efficiency for sure. So either it could be a tax-free return for me or anything else. So investments held by the investors for a period of 12 months or more qualify for the long-term capital gain benefits. And in addition, dividends are tax-free in the hands of the investors, as we know, because there is already dividend distribution tax which gets deducted from it. So a unit holder, of course, we have what, which is the sponsor, then the trustee, then the mutual fund, then the transfer agent, and then the custodian. Custodian is a company which holds the physical copy of the units, and an asset management company, which is AMC. So unit holder can buy this, and these things, of course, are being controlled by SEBI. And unit holder can buy the particular stock from the stock market itself, mutual fund from the stock market itself, or from a company or a financial institute who is offering the same. For example, ICICI Securities, HDFC Securities. These separate wing of a bank offers the securities. Could be investing in bonds, debts, mutual funds, etc. Sponsor is an entity that creates a mutual fund either independently or in collaboration with another body, and so on. And sponsor is required to meet the eligibility requirement outlined in the Securities Exchange and contributes at least 40% of the investments managed net worth. And beyond the initial investment, it contributed towards the establishment of the mutual fund. The sponsor is not responsible or accountable for any loss or shortfall coming from the operations of the scheme. So sponsor means who would be the ultimate person, responsible person who initiates this mutual fund, who would be the sole owner of this mutual fund. Okay, for what particular purpose it is being there, where we will be investing, how much sort of returns we will be paying, how we would be paying the returns, all other stuff. But whether the mutual fund would be profitable or not, that's something which a sponsor will not take a guarantee, because it depends on the professional person who would be hired as a fund manager. Then comes the trustee. So these are all conceptual related things, friends, just theoretical and conceptual. So trustee means trustee's responsibility is to safeguard the interest of unit holders and to ensure that the mutual fund complies with all applicable laws. Okay. AMC, asset management trustee, appoints an AMC to serve as mutual fund's investment manager. Correct. So an asset management company. What is the difference between trustee and an asset manager? It's trustee safeguards the interest of unit holders and ensures that mutual fund complies all the applicable laws. So for example, you are a trustee, you will make sure that yes, investment is safeguarded, that it will not go anywhere. Yeah, there'll be returns from the investments itself, but it is not fake. Every rule and regulation, every law, it is applicable. We are following that thing, and hence it is working. But you will also appoint a professional professional company, and that company would be known as asset management company. Under asset management company, there will be what? A fund manager. It is not a fund manager who will run the company. No, fund manager is a professional person who will manage the fund professionally. This is his. So stock exchange, which is Securities Exchange Board of India, must authorize an AMC before it can administer a mutual fund as an asset management company. So they should be authorizing it. Yes, now this is an eligible company to go ahead. And AMC is required to maintain a minimum net worth of 10 crores at all time. So again, these guidelines. So who would be checking it? Trustee. Who would be checking trustee? SEBI. Correct. Then we have registrar and transfer agents. Registrar and transfer agent, the mutual funds are chosen by AMC if permitted by the trustee. And registrar conducts redemption requests, sends account statements to unit holder, and processes application forms. And registrar and transfer agents, which is RTA, registrar and transfer agent, manages investors' correspondence and maintains the investors' accounts. So registrar and transfer agent for mutual funds are chosen by whom? AMC. So trustee followed by AMC, AMC followed by RT. Correct? These are people who are working as an agent, and they will keep the complete records of our funds, how much units at each unit holder holds. Okay. Fund manager, of course, we have already talked about it, but yes, a fund professional and specialized who are in charge of and accountable for the gains and losses of a given fund are known as the fund managers. And it is extremely important that they have market expertise. Mutual fund managers who is aware of these issues assess the risk and prospective returns, creates a portfolio to achieve the mutual fund's objective, which is growth, return, maximum dividends, extra. So he would be the final person responsible. Let's have a look at it. Open-ended fund is collective investment schemes wherein investors can issue and redeem the shares at any time. Open-ended, it means open. You can come and go, means enter, exit. And closed-ended fund is collective investment scheme where an investor can only enter the fund but not exit. In case they want to sell their investments, they will have to sell it to the investors within the fund.
Let's have a quick quiz question, guys. What is asset management? Your options are a financial strategy for accumulating debt, a process of organizing and monitoring a company's liabilities, a systematic approach to acquiring, operating, maintaining, upgrading, and disposing of assets, or a method for valuing intangible assets like patents and trademarks. Please mention your answers in the comment section.
So ISDA, so what is ISDA, friends? ISDA is nothing It is known as International Swaps and Derivatives Association. And it was chartered in 1985 and has 12 members institution and is spread over 980 institutions. It comprises of 12, but now it is increased to 980 total institutes in which comprise 12 members, 78 countries and 6 continents. Every investment banker, so I'm from investment banking area, every investment banker has to follow ISDA just to hedge the positions of the clients in which securities they have actually taken. For example, if I am one of the clients, if I'll say I'm Tata Steel and I have an exposure in another company, and I have also taken some derivatives to protect the exposure, could be related to foreign exchange, could be related to interest swaps or anything else. This association helps me and gives me a guarantee that Gaurav, your company or this transaction will definitely take place. It means you are rightly hedged. There are no more conditions. But yes, let's just understand what is ISDA is all about. So they give equal opportunity to all the company's friends to understand this document, and also finds out that basis this document, their transactions will get executed in its complete manner. Let's have a look at it, what this says. So there are types. So primary members or types of ISDA members: dealer firms, example, investment banks and commercial banks. And these are the first types, followed by the associate members, who are nothing, who are this, which are brokers, law firms and accounting firms. So primary members are investment banks, also commercial banks also. They come across and they share their pain areas. They share their pain areas that yes, though my position is his, but who is taking final guarantee if the position is internationally being driven, as well as if the position is, from a specific bank point of view, from private equity firm point of view, or any other commercial bank point of view, where we have taken some financial positions, and who is going to take the guarantee of these bigger amounts. They are not dealing in, say, 1 million, 2 million, 3 million. They are dealing in 100 million, 1,000 million, something like that. Amount is also bigger. ISDA helps us to get the same thing executed, and that too on timely basis, for sure. So ISDA agreement. So yes, and what is this particular agreement is? Let's have a look at it more. And there are subscribers also, end users, financial institutions and the government entities. So these are the three people. One is the primary member, associate member, and there are subscribers who can subscribe to these ISDA things. So even a government entity can also subscribe into this. A financial institute can also, because financial institutes are nothing, these are just the banks. And more than banks, generally we see banks, but more than banks, the financial institutes are also private. These are IRD, that is insurance firms, Insurance Regulatory and Development Authority is one of the regulatory authority for the insurance companies, right? So financial institute is not IRD. Financial institute would be an insurance company, insurance firm, which has large amount of the funds which are available to them. Could be NBFCs also, non-banking financial corporations. They have the fund, but they are without the banking. They do not try to do the banking related stuff. Let's take it forward. Role of ISDA is categorized into two: corrective measures and preventive measures. So when I say preventive measures, identify the risks, identify and reduce the sources of risks. So while investing in different investment avenues, specifically could be equity or so, first is to identify the risk. First is to identify the risk and reduce basis the sources, reduce the sources and all. So developing ISDA master agreement. There is a website which I'll also share with you where you can also find out more details related to that. So ISDA agreement, which is International Swaps and Derivatives Agreement, a master agreement, which would also be shared. So it could be related to swap. It could be related to, related to taking a derivative position. and finally hedging it out. Friends, important was, or why this thing came up into picture. It came up into picture because of one reason, that across globe there are many transactions which are happening to reduce the risk. So people or companies are taking positions in the actual market, which is in the stock markets or anywhere else. Further, they are also taking a position in the derivative markets, and they also know that the derivative also fluctuate because derivatives is derived from the main market. How to hedge the same thing? That's the way across globe. That's the way ISDA master agreement came into picture. As I shared with you, 980 institutes are still, as on day, there are 980 institutes which are part of this ISDA across different countries. Publication of the document material, legal opinion on enforceability of netting and collateral. So netting means how to net it off. Net off means what you're supposed to get and what you're supposed to pay. Finally, the payment which being there. Okay, so this way the things are, and simultaneously the collaterals would also. The second would be promotion of the risk management practices and standardization of the document and fostering the high standards of the commercial contract. So when I say standardization of the document, means it's not the one document which would suffice the purpose in one specific country. And the best example of standardization which we see in the financial statements, one of the best example are the rules and regulations to be followed to prepare the financial statements. And those rules and regulations are none other than the GAAPs, or I would say, these are IFRS or Ind AS or US GAAPs. US GAAPs to be followed by all the companies which are listed in US. IFRS to be followed by 171 countries across globe to prepare all the financial statements basis the standardization. The same concept, this ISDA also adopted while making the document. The document in itself is a complete document, which is one standardization document across different countries to be followed, so that a uniformity would come up basis, addressing majority of the issues and coming up with one solution. And again, this document is, or the inputs of this documents are being given by all the financial institutions, that what they should look forward for and how to understand this particular document in itself. So the next is the corrective measure. Corrective means that is treatment and risk management related to public policy, related to regulatory capital perspective or so. So one is preventive, another is the corrective measure. Corrective means wherever the corrections are required, this organization comes into picture and talks about that here is the right risk management which you should always take care of. And though they have already standardized lot many things, friends, so though the corrective measures are there, but they play a comparatively less role. First is the preventive measures which takes place. So let's understand this document in more detail. Structure of ISDA documents, and we have the structure. Let's have a look at it. What it says: once signed, master agreement governs all future individual transactions entered into between the counterparties. And I have already discussed what is counterparties. So it must be between all the counterparties, two or more as the case may be. So governs all the individual transactions entered between these two counterparties. So it could be related to swaps, it could be related to derivatives, it could be related to both, but it is not related to something which is an buying of the shares, which is the primary buying, which is, I would say, which is the first hand buying. No, it is related to the derivative contracts and the swap contracts, and to protect the investor that yes, this derivative contract would be executed in its completeness. Correct? And negotiation of the master agreement with care and prudence. So there are also possibilities, friends, that the other counterparty, or I would say the counterparty, is not in a position to pay you back. It could be basis bankruptcy, it could be basis defaults or anything else. Those cases are also dealt in the master agreement. So this master agreements helps us to understand and being taken care and as per the prudence that, basis the current scenarios, how we can modify some of the other terms and take the contract forward, keeping the intent of the counterparty in the mind. The recent example, like what happened in 2022, and it is still happening. There is one country which has faced some economic crisis, not at a huge level, but yes, it faced economic crisis. Okay, that's one of our neighboring country, Sri Lanka. So that company faced financial crisis, okay, and it is still trying to recover. If that economy is bad, it's being hit badly. So any contract with the Sri Lanka country would definitely have an impact on the inflows of the receiving country. It could be any Asian country, also any APAC country or any different country too. So to protect them, and some things which are not in control of the company, these are external factors. Internally, of course, there are many things which can be controlled. External factors which are not in control of the company should also be taken into consideration. So ISDA master agreement is also known as boilerplate document. So this is known as boilerplate document. Various provisions of ISDA master agreement, and these are related to interpretation, conditions precedent, netting off, withholding of the taxes, representations, undertakings, and early terminations, and government laws could be. So related to that thing, what is the agreement, conditions which are inbuilt to that, also taxes which could be paid and which could be withheld within the organization, some undertakings if there are any. An undertaking is a very popular word in case of that is structure of ISDA master agreement. Master agreement, that is standard terms, multi-currency, cross-border master agreement, local currency, single jurisdiction master agreement. So if it is a multi-currency, then it will be related to the cross borders. And finally, it could be scheduled credit support document, could be in English, Japanese, or if it is multi-currency, it could be confirmation. ISDA definitions would also get covered into that.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
On Feb 28, 2022, ISDA published the 2022 ISDA Security Financial Transaction Definitions and related documents. The new document allows firms to enter into derivatives and SFTs, which is Securities Financing Transactions, under a single ISDA master agreement. The publication followed an ISDA October 2020 white paper that detailed a proposal of the standard document across the repos and the stock loans related to that. Okay, and I'm just reading it one more paragraph which is taken. ISDA SFTs documents are products of the year-long drafting and comments process by an ISDA working group that includes buy-side and sell-side participants with both an SFTs and derivatives focus. So how to use this document? SFT schedule, provisions, definitions, forms of this and all. So documents and architects, and then here I would request all of you to please have a look at it, which says on the left hand side, which is ISDA master agreement includes SFTs schedule provisions in the schedule, and this goes where. So it says credit support document on the right hand side. Could be variation margin, could be credit support annexures, could be 2018 initial margins, credit support deeds or so, and could be confirmations related to stock loans, repos, confirmation derivatives, which is on the bottom line, which is here. And then the SFT's definition and the other ISDA definition, which is a booklet as per which is available to all of us. So it is as per the definition which is in 22, which is related to equity, derivatives, and all. Just come a bit down. This is the architect. So no questions will come from architect. I just wanted to share with you. Yeah, let's go ahead with the second paragraph. I'm just giving a small reading. By utilizing the ISDA SFT document, parties are more easily able to negotiate bespoke structured transactions without having to make substantial changes to a master agreement. And ISDA SFTs documents built on the framework of the ISDA master agreement, providing for representations, warranties, closeout mechanisms, events of defaults, and other relationship levels contractual agreements across stock loans, repos, derivatives. If desired, the SFTs documents provide flexibility of parties to customize their standardized positions for their following as potential use case and benefits that the market can currently gain from utilizing the ISDA SFT document. Simplification and streamlining of the document. So for example, parties, let's have a look at it. I'll just give a small reading to this. So for example, parties can use a single set of representation, events of defaults, and tax provisions. So three things: set of representations, events of defaults, and tax provisions. And this type of consistency could reduce legal cost, as parties only need to negotiate one master agreement rather than multiple versions. And it could reduce the operational cost. System could be programmed to reflect one document and standardize with the consistent definitions. And so there are many more things which is common domain model and many more things which are already here and so on. So specific areas where simplifications and streamline could be of benefits are equity prime broker relationship, and which says that prime broker offers into variety of agreements with clients and all. This is more theoretical. Then it is related to emerging markets. And what is related to closeout? Let's have a look at it. What is related to closeout? I'm just going to give a first para reading. That is, COVID-19 pandemic and Ukraine crisis have prompted market participations to look at the termination provisions in their documents. So friends, what happened in the COVID was that, yes, many of the contracts got terminated because of non-performance, because markets are not open, nothing is open. So nothing is getting executed. So sometime if 15 days time, if nothing takes place and no operational activity or a construction activity is taking place, then either the party can come into picture and also take an immediate action that, yes, there's nothing happening and let's terminate it. It was an exceptional case in the world, which is COVID, or maybe a Ukraine crisis, or could be a war-related situation in which both the countries or either of the countries cannot just control. So crises have prompted the market participants to look at the termination provisions, and key aspects have involved the way in which the events of the default operates and the availability of the illegality, excuse me, and force majeure provisions, which is something which is not in control of the company, which is related to something war-related situations. The available methods for the services of notice and timing in the process of the closing out the transaction. That is closing out the transaction. Yeah. So corporate equity derivatives are used by the investors such as hedge funds, private equity funds to raise finance, to acquire a physical holding of shares and monetize in existing positions of shares, or gain economic exposure to share without physical acquiring them. Okay, now, so since I know that we are already through with the derivatives, put options, call options, these are the concepts which are already been through. So for example, if an end user buys a put option, so when a person buys a put option, if may I ask, only from the hedging point of view. So if the person has an expectation that the market will fall and he or she wants to gain from the falling market, that's the way that put option being used. So put means right to sell. The dealer will generally establish a short position in the shares as hedge against the share price falling below the stock price. The dealer can achieve this by borrowing the shares under a stock loan immediately and selling the market. If and when the position is excess, the dealer can purchase the shares in the market to return. I'm just reading it. And the difference between the sale price and the purchase price helps to cover the dealer's position. In some circumstances, the end user owns the stocks and can be cheaper and can cheapen the cost of the put it is buying by providing a stock loan without requiring the collateral. So what does it say? So there is a put position which is being bought by the dealer at a certain price, and put option hedged by a stock loan. So what is happening in this case? Let's understand with the help of this chart and the diagram. End user on the left hand side, option buyer or lender, and on the right hand side is a dealer, which is an option seller or a borrower. So put position, it has taken a put position at a premium, and we know that premiums are the amounts which we pay to buy, to take a long position. Strike price on exercise of the option will be there, and securities on exercise of the option will be provided to you. And there is a stock loan. So what is the put position, friends? An option premium will be paid, and finally the strike price at a specific strike price on exercise of an options on exercise. So once the particular put option is in the money, then it will be exercised at a particular strike price, and so on. So if a put option holder is in the money, then he or she holder would exercise it, else it will not get exercised. So if it is a call option, friends, it means it is in the money. If it is a call option, when I say call option, it means you have an expectation that the market will rise and you will like to gain from the rising market. So the moment the market is rising, the prices is rising, it is in the money. Because of the strike price, it will go beyond the strike price. But if it is falling, for example, if it comes down, it becomes out of the money in case of a call option. We buy put. Why? Because we want to gain from the falling market. If the strike price is 100 and stock market or the stock price is 110, it is out of the money from the put option point of view. Okay. And if the current market price is 80, again the strike price is 100, then you will become what? Or the option become what? In the money option, which is known as the ITM, which is a put option will become ITM. Are we clear on that? So in this case, excuse me, the person has taken a stock loan. It means a dealer has taken a loan, and hence this will come up. Borrower. So loan has come up and delivery of the equivalent securities on exercise of the options. So who would guarantee this transaction? That this will be at the end of the day, the put option would get closed. What is the expiry of the put options? Or I would say any option. What is the expiry? So we have the expiries, which is 1 month, 2 month, and 3 months, which is every Thursday of the month and every last Thursday, because on last Friday of the month, a new contract for third month contract would come up. So who takes care of the guarantee of these things? So ISDA agreements also helps us. These master agreements helps us that there won't be any counterparty risk, friends. So from where you have taken a stock loan and where you have actually also taken a position related to the put option. So the person has taken a stock loan as well as taken a put option, and from that, while buying the put option, it has made a payment related to the premium, and hence at a certain strike price. So this how the whole thing is actually happening. And how come the master file would take place? Definitely in this manner, the master file would actually take. So number of notes repack programs involves the use of swaps and or SFTs, and of course these could be under under these programs, an entity, usually a special purpose vehicle, which is SPV, will issue some notes secured on collateral. And this, so these are not the currency notes for sure, note in writings. So repacking program. So just come a bit down. Let's have a look at the diagram. Repackaging the program, which says there is a note holder. Proceeds of the note holder, will go to the issuer, and the payment under the notes funded by the synthetic exposures and the swaps or the rescheduled collateral. So the payment would be to the note holder. On the right hand side, it is securities collateral. Collateral would be provided, and so collateral means for sure if there's a default, then this collateral will be used to recover the money which has been default. And there could be some swap counterparties and repos counterparties. So if exist, then repo counterparty would come up, else it will not come up. But there are swaps counterparty which would also come up into picture. I have issued a bond which is of a fixed rate of interest, say 8%, 8% to make a payment every annual. And to make that same payment, I have an holding in one financial instrument which provides me
some variable interests. It could be 9%, it could be 7%, 6%, basis the different market scenarios. So one is a floating rate of interest, which I have taken, and there's a fixed liability which I'm supposed to pay with an interest, but the amount are same. There's another party, friends, which has some inflows related to the fixed, but an outflows which is floating or which is variable. So if I can find out that party, not basis the interest rates are same, but also the total capital amount to be paid same. So for me, it is very difficult. For even a single bank or financial institute, is difficult to find out the right swaps rather than only doing a swap. Who actually plays a role in finding out the right swap at a comparatively lower cost or a minimum cost? None other than investment bankers. So one of the job of investment banker is to execute these transactions. Company, let's bring one platform. Just like a stock market, we have one platform where we could see equity, derivatives, currency, as well as commodities and many more things at one place. They also provide one platform to us that yes, you are being given this particular opportunity to swap for different currencies, also different rate of interest also, and currency and rate both together. So that's why they try to reduce the swap counterparty risk also. So they are swapping it, but yes, if the bank is able to default or the company defaults, then who is going to take any guarantee? Investment banker will not take a guarantee. Let me tell you very clearly. Investment banker is not guaranteeing any sort of an interest payment or anything, but it will help you reduce the cost of raising this particular funds. So who is taking this guarantee? This document, master document, ISDA. So Basel is a place where the first meeting took place, and standardization of the norms which would be followed to take care all the banking related transactions globally. So the people or delegates from different countries actually joined that meeting at a place namely Basel. That's why they named all the rules and regulations being created to perform all the activities as Basel 1, Basel 2, Basel 3. Basel 2.5 also has come up, as well as the latest one is Basel 2010. So no need to go ahead behind those rules and regulations. Capital adequacy ratio is there. RWA is also there, which is risk weighted assets. Many more terminologies which are there, which is here also, which is CCR, which is counterparty credit risk. So Basel got created to reduce the counterparty risks. Counterparty risk related to the credit risk. So credit risk take care of, if we have given some credit to someone, there will be a risk related to the counterparty. The counterparty won't be able to make a payment. So how to address the same thing? That's why the Basel committee was being formed, and they made those particular rules. You could see the last line in April 2022, ISDA requested that the Basel Committee of the Banking Supervision revisits the SACCR, which is standardized approach for counterparty credit risk. So this ISDA also helps banks and the Basel committees to define all those rules which are to be followed. Okay. So election referred here, that is the elections referred at the payments measures and the methods, the thresholds relating to the certain events of the default, and the offices through which the parties can, and amendments, that is parties agrees to make the terms of the master, and additional terms. Parties can include set of clause between the closeout amount and the amount of owing under the. So in one of the slide, I'll show you one of the agreement over confirmations. Peculiarities for the confirmation for derivative transactions could be related to trade specific terms and unique for each trade. So I'm not going to read all. Executed versus exchanged and so on. Yeah, and I know this is very microscopic. I know that it is very microscopic, but ISDA confirmation, Massachusetts Water Resource Authority, and here is the from Wells Fargo Bank NA. So Wells Fargo is also a bank which has actually conducted. So it's related to USD 133, I would say 133.300 million interest rate swap transaction, and this is something which has come up. I'll just read out
couple of things, which is related to the trade date, which is October 28, 2008, effective date, which is again October 28, termination date, which is 1st August 2030, subject to the adjustments in the accordance with the following business day conversion, and upfront payment would be related to USD 25 million payable by the party A to party B, and upfront payment date is 31st October 2008. Fixed amount would be fixed rate payer, which is party B, and fixed rate payer, which is the first day of the February and the August beginnings. So this is related to the debt agreement which they have actually formed and who would be making what. So at the top of it, we write what ISDA confirmation. We get it confirmed from ISDA basis this. I'll just do a small reading that the purpose of the letter of agreement is to confirm the terms and conditions of the transactions entered into between Wells Fargo and Massachusetts Water Resource Authority, state government, government tax exemption agency, which is party B, and this transaction is effect at the end at as of 12:01 a.m. California same time trade date specified, and the definitions, ISDA, and couple of more things which are already here. So how these transactions and who is backing up? So we at the top of the doc we write it ISDA confirmation. Okay. Some credit support deeds, which is related to credit support annexures, legal agreement, which sets forth the terms and the conditions of the credit arrangements between the counterparties. It's a legal document and a legal arrangement. Okay. And I'm just going to read it further. That is collateral support, which is related to legal agreement, which sets forth the terms and conditions that collateralization will occur under in a bilateral and a multilateral relationships also. And the last would be independent amount is required to set off the potential future exposures or credit risk between the margin calls calculations periods or so. And if daily calculations are used, the independent amount offsets the overnight credit risk and so. So there are many things which are part of the credit support deeds. If required, the credit support deeds to be required, then it will take place, otherwise it will not take place. And what is the meaning of it? That is, stock lending is when lenders temporarily lend securities to borrowers in exchange for borrowers' promise to return the same securities to the lenders at the later date. And securities are basically sold to the borrower under a contract for repurchase of identical securities, not generally leads to the borrower. So what does this say in simple words? That you are lending out the securities. You are not selling the securities. You are lending it, and after the contract is over, you will get the securities back. So that's why it is stock borrowing and lending. It is different than it's absolutely different than the stock purchase in the markets. I'm sure you must have not, but let's have a look at it, what it says. It's again a smaller module, but it's covered with concepts as well as the detailing part of it. So majority of the SBL activities, which is stock borrowing and lending, happens on the over-the-counter market, and it's secured by collateral, which might be money, securities, or other assets. So it's a more of an OTC thing. Correct. So it is not happening on the stock exchange platform, which is NSE and BSE particularly, but here is. So parties will initially agree on the eligible collateral, and it is the subject of the General Master Security Lending Agreement. So another agreement gets created. One we read it, which was in the previous module. Here also it's related to stock borrowing. Hence, it is an agreement which is known as General Master Security Lending Agreement. And there are a couple of things related to that. So phrase security lending is deceptive because according to the law, securities are generally sold out to the borrower with an agreement to reacquire equal securities later on. And both securities that were lent and the collateral that was received passed into the absolute title. So we give or we lend that particular security. Followed by that, in future, we will buy the equal securities or equal amount of the securities or reacquire those particular securities also. So that's the whole concept of stock borrowing and lending. And that too with a change of a title. So security lend and borrower may sell the original securities to the additional buyers also. So this could also take place. So let's understand it in a more deeper one. So why securities lending? Suppose if you want to lend something to someone, what would be the purpose? Why you would like to? I guess more or less the reasons could be same: interest earnings, more earnings, and so on. So investment bankers, brokers, and market makers borrows securities for number of purposes, and those are, so first of all, who buys? If you're lending, so there must be someone who is buying it, right? Who are these buyers? Investment bankers, brokers, market makers. Okay, to ensure that the trade settlement can occur. So what does this mean? It means they are, you know, buying these securities. Someone has already lent, and there's a possibility then someone has already short sell those securities. So let's talk about something. If you are trading in a market, so we know that we can buy the securities today. Okay, immediately we can give an order and we can buy. Can we immediately sell the securities provided we don't have the securities? Or can we immediately sell the stock provided we don't have stock? In this case, there is another possibility for you to do this particular transaction. You can immediately short, you can immediately sell those securities at 100, 10 rupee each or $10 each. You will immediately gain. Gain means the money will not get credited to your account, but yes, you will. Commission will be reduced. At the end of the closure, if your prediction is good, say around 90, and it reached 90, you would do what? You will buy at 90 all 10 stocks. So it means you have bought at 90, the lower price at the close of the market. You sold it initially in the higher prices, and hence the gain is something which is there. The challenge or the problem will not come here. The problem will come if it goes above, say from 100, it goes to say 110, 112 or something like that, more beyond your expectations. Okay. And this time you have to close at a loss and you forgot to close. So think about a situation. You guys have already sold out securities. I repeat, you guys have already sold out securities, and without having the securities, expecting that the market will fall down and definitely you will gain from the falling market. Okay, market will fall down, you will gain from falling market, but it happened just opposite. And you don't have stocks, and you forgot to settle it down at loss. It will go to the auction. So if I have purchased, it means it's my right to receive those stocks. From your point of view, it is your obligation to give me the stocks, and definitely I'll make you the money. So here the lending purpose comes up. So you are supposed to buy those securities from someone so that they would be able to give those securities and put your securities in your account, and from your account it gets further being transferred to my account. Broker will never ever transfer to the client's account. So investment bankers, brokers, and market makers borrows securities for a number of purposes, such as to ensure that trade settlement can occur. So if you are in short of securities, they have borrowed those particular securities from someone, okay, with an assurance that we will return you back. No worries. So the cycle is coming up in this manner that, friends, you have shortfall, you don't have securities. From where you will get it? Someone has already, or someone is going to lend you the securities, and at the end of the day, or maybe at the settlement time, you will be returning them back. So to ensure that a trade settlement can occur, the first trade settlement, there is a possibility to support the market making and other trading operations such as hedging and short selling, as I shared with you. It happens because of short selling. And by supporting price creation and promoting high settlement success, securities lending contributes significantly to markets liquidity by ensuring a smooth operation of the financial markets. So friends, securities, financial markets, or I would say, the stock markets provides us the full opportunity to trade in stocks either for buying or for selling the same day. So buying, you can keep a position with you, but selling we cannot do for more than one day, else it will be known as short selling. It means we have sold a stock in which we are already short. It means we do not have those particular stocks at the end of the day. Now, from where we are going to buy the stock, even we do not know. Someone is going to lend to us to make sure to fill that particular gap and to be given to the buyer who has already made a payment to you. And there's a fee, there's an auction, and many more things. That's a complete process which is there. So why securities lending? These are a couple of reasons which are why securities lending again. So investment bankers and all. So some investors may utilize securities lending as a mean of generating extra revenue from their investment portfolio because there is a demand for borrowing. So they also try to lend. An investment banker will keep a huge amount of the securities with them, and definitely they can lend it at a price, but just by charging the commissions or at a higher rate of interest. Or a higher commission rate could be 3%, 4%, just like, just taking care of the emergency situation or an exigency situation at that particular point of time when some company is short of those things. So trading of participants in securities in stock borrow lending. Okay. So the main market makers of the SPL are banks for sure, market makers, hedge funds, traders, mutual funds, brokers could be. And brokers executes orders on behalf of its clients, whereas a dealer trades on its own account. So what is the difference between a dealer and a broker? So a person who has the right to use the terminal, that is a trading terminal, who has the right knowledge to use the trading terminal for the trading purpose for sure. So who would be the right person? Generally, the person who qualifies the examinations, either by NSE or a BSc. So in India, of course, these are the national stock exchanges. These examinations are related to capital markets, derivative markets, and there are n number of examinations which are for a specific market. For currency market, for commodity market, there are many more examinations. So friends, once we see that the stock market certifications are already there, it authorizes to become a dealer. Dealer means who would deal, who would see that, yes, how to execute the orders over here. Now, on the other hand, brokers are the people who have the right to see the complete terminal, who are registered as a broker, under whom there are some clients and could work, or a dealer could also be working under. So broker would appreciate a person who is a dealer who can execute transaction on his behalf and on the client's behalf also. So two types of people. Broker can execute on the client's behalf as well as on his own behalf, as well as a dealer would deal on the transaction. Means who would perform the same thing on the platform. It means who understands the platform, the trading platform. Okay. So if you want to, gain more knowledge about the trader, the dealer, or if you want to become a dealer, it will cost you not more than 2,000 rupees. You must be surprised. But for to become a broker, it will cost you 200 to 300 crore rupees also, because the security amount which you are going to put. So there are less brokers, but there are n number of dealers. So 2,000 rupees is the examination fees of NSE. And there's a capital market dealer module. So there's a word, namely capital market dealer module. If you wish to, you can definitely do that. Types of security trades in SPL. Securities lending covers securities such as equity, fixed income, which is bonds, corporate debts, obligations, and so. And collateral could be cash or securities or combination of them. So after becoming a dealer, you can work at an individual capacity. You do not require anyone's suggestion to go ahead, and you could be given a right to work on the terminal directly. So it could be related to lenders who would show their interest in securities, and further related to the borrowers, and the borrowers would charge something related to the fee, to the collateral, and finally from the lenders itself. So this how the security lending flow takes place. And let's have a look at it, the next part. So the trading process in SPL, that is when a security is lent, the borrower acquires the securities title for sure. By becoming the owner of the security, the borrower gains the benefit of owning it, and all coupons and dividend payments, as well as any additional privileges like voting rights, will go to the borrower for sure. These dividends and coupons must typically be returned to the lender in the form of manufactured dividends as the term goes. So if you lend some securities to someone, for example, if you lend it to me, now I'm the security holder, I have the rights to gain from it. So all the coupons, if I have been given or being lent as a debt, all the dividend payments would definitely come back to me. And these dividends or coupons may typically be returned to the lender in the form of manufactured dividends as the term goes. So they have not originally gained, I have originally gained because I am the current owner of it, and definitely it will be so. So it is referred to the payment made to transfer dividends and interest payments from the borrower to the lender to those securities. So it is a capital amount plus anything which you have gained, it should be returned back. Custodian services and company A, company B, and we have, for example, here is the need, and here he has Adani 1000. So company A need Adani shares, company C has Adani shares, and it could be transferred like that, and SBL contract could also be taken care into consideration. What is custodian? So NSDL and CDSL, there are two custodians. So just search the full form of the same. NSDL, CDSL. I'm writing in the chat. CDSL. Correct? Meaning of CDSL is, so there is a company who takes care of all the deposits or who keeps all the documents which are in its physical form at one place. Okay. And when I say at one place, CDSL is a company which is Central Depository Services Limited. All the physical form of securities are being kept with them. Okay. So just like the lockers where we keep something which is in physical form and hence which is there. So custodians are these things who provides. So custodians have all the securities with them, correct? They know that the security belongs to who is the owner of this. So for example, company C is the owner of 1000 shares. So if you want to check who's the owner of that 1000 shares, go to the CDSL, and CDSL would be able to answer you the same thing. Now company A needs 1000 shares. So through a custodian, you can also take it forward, and through an SBL contract also, you can also take it forward. So company C can lend company A provided the same SBL contract has taken place. So let's have a look at it. If so, replicate SBL, company A, company B, and company C could also be are receiving custodial services from custodian. Adani 1000 shares are needed by company A, and Adani stock is held by company C. Because the custodian knows both counterparties and becomes the guardian in this situation, there is no market risk. Both the parties will be charged fee by the custodian. So there is no market risk. Market risk means this is a change in the prices or any other number, the value of the security will get changed. No, so they will charge a fee, and then they know that who is holding how many shares for that. So this how the things take. So there is a wide range of possible collaterals used to collateralize the credit exposures with various degree of risks. And the types of collaterals used by parties could be cash, government securities. So on what basis I'm giving? Of course, cash. There could be a possibility that I am giving you a government security. So for example, against my fixed deposit receipt, against my FD, I can take one more, I can do one more transaction, but I'll make sure that FD will not be used by the person, because if I'll default, in that case, an FD could also be. So that's why it is a collateral. Often direct obligations of G10 securities, Belgium, and all other stuff. Mortgage-backed securities. So securities which are backed by the mortgage agreements, it means those are in physical form. Okay. Corporate bonds, commercial papers could also be. Letter of credit guarantees, and equities and government agencies securities could be. So all these qualifies for what? For the collateral. Okay. So even my own securities could also get qualified for that, and I will lose a right to sell those securities at any point of time. So I'll keep it with them, and definitely I will not be executing anything from that. Why? Because there is no purpose. Now I have given the same security to, say for example, you, so as a collateral, so I won't be able to sell those particular securities at any point of time. So SBL makes sure that whatever the collateral, if so, it could be in its physical form, like for example it's a tangible, or it could be intangible, but yes, the right document must be. So fee and rebates in SBL, some fee. So SBL fee paid by the borrower to the lender vary accordingly to the nature of the securities lent. And other factors include creditworthiness of the borrower, duration of the loan, types of collateral used while you will be used also affect the fees. And a lender who receives cash and collateral from borrower will reinvest it, and he will earn spread between the reinvestment rate and the agreed rebate rate which he pays to the borrower. So it's simple, friends. Fee and a rebate would also be provided. Fee, definitely it would vary, so there is no standard fee for it. So let me be very clear on that. So it could be 2%, 5%, 10%. Generally, a fee. So there is a cap on the fee, but it could vary from country to country also. So some countries allows that yes, you may charge any fee basis the amount of the transaction, or you may charge the fee from both buyer and buyer as well as the lender, or so you can charge fee from the one, but generally it is being charged from both the parties and so on. So there could be a reinvestments also, and many more things which could be the part of it. So like for example, in case of an arbitrage, there's a difference between the spread. Hence, the same thing happens in case of the rebates, which could also be offered at the time of calculations of it. Securities borrowing to cover a short position. As I shared with you, borrowers borrow securities could be related to settlement coverage and naked shorting, as well as the market making. As it means, so what it means that you do not have a single stock, and even that you have taken a bigger risk that yes, I don't have a single stock, but I want to short sell because I want to gain from the falling market. So selling securities for a loss with no corresponding long position is known as naked shorting. Okay, securities for a loss with no corresponding long positions. So I don't have any long positions in any of the stock, but I have just already sold the same thing, and I have sold the same thing at a loss. So I closed my position at a loss itself. So with the example which I shared with you in the beginning, 100 rupee stock or $100 stock, I have said 10 of those, and I have already short on them. Okay. Now, this is a short for this particular position. I was expecting the market will fall down, but it has increased, and it closed at a higher index value. In that case, I would, and if I want to close the position for the day, I don't want any stocks to be kept with me. Higher price, say 110 or 112. So 10 or 12 rupee difference, I would be land up paying more plus the brokerage. So for a buy order to be filled and the tight two-way pricing to be created, market makers must also be able to borrow the security. So this is something which is more towards from the buying point of view, and support a financing deal driven by a desire to loan money to temporarily transfer ownership for the benefit of both lenders and all. So let's do one example. Let's understand this particular thing.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
It is well established idea in the financial sector to offer securities in the form of real estate, money, gold, securities against potential payments defaults. And the following list of key collateral characteristics. And it is utilized as promised that the necessary cash will be paid at the appointed time. Yes, so necessary cash, what is being offered or what is being decided, it will be paid. And credit enhancements, it assists the business in reducing the credit risk by accepting assets of equal worth. So for example, if I have taken a loan from the bank, this is a home loan, company or the bank is taking or is assuming almost a zero risk in that. The reason is, as we understand, the reason being that tomorrow day after it's a default, particular asset sold out to recover the money, backed by equal worth or more, could be. I have taken a personal loan, okay, which is not backed by any other security, but yes, I can keep the bullions. Like there are things related to, I'm sure you must have heard about companies or things like Muthoot Finance, Chola Mandalam. So suppose you want some cash, say equivalent to 5 lakhs rupees. You have a gold and equivalent to the worth of the gold, or could be a bit lesser, the bank is ready to give that amount, and that too at an interest rate. So they will say that you put the money here and we will provide you that amount which is there at a certain interest rate, which would be around 16%, 14 or 12% to 16% a year. Okay, though they charge something or the other, but they have the different things. So GIG gives loan in exchange of golds. Exactly. So loan at a specific rate of interest, because I know that yes, sometimes we require some good amount of the money. We have our bullion. We don't want to sell them. The purpose is not to sell your current gold. Purpose is to keep the gold as a security with those particular banks and get the money. The moment their whole amount is paid, say in 1 year, 2 year, 3 year time, as the case may be, like the way you have actually, or you would have already taken care of. In that particular case, the moment it is paid, you will take back your, right? Though they say 1%, 1.5% or 2%, it is further negotiable. I must share that with you. Okay, so you can take the benefit of it, but your original security is intact. Tomorrow day after, if there is a default, then they have a right to sell it. Okay, the next thing is handle the crisis. It aids in managing and resolving crises like those involves the economy, currencies, or the market participants. So could be economic crisis, could be currencies or so. But the 2008 crisis was first not new. It was just being a smart play by the investment bankers. And one of the biggest investment banker got bankrupt basis that, and it was a baby of an investment banker itself. From the not investment banker, investment bank. And can I hear that name of the investment bank which got bankrupted that time after the 2008 crisis? It's a very, very popular name. Yeah. So I would request you, please write down a couple of things which are not there in the PPT so that it will give you another edge to, have a look at it. So if you have already studied it, it's good. But if not, then yes, Lehman Brothers was one of the banks which got bankrupt, and there were many more financial institutes who were nearer to the bankruptcy because they knew that once the bubble will burst, then this will have an impact globally, not in one country only, right? Because they have taken exposures not only basis US, but in different continents, not only countries, I'm saying complete continents. So purpose of collateral, approach to improving credit that enables net borrowers to get better borrowing rates or haircuts. Haircuts means the upper, that is the maximum rate of interest. So there's a cut at a rate, hence we call it a haircut. A method of reducing credit risk. Focus is on what, friends? Focus is on credit risk in a private or over-the-counter transactions. That balances the chances that the counterparty may breach the terms of the deal in whole or the part, and applied on the net on a net basis to secure specific deals or not to protect from interest rate risk, market fluctuation risks, currency risk, means currency rate fluctuations. It is to protect against counterparty risk. That is, and counterparty risk is none other than the credit risk. Purpose of collateral is to go ahead and take care of the credit risk itself. And when trading between parties would normally be banned by the credit risk limitations of rule, a trade facilitation instrument allows them to do so. For example, European pension fund regulations or Islamic banking law. So every country has their own specific laws. Specifically, there's one more law, namely Islamic banking and Islamic banking law. So those things have already come up, as well as pertaining to overall risk, legal compliance, market risk, VAR, stress testing, as well as capital sufficiency and risk management and so on. What is VAR? Value at risk. Can you just have a look at it from the left hand side itself? So the quantity and the bid price, which was 115.80 and many more, and hence then the trading information related to trade volumes, total market cap, free floating shares. Okay, of course, freely floating shares means which is with the retail investors. Impact cost, daily volatility, it means it is volatile basis. This 1.92. 1.92 means that if the share price is 100, it could go above plus 1.92 and minus 1.9. Okay. Annualized volatility and so on. Then we have 52-week high-low, which is still, 52-week high-low, it happened, and on which date it happened. So it highest reached to 94 and lowest it reached to 295, 124 and 95. Upper band, lower band, and many more. These are just few calculations, and there is no price band to that. Yes. On the right-hand side, there are risk-related things. Security VAR. Security means this Tata Steel's equity. It is 12.2. These are in percentages. What does this mean? This means, so first of all, VAR stands for value at risk. Of course, these calculations are taken care by the stock exchange itself. Stock exchange believe that yes, it's a right of an individual investor to have the right information. What to do with the information that an individual investor must learn and then take a decision on. Okay, we are going to provide you the information. After that, it's your call. It's just like that they provide you once you drive. It's a red, yellow, green. Meaning of red is to stop, and then yellow is to just to start your engine and then go. Green is go. It's your call whether you want to jump the red light or you want to make it as smooth as possible. So providing information is the duty of the stock exchange, and it's your right to receive the information. What to do with that information, it's up to us. 12.20 means that this stock has a possibility and a probability to increase by 12 rupee 20 paisa, assuming 100 rupee being the base price, and to fall by again 12 rupee 20 paisa on daily basis. Basis last, so updated intraday, basis last 1 year data. Okay, VAR, value at risk, how much? So it is a risk in a portfolio. Portfolio could be one, of course, more than one stock. It could be n number of stocks also. Okay, so generally we calculate VAR for the purpose of understanding that how much value we are going to lose basis one standard deviation. So this is a bit more mathematical in this case, but you just understand this, that it has a possibility to lose 12 rupee 20 paisa and to gain by 12 rupee 20 paisa in a day itself. Okay, and there are extreme loss rates also, ad hoc margins also, applicable margin rates also. This could also work, but how to calculate, how to derive out the same thing, these things are not there. So basis this, now you have understood this, that what is the meaning of a VAR. I have shared a live example in front of you. Now let me know, friends, should VAR be higher or lower? It must be expected to be as lower as possible. Is it clear? So how to calculate the same thing and all of the stuff, that's a different story altogether. Okay, so every security, whenever you're planning to buy a new security or anywhere, just give yourself an opportunity to have a look at the fact. Basis the price, which is 115.80, is this where good or bad? And we have the derivatives also of the same, and we have SLBs also for the same. Series A, Series B, securities lending and borrowing mechanism and all. So we can see how many securities and who is actually doing the same thing. So you can give yourself an opportunity to have a look at these things, and you would be able to find that what are these particular things are actually calculation of aware, because calculation of aware is not the purpose. Yes, understanding what is the meaning of it, how to interpret this, that is the main purpose. And every time whenever you are purchasing a security, friends, it's a recommendation from my side, always see this. If it is on a higher side, it means it is highly volatile security. Comparatively low, it's less volatile. So 10% and above, I call it aggressive. Less than 10%, I call it a defensive security. And the market risk which gets calculated with the help of VAR and many things. Again, the purpose again is that is the money markets investments, lending for short periods to earn interest on available cash or securities, and a balance sheet management techniques used to optimize the bank capital by earning extra income from lending excess assets to other institutes in need of additional assets. So banks also lend. So they have the funds which are available. So banks or a balance sheet management technique used to optimize the bank capital by earning extra income from lending excess assets. Because I have seen majority of the time, company has purchased a particular land and they have taken the land on lease for further rent to further let it out. Okay, so it is not a building which they have let out. It is a land which they have actually let out, could be for any purpose, and the basis that they are earning for. Generally, the lease amounts remain same, and the income increases over a period of time because the value of the land is rising, as well as the rentals of which you can generate from that particular land as an investment, it will increase. So companies also invest in that. So how they are trying to manage their particular balance sheets is how they can definitely do that. To buy the asset on lease, or say for a particular thing, they are putting their assets as a collateral, which is an immovable asset, and from that they are actually earning. So this is how they are actually doing it. An arbitrage opportunity through the use of tri-party collateral transactions. Let's do an example, friends. Let's do a live example of this. Purchasing and selling similar assets in different markets. Okay. Right, Kunal? Okay. So I am opening two windows in front of you, friends. Okay. And I'm putting similar stock. Okay. You name out any stock, friends, which is there. So shall we go ahead with maybe Sun Pharma was also there, but yes, not the MRF. Okay. So Sun Pharma being there, okay, and RRR is a very common stock here. So Sun Pharma MRF service NTPC is also there. And what's the price of an NTPC? 215.15. Let's understand with the help of an NTPC. And I'm also opening one more, this, and again I'm also writing it here, which is NTPC, National Thermal Power Corporation. So this is one window and this is another window. NSE, BSE. Basis the close prices, both the stock exchanges. 10 practical steps guide to collateral management. Our next subtopic is collateral management. Let's come a bit down. So friends, important for us is that is understanding the overall collateral management. That too, this PDF will definitely help you to understand it in a better way. So traditionally, financial institutions viewed collateral management not as necessity, but as something that had to be performed with a little concerns, a reactive function positions at the culmination of the trading cycle that did not require too much of the attention. For many years, collateral risk exchange function has been conceptually at least well understood in the financial market, albeit a process that was not a priority for firms pre-2000. But 2008 financial crisis and the years following had presented and drastic impact on the precision of the collateral management and importance of its operations. Unsurprisingly, regulatory changes have come in hand with the credit crisis to prevent a similar scenario developing again mandating the use of the collateral for virtual all market participants and penalizing anyone unable to comply. Okay, so this thing happened, or this thing became very important basis a subprime crisis which took place in 2008. Counterparty exposure, risk exchange through the use of collateral, and the legal risk, operational risk, liquidity, and correlation risk. These are the four different risks which got identified. So as we could see, many things are there in this 10-step guide. Let's go to step 1. So Sahil, let's go to step 1. So from this, we have come to know counterparties includes whom? Banks, broker, dealers, insurance companies, hedge funds, pension funds, asset managers, large corporations, all these. And collateral management is very simple. That is cash, security, or other instruments, such as bonds, equity, are passed related to from one counterparty to another for a security. Two parties trading financial instruments that gives rise to the future cash flows, such as OTC derivatives, which is over the counter, runs the risk that one of the parties to the trade may default on the future payments, leaving the non-defaulting party with a financial loss. On any given day, the party requires a post collateral to the other is determined by calculating the net present value of all cash flows for each open trade transactions. Net present value of all the cash flows. Okay. And we discuss collateral in terms of what? Variation margin and initial margin. Whilst both collateral they have served, and the variation margin and initial margins are already here. One is variation margin talks about, friends, which is in green circle, is mark to market margin, popularly known as MTM value of a particular portfolio. So mark to market, daily basis, what is the fluctuations which is happening? And if you are out of the money, the broker will ask. If you are in the money, then broker will not ask people. Broker will say that yes, you are rightly positioned. And there is initial margin also. Initial margin means a sum of money that could be conceivably lost over a defined period post a default. So the period is defined by regulations and differ from instrument from day 1 to day 2 or to 20 days or more. So what they say is initial margin. Initially, what you are supposed to pay, variation margin, which is known as the mark-to-market margin. So always keep one thing in mind. One is IM and one is MTM, which is also known as the variation margin. Take it forward. Standard OTC derivative collateral transaction between the two parties, and you could understand. So two parties negotiate and execute the credit support in excess, which is CSA, and this contains the terms and conditions which will collateralize. Which collateralization will take place in and is an annexee to the ISDA, which is International Swap Derivatives Association Master Agreement. This we have already discussed in yesterday's session. Okay, and second point is that is the trade subject to the collateral agreement are regularly mark-to-market margins, and their net variation is then agreed. So if there is something which is other than the variation which is there, how to deal with that particular margin or to that particular variation, that's something which will be agreed between the two parties. Take it forward.
Let's have a quick quiz question, guys. What does ISDA stands for? Your options are International Securities and Derivative Association, International Swap Dealer Association, International Stock and Derivatives Authority, or International Securities and Derivatives Alliance. Please mention your answers in the comment section.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
So when collateral management was first being introduced in 1980, and these are departments and many more, and operational treasury departments within various institutions and all other stuff and the risks. So G20 meet to discuss the response to the global financial crisis, and this would happen in the on the right hand side. So you know what is Of course, we have understood what is ISDA, but in the G20 meets also, these things also gets discussed because all those countries becomes the part of this discussion, which is related to the financial crisis and how to overcome, and how each and every country could help them to overcome this crisis. So, what type of firm needs to have function in place of collateralized trading? Virtually all firms that have access to the financial markets, either directly or indirectly, and are trading a financial instrument with a counterparty will need to have a system in place to facilitate the managing the collateral obligation. So any firm, friends, any firm which needs the collateralization, the obligation of the same thing which is there, so they are supposed to undergo, the collateralization management, and it is recommended. ISDA also plays a vital role. That's why we covered the same module before this particular module, and we have understood its importance, that how much it is important, which is not only applicable in one country. It is a master agreement which could be used everywhere across globe with some tweaks within that. Yeah. So I was just talking about this paragraph. The first paragraph, Sahil, just come a bit down. Overwhelming drive of the use of collateral is to provide security against the possibility of payment default by the opposing party in trade. ISDA 15, the report states credit risk exists whenever a firm has a relationship in which a counterparty has an obligation to make the payment or to deliveries in future, and there are a number of ways of addressing the credit risk arising from the derivative transactions, but the use of the collateral long been established as a effective mean of mitigation. And it is now customary that firms do not trade with counterparties without collateral. Yeah, so you could see, friends, so there are crises which happened. There was a complete list of the crises which happened in different countries also. What type of assets are eligible to be pledged as collateral? Okay, so cash as collateral has number of attractive traits. So you could see the second paragraph, and it is easy to value, and cash also exceptionally is easy to rehypothecate, and rehypothecate is a process whereby collateral received by one party is reused by them where they have collateral obligation with another counterpart. This is especially common for the OTC transactions. So if you have received a cash, that cash could also be used for another purpose that is known as rehypothecated. Okay, again, one more time hypothecated, and so on. So I found this document very informative and easy to understand, a 10-step thing, and hence I'm just sharing it with you. So what are the advantages of collateral management? And we could see that is mitigation of the most important is the mitigation of the credit risk. Definitely, all are theoretical part and so, right? So this is something related to the credit risk management, and how big the credit risk you will do not know. That yes, in the market risk and credit risk in the collateral. So without the collateral management, the things doesn't take place. Now take it forward. Yes, another advantage of the firm collateralization, their trade is providing them access to markets or counterparties that would otherwise be unreachable. Very good example. It provides you what? Complete exposure and protection against the markets in which you have taken exposure in different countries. The purpose of ISDA is also the same. That is to protect for credit risk, against credit risk. But how? This session related to ISDA and collateralization are interlinked with each other. So ISDA says that yes, I will help you get it protected. No counterparty risk. But how? Collateralization management. Correct? And validate. So last, the process of exchanging margins with counterparties often provide a method by which firms can validate their portfolios. This is how the thing. Challenge is implementing the collateralization. It's a new regulation. There could be a value related to that. There could be more complexities. Come a bit down, please. There are further risks which are involved related to operational and related to liquidity, legal, and there's a cost which is already involved. So no portfolio is managed or backed by a risk unless we have a thing which is related to, the cost which is attached. So even if your own assets are insured just by paying the insurance premium, it doesn't come at free. So collateralization is not collateralization management or collateralization across different countries. though it is costly and it is not so, you know, this it's not so system driven. So it could also happen that yes, two parties are there, but it is not something which is being recorded until less, it's a system driven thing, and which system to be followed by everyone across globe. Yesterday we also came to know there are 980 institutes which are doing well in ISDA, but those 980 institutes in different countries, there are many financial institutes across globe. Those could be a few, that particular number could be a few percentage or a specific very defined percentage. So how those softwares should be defined so that they would be able to find out that against which the collateralization is available or not. That's why there's a demand for a greater automation on the right hand side, which you could see. So SaaS is one of the software, that is software as a service solution that has out of the box connectivity to market infrastructures. On the right hand side, I'm just reading it out. So this is one of the way that things can take place, and collateralization management could become more transparent rather than only a management from one country point of view. Further, it say that the demand for an effective and yet affordable collateral management platform remains for many high priorities. Of course, there is a demand, but companies are not able to find it out. Countries are not able to find out how to optimally utilize it. Because, the only thing is that unless the markets are regulated, no system can come up with a solution which is country driven, unless it is something which is regulated. Means every transaction gets captured, every collateralized source of collateralization must also be captured for what particular purpose it is being given. So OTC market, there are things happening in times, but at a regulated or from the regulated market point of view, friends, these are not happening. So this thing should be regularized, or I would say should be automated, and we have reliable process, the knowledge workforce, and many more. So these are all theoretical, friends. So yeah, and the last set is a cloud margin and IHS market. So this is something which is actually marketing basis. This is that yes, how they can help bring to the automation of the collateralization. I'm just reading the first paragraph. Cloud margin and IHS market offers functionally rich, highly automated web-based collateral and margin management solutions that address inefficiencies within collateral management that the industry is currently facing. And they offer comprehensive end-to-end workflow solutions for collateral and trade life cycle, which addresses documentation, valuation, trade processing, and margin requirements. So things are getting automated. This is few platforms, but again, there are many more things which are making the market more inefficient rather than efficient. When I say efficient market, friends, efficient means that majority of the information, which is the right information, is available to be analyzed by everyone in the economy, and people in the economy perceive the information that how it should be, so that they are able to take a sound decision. For example, like I'm sure majority of you have come to know what is VAR today, rather than the calculation, but what is the meaning of VAR today? So there are key technical and legal developments which has taken place in 2003 Electronic Data Interchange EDI standard development to automate collateral transactions and communication. Same goes with 2003 ISDA collateral asset definitions, as well as enterprise-wide collateral management and Chinese market collateral glossary, which is also there. And 2008 major dealer in operations management group letters to the US Federal Reserves, and the major participating dealers agreed to a goal of weekly inter-dealer reconciliation of the collateralized portfolio with more than 5,000 trades, the provision adequate resources to the collateral management functions to identify and resolve differences, collect and report metrics to supervisors. Yeah, parties to collateral management. First party is CAT, which is known as Credit Analysis Team for sure, and they conduct investigations, conduct assessments, establish collateral specifications for both new and existing counterparties, and so on. And this often comprises a preliminary examination as well as the continuous regular examination of each counterparty's credit risk. So they are doing it regularly. That's why it is known as credit analysis team or so. Front, which is trading office and all, and these are known that traders may execute trades only with approved counterparties. Okay. Then comes the middle office, then comes the legal department, evaluation team, accounting and finance team, and so on, and collateral management team. And that is the third party service also, which provides a software provider, consultant, auditor, tax specialist, and tri-party also. Like the document which I shared with you. So that could be a third party who is providing you a software. Okay. This is of course the types of collateral could be related to product data related, as well as market data, legal agreement, client data positions, and many more. And here the collateral management, which talks about the contract steps, the credit risk. I know it's blur, but yes, you could just reading it out. And which is going to talk about things which are related to market risk, credit risk, and so on. Majority of the time, it is known as the credit risk, which needs to be managed using a collateral. Framework of collateral management would be cash, mortgage-backed securities, corporate bonds. So these are the things which helps us to do the collateral management. Managing backed, or it is backed by what collateral. And what is collateral management? It's a technique which guides the counterparty on the terms and aspects of the collateral transactions to be undertaken, and defines the granting, verifying, and advising policies for participants to lower counterparty defaults. And efficient collateral management includes the features which are mentioned, which is credit enhancement, risk management, capital adequacy, regulatory, operational, and so on. These are all theoretical, but yes, these things happens. These things takes place. So more than that, friends, what I believe is the right software, right platform must be there and must be regulated. Means backed by a regulatory authority which vouches for everything which is happening as a part of the collateral. Okay. And why it is there? So these are few reasons that must be related to credit risk, derivative exposures, and so on. And I'm just reading it too. Could be related to risk management also, that is reduction in portfolio risk, capital adequacy, and reduce operational risks. So the objective of collateral management must also be clear. It should not only address one thing, it should address many things, like just like all the checklists, right, friends? So all the checklists must be there to entertain the same part and to take it forward. So that was related to the why part of collateral management. Now the process of collateral management, MTM changes, as I shared with you, mark-to-market management. This is a very popular word in derivatives. So I guess someone mentioned that I trade in derivatives. So I guess this was sign, or we gain more experience by losing money, or when the moment we become serious about it. But let's understand it that yes, this is part and parcel of the stock markets. So top up required means that there is a more collateral which is required to cover the position. Okay. Notice and legal actions and process of collateral, it's part of the collateral management. So I'm sure this is all theoretical. I don't want to invest reading all the lines together, friends. This is something which is there with you all. Substitution in collateral management. So substitution, that is a borrowing party may wish to switch out one type of security for another. Consider using cash instead of a treasury bond, or corporate bond instead of a government debt. For example, the moment I went to the Muthoot Finance, they said that yes, now you can put this. I gave a gold and I took the money. This is a live case. After 6 months, I wanted to use that gold. In my family, there was a function, I wanted to use that. And they said that what else you could provide. I said, okay, this is something which I can also provide. So first they were very rigid in taking the cash. Okay, I'm giving you back, and yes, I'm ready to pay off everything. My need is over. So they said this, blah, blah, blah. So, okay, I took it again and I kept it again for 3 more months, in total 9 months. But against that particular gold, I gave them a different gold, but of the same value. So that was the same thing which happened. Collateral team will next consult the CSA for the advice on what constitutes a suitable substitute collateral, if it is covered, or it will make a decision based on the substitute collateral perceived value. And this enables the relationship flexibility and provisions for quality. And following the acceptance and the submission, it may be appropriately tracked in collateral management system, communicated to all the pertinent parties, including custodians, followed up by this. So since with thinking from the one customer point of view, it did not make any sort of a difference, but every customer is doing the same thing. It must be documented. You know, friends, the moment I gave them the gold, I don't know whether you have experience or not. They asked me to take a picture, and they also gave me that what I submitted with them, what was the value, what was the carat, and every other thing. They gave me the details, said what they have taken as a part of it. The moment I got it changed, again, it was being given to me as a proof that what I have submitted with them, so that I'll take that particular proof and would be able to get that thing back. Instead of writing just a gold or a boolean which is there. So they gave you complete thing that what you have given as a collateral. Substitution in a collateral management, these are all the steps. I mean, you may take time to read this out. Okay. And types of collateral management could be related to bi-party collateral agreements, could be rehypothecation, and tri-party collateral. What is bi-party? And it is very old form of collateral and without any involvement of the third party, like governing authority or custodian, and generally which is OTC between two parties, of course. Rehypothecation means allows trading the agreed collateral on exchange. So suppose you guys are Muthoot Finance, I have given you my gold to be with you. Can you put it on exchange? It allows to trading the agreed collateral on exchange. It means, can you trade it in the stock market? Possible? Not possible. This is not possible. Gold is not possible. For example, against the stocks which I have, say for example, I have a stock of say Tata Steel. I have put that same thing as a collateral with you. Okay. Can you trade those stocks in the stock market? Answer is yes, provided it comes under the type which is rehypothecation. You give me options. So it could be bi-party. It means you cannot just do anything about it. It could be rehypothecation, friends, that yes, you have a right to sell it out in the market. And whatever the gain or losses would again belongs to you, because I have already hypothecated it. It will not come back to me that my value is already fallen down. So generally done to free up funds, other funding requirements and all, and tri-party collateral agreement, which is a third party is involved. Of course, the third party serves as a middleman and facilitates the movement of payments. And it is a custodian bank which also serves as a lender safekeeper of the collaterals. I talked about the custodians yesterday. Two custodians in India. So there are many things which are interconnected. But what is the purpose of custodian? The purpose of custodian is to safekeep all the assets in its physical form. Physical form means in its paper form. Of course, not the house in a physical form, but the papers of the house in a physical form. Just like the lockers. So custodian is one party to talk about this security, this financial security, who is the final holder of this financial security, and we have the document, we have a proof that this document says. Right? So this is the role of the custodian.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Of M&A market. Of course, its M&A market is very large. Why companies do M&A? Why companies buy another companies? There are n number of factors, friends. One of the factors which I just mentioned or share with you is for sure the expansion. Two types of things. I guess Shrikant mentioned the same thing. That is, it could be horizontal, it could be vertical. What is the meaning of horizontal and vertical? For example, Tata Steels acquires another steel company. For example, Tata Steel acquired a Bhushan Steel company. It is an expansion of the existing capacity. This means that this is horizontal. Okay. And when I say Tata Steel acquires, say, another pharmaceutical company, I'm just taking an example, or say tire company, could be JK, could be C8 company, could be MRFL India. So that is known as vertical integration. It means in another vertical. So that's why they call it, we have vertical one, we have vertical two. Those are known as, could be the subsidiary companies also. So always understand what is the purpose of doing an M&A. Is it something to enhance the capacity, or is it something to increase one more vertical, which we are now going to look forward for? So this way, friends, we understand mergers and acquisitions from the concept point of view. So mergers and acquisitions activity in India between 15 to 19 has mainly been consistent with few highs and lows. And of course, more than 3,600 M&A transactions totaling more than $300 billion have taken place in India during this time. And 60% transactions, both in the terms of volume value, were in industries like industrial products, energy, telecom, media, and many more. So major impact is on these companies or these particular sectors itself, though it's a very huge market, and it is something which an investment bankers looks forward for. So if I'll help you write few words, please write down buy side and sell side. There are two sides in an M&A, specifically in investment banking also. Okay, so basis that there'll be a question. So accordingly, please write this down. So one is the buy side, another is the sell side. If you want to raise funds, there is a possibility that you can issue equity shares or you can issue bonds or debentures. Okay, this way you are doing what? Buying or selling. This way, friends, you are doing selling your stake to the shareholders. So while offering shares or the debt to the bondholders or to the market, that is known as a sell side. You're selling it. What you would do with that particular offering? You would try to invest in your own organization, in your own company for expansion, for marketing, for sales, for IT, for R&D, n number of things for different projects or so. So whatever you have generated as a money by selling it, what you will be doing? You will be putting it in different transactions. So for expansion, you will be doing what? M&A. It means you are going to buy different companies, right? Different companies, different projects or so. Job of an investment banker, as I said, heart of investment banking is to find out all those deals. You know, how those deals would get cracked to enhance the efficiency. As I shared an example related to Microsoft and LinkedIn. So Microsoft wanted to enhance their basis the number of people which are attached with the Microsoft and to reach out to all the companies, CEOs and everyone in just one go. It could be a cost-effective thing for them or it could be a costlier thing for them. But what they did is that rather than only the people, but people should also know them. So they understood that yes, there is an opportunity by a company on which people are professionally attached with each other. Okay. And there's a one platform where people are attached. Then they found out a LinkedIn is one of them and they bought it. And that's why their customer base increased like that. So no need to further market. They know that whom to reach out. And now this is also growing and this particular thing is also. So both the companies are renowned in the market. So that has given them a synergy effect. Okay. So M&A transactions could be specifically related to, as I shared with you, it could be a horizontal integration or could be a vertical integration. That is adding one vertical, two vertical or three vertical as the case may be, friends. In an investment banker do the hardcore research on that. And when I say hardcore research, what is the meaning of hardcore research? Hardcore research means that what to take care of it. So for example, in an investment banking, what you will be doing could be DCF research, could be relative valuation, fundamental valuation, relative valuation, both could work. So when I say fundamental valuation would come up in this particular form, that fundamentally how good you are using the discounted cash flow model. And when I say discounted cash flow model, it means it's related to predictions and many more. So either an investment research or could be a relative valuation. Relative valuation example, which is related to enterprise value calculation, which we did in one of the session. If not, we'll be doing it one more time today, so that you would be able to help yourself understand that what is the meaning of relative valuation, calculating enterprise value, and couple of things, and the multiples related to that. So the job of an investment banker is to do the screening first. Screening means which companies and where. If I ask you a simple question, you want to buy a new house, and for example, everyone wants to buy a new house. This is open-ended statement. And when I say open-ended statement means, where to buy, what is the budget, at what price, what will be the size of the house, so specific location, floor, many more things will start coming up to help me to understand what to research for you or what to specifically search for you. So that is known as screening. So screen out all those things in one go specifically. Okay. So screening is one of the steps in finding out the right companies. So again, in the world, one of the biggest transaction was Walmart USD $16 billion purchase of Flipkart in 18, followed by a Russian consortium led by Rosneft's USD $13 billion purchase of SR Oil in 17, and Adani Transmission's USD $3 billion and purchase of Reliance Infrastructure's integrated Mumbai power distribution business in 18. So these are one of the biggest transactions which took place, friends. So what to do to expand the business, and which is on day-to-day in demand, so that it will help you circulate the money day-to-day, followed by from where to raise the funds. So whole investment banking, which is buy side and sell side. Buy side means doing an extensive research on the companies which you want to buy in the future, and so on. So the main goal of government reforms agendas and policies were to promote foreign investments, and of course, and the new bankruptcy law, government initiatives to expedite the clearance as per the part of the push to make doing business in India easier, and losing of the foreign direct investments restrictions, loosening the foreign direct means smoothing it down, and restrictions all contributed to an increase in the M&A activities. So there are two things. One is known as FII and one is known as FDI. So there are differences between these two. So whenever I say investing in a project directly, means you are directly investing in one or the other project. The project is going on, airport building is going on, and airport doesn't have, I repeat, airport doesn't have the stocks or the bonds which are being issued to raise the funds. That is known as directly investing. For example, you are the owner of the airport, suppose, and say ABC Airport Company, or a construction company, you are building that thing. Now, at the end of the day, right? So you need to also take care of the same thing in this particular fashion, right? Just a second. Yes, what is the difference between the FDI as well as FII? And when I say difference between FDI and FII, FDI invests directly in the project because they do not get a route to invest through stock market. But also, if the company is also listed, then an FII could also take place. FII stands for foreign institutional investors. So when I say institutional investors, friends, institutional investors means that these are hedge funds, these are insurance companies, banks, any other financial institute could be, which has lot much of funds. On the other hand, when the funds are already there, it is now the opportunity with the company, or that financial institute to to invest largely at a bigger amount, or maybe and take a significant stake in the other company. So FII and FDIs, two different things. Companies, or I would say in India, so we promote more towards FDI also, because we should be able to attract more direct investments once the investments are there, and so on. Like for example, the classic example is metros. The elevated metro rail construction, or could be underground also. the construction of all the metro lines and every other thing. So that is known as what FDI. DMRC doesn't. So, for example, Delhi Metro Rail Corporation doesn't have any stocks or bonds to be listed or so. So, how to raise funds? Other companies, other countries can invest heavily on this particular project, and we give them some returns on that. So, this is known as an FDI. FII means, for example, if Adani Port, there is a stock for the same thing, and they can directly invest good amount in that particular company's stocks or the bonds or through the bonds itself. So those two differences are there. Okay. So, however, India started seeing a slump in deal making in the third quarters and so on. And inter alia, the US-China traders war and Brexit, the situation in the Hong Kong and the drone strike on the Saudi Arabia oil facilities had indicated a dawning recession. So these are the things which actually takes place, everywhere where the things are in line or not in line, and some things which are not as in the control of the companies. So, business law, which is also known as mercantile law. Both companies acts, CA 2013, which is Company Act 2013, and the Income Tax Act 1961, which is also, I'll just put it a bit down here. Yeah, Income Tax Act, and do not define them the term mergers. So, merger is a concept of combining two or more entities into one with the goal of creating a single rather than just accumulating the assets and liabilities of the individual companies. Okay, and mergers may be done for a variety of reasons, including economies of scale, purchase of technologies, access to a wide range of markets and industries, etc. Normally, in a merger, the merging entity would merge into a single surviving entity and ceases to exist. Like an example of a salt and a water, which I just shared with you. So that's why it is merged. It's dissolved in the same thing. Correct? So could be related to economies of scale, technology, and access to a wide range of market. So Tata Motors and the JLR merger of these two reasons. Like purchase of a technology, Tata Motors purchased the technology for what particular purpose? For passenger vehicles, not for commercial vehicles. They are already good in commercial vehicles. Of course, they use this technology for passenger and commercial both, but they wanted to cater the passenger vehicle market. So, and they wanted to give a competition to those particular things too. So this is the reason, friends, that yes, Tata Motors acquired, as well as they use the technology, wide range of markets and industries. When I say wide range of market, different markets. So when they acquire JLR is a popular brand across globe rather than only in India. So in India, it was not so popular. Plus the cost effective thing. They started manufacture the same thing in India and then selling it out. Earlier, one car used to come around, including an import duty starting from 1.1 or 1.2 CR. Currently, those cars starts around 50 to 60 lakhs on road. And whenever they are manufacturing it, their cost is reduced. The quality is not being compromised, of course, and then they are selling it out also. In 4 years, they changed the company JLR, which was a loss-making company, to a profit-making company across globe in 2022 itself. Normally, in a merger, the merging entity would merge into a single survivor. So, there is always a good concept in a merger, friends, that when you are encashing the name, when to dissolve the name also, that's something which is also important. Or you keep it acquired. Don't completely merge it. Difference. Please understand this, right? Suppose you have acquired one company, 100% stake. So I am, suppose, Jaguar Land Rover. You are Tata Motors. There could be a possibility. Yeah. There could be a possibility that I am, Royal Enfield, and you are Eicher. Jaguar Land Rover and Royal Enfield both are brand names, not only present in India but across. Suppose you have acquired these companies. Now, if you merge it and put your own name to that, what do you think? Will you get some good sales out of it? If you have merged it, would you be able to get good sales out of it just by naming it? Like there's a bike by Eicher Motors, and those international cars are also known as Tata Motors car, or maybe in front of the JLR cars, the Tata Motor logo is written. Would you be able to encash that name or the market? Yes or no? The brand name, how people are perceiving you, that matters a lot. how people are perceiving. So when I say the brand name matters, it is something which is so vital, across. So let's have a look at it. And these brand names works like anything. Same goes with Microsoft LinkedIn, the example which we started with. So merger provisions, section 230 to 234 of company that deals with the agreement of the agreement or compromises between a firm, so its shareholder or its creditors. And commercially speaking, depending on the needs of merging organization, mergers and amalgamations can take many different forms. And also the corporate law may not give much consideration to the various business mergers and amalgamation form the Competition Act 2002 does. So how to be more genuine in the competition, that's something which also works and being vital across. So let's have a look at it, some merging strategies and horizontal merger and vertical mergers and couple of more things which we can. Okay. Horizontal occurs between organization engaged in rival businesses that are at the same state of the industrial process. So by eliminating a rival and bolstering its market position, a horizontal merger moves a business one step closer to the monopoly. Very good example. So there are companies which are highly competitive in the telecom industry. Could you please just name out 3 telecom companies in India, telecom service provider? IDEA become a big player, one of the big player in the market. IDEA got acquired by Vodafone. Vodafone is not an Indian company. So all the things, so these 3 are still existing and their things are working. So for example, if Airtel acquires Vodafone IDEA, I'm just assuming, if Airtel acquires that, then there will be 2 players which will be there, which is Airtel as well as which is Bharti Airtel and as well as the Jio. But these companies, or I would say, since how long this Jio is existing? It actually came on 5th September 2017. They launched their first. It was a launch date of that. So friends, we understand these things. That yes, initially 3 years they provided a service absolutely free of cost, and Jio is not only into the mobile service but also in the broadband. Both the services they are actually trying to provide. So let's have a look at it. The advantage of economies of scales and economies of scope are some additional advantages of this type of merger, and Competition Commission of the India CCA closely examines these types of the mergers, and very good. So another example of a soft drink, help yourself. Coca-Cola and Pepsi beverage division merges is a perfect example of horizontal merger. Only their beverage division, not the other one. Okay, so now they do things in a better way as well as combined together. So of course there's always a heat which is there, but yes, now they are helping themselves to popularize it further. Like Lay's is which company's product? Is a product of PepsiCo. Correct. So PepsiCo has different verticals, beverage business, the Lay's, and many more. You can also check their website and find out. Now the next is the vertical merger across, as I shared with you. So across production lines, as I shared with you an example, what is a vertical merger? Like for example, Tata Steels, or I would say Tata Motors acquired a tire manufacturing company. Could be MRF, could be anything else. So this way you can understand that what is a vertical merger itself. So vertical mergers are joining two organizations that are in various phases of the same industrial or production process. And vertical integration would result, for instance, from the combination of construction company with a company that produces steel or the bricks. The same case. So a company, for example, in case of I would say, the Coke and Pepsi, they are into making of that soda drink. Suppose they come into manufacturing of bottle. So they are coming to bottle manufacturing. Could be plastic, could be this glass. Okay. So now their more vertical will be there, but which is related to their overall business. So that's why they try to get or encash again different vertical, but accordingly keeping one thing in mind. This is whole part of the 360-degree business. Simultaneously, we'll be providing the economies of scale and so on. Example, Z Media, Dish TV. Because of lower transaction cost and synchronization of the supply and demand, businesses stands to win. And additionally, vertical integration enables a business to develop greater autonomy and self-sufficiency. Important is what? Greater autonomy and self-sufficient. So we are self-sufficient. We are not dependent on it. So again, the example of a Tata Motors or example of a Coke and Pepsi, they become more self-dependent or self-sufficient, that we are not again dependent on the bottling business. It's something which is owned by us. We know how to make that soda related drink, as well as we know how, or could be packaging. In case of a Lay's, there is a packaging. So they are more interested in also taking care of the same thing that will known as the vertical business altogether.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Okay. Mergers of equal. A mergers of equal take place when two businesses that are nearly same size come together to form new business, as name implies. So same size, and so two businesses comes together, forms a new business as it implies, and shareholders from both firms receive shares in newly formed company in return for the shares they previously held in two companies, and that they made the merger after the merger is complete. Okay. Finding out merger of equals. Okay, before I go to this or before I tell more details about it, when we do the screening of the companies, when I say screening, friends, it means identifying all the companies in which we will be investing. Identifying all the companies in which we will be investing. All the companies means this is the whole globe. We will be shortlisting and finding out. And how the shortlisting takes place? It takes place with the help of paid databases. So if you do a Google research or so, you won't be able to find out all the companies which could be your target companies. Right, friends? So when I say screening of the companies, screening takes place with the help of the right database companies. Database companies or databases, I'm sure, have you ever heard about word namely Bloomberg? In case of doing the merger and acquisition screening, the screening takes place with the help of the paid sources where you will get the whole globe data. So when we do the screening of the companies, then clients also tells us, Gaurav, that yes, we want to invest in a company which is situated in APEC region and in IT industry or in a telecom. With one thing, the sales must be between $10 million to say $1,000 million. I would say $100 million to say $500 million. $10 million is smaller. So $100 million to $500 million of sales are, and this helps us to fine tune or to screen them. So we'll be able to find out all the companies which are already there, and similar transactions, Gaurav, also find it out, which has already taken place in last 3 years. So this way we used to take place. Okay, so this how the thing would take place, and so on. So Chrysler and Mercedes merger. So a belief is that the firm manages and unwilling to keep their own power, and even if it means creating a company for shareholders that is nearly twice as large as the current company. So for a deal to happen, one company's CEO is almost certainly going to have to give up his or her position, or CEO or co-CEOs, like one Goldman Sachs has had and are uncommon, and are suddenly the deal doesn't seem so equal anymore. If this barrier can be overcome, it's important to look. Sorry, it's important to look at the valuation. So what they are saying is that if two companies merge together which are of the equal values. So for example, I'm company one and you all are company two. I merge your company with my company. Both are almost equivalent. So suppose assume that you all are the CEO of the company individually. Okay, I'm also the CEO of my own company. So the glitch comes that who should be the final CEO of the company, because we both are competitive enough to take decisions and to run the show. In that case, a co-CEO position could also be created. And some companies do that as something which is equivalent because we have given them the same powers. So if I'm not available, you are there. If you are not available, then I have the power. So even in the law, this is something which is being decided that will not step in each other's shoes unless it is being decided. And yes, we would be able to take decisions on each other's behalf. So co-CEO concept is there, but it's in something which must be rightly discussed and managed. Correct? Okay. Then we have merger strategies which are related to conglomerate mergers. Conglomerate mergers is the union of two organizations from unrelated industries and utilizing financial resources, increasing debt capacity, increasing the value of outstanding shares, so higher leverage and earning per share, and decreasing the average cost of capital are the main drivers of conglomerate mergers. Conglomerate means two or more companies combined together, utilizing what? Financial resources, increasing debt capacity, increasing value of outstanding shares through leverage, and many more things which are a part of it. And the main drivers of the conglomerate, these are the main drivers of the conglomerate mergers, and of course, the average cost of capital. Can someone tell me what is the cost of the capital, friends? I think so. We have discussed good on the same. It is popularly known as WACC, which is cost of capital. WACC, weighted average cost of capital. So if two companies, or I would say two companies, one company go ahead with the different sources of capital, that is, for example, equity and debt combined together. So suppose equity has a cost of say 12%, and debt has a cost of say 7%. I'm just assuming. Weights are say 0.6 and 0.4. Weights means, I'll just share with you, total capital equals to say 1000 million, out of which through equity it is raised as 600 and through debt it is raised as say 400. I'm sure now the things are clear to you. So what is the difference between equity and debt? So what is the cost of capital here, or a weighted average cost of capital? Conglomerate helps us to do that. Conglomerate helps us to reduce the overall cost, decreasing average cost of capital. So one company has a weighted average cost of capital which is coming at 10%. Another company has 8%. Okay. So as per their equities and debts weightages, this thing would also get managed better. So if other company is less on equity and heavy on debt, so the overall cost of capital would come down because the debt comes with a comparatively lower cost. So friends, understand the same thing, how these things takes place, and what is the meaning of the conglomerate and the merger related to that. So a merger with an unrelated business also helps the company to foray into diverse businesses without having to incur the large startup cost normally associated with new businesses. Okay, thank you. Conglomerate merger, GENNBC. The right conditions typically leading to a conglomerate mergers are desire of newly merged companies to continue to operate independently as decentralized subsidiary, and Diversification opportunity with no significant antitrust issues, strong financial position of the large companies in the business combination, high potential growth rate in an industry or significant cash generation, and talent expertises, intellectual property, including patent synergies. Conglomerate means two or more companies comes together, gets merged. Okay, you get the benefit of different companies. Their decentralization strategies would definitely come up. Diversification opportunities with no significant antitrust issues and so on. And what is the effect when I say synergy effect? The synergy effect means that, friends, we popularly use two words in a synergy, and those two words are accretion and dilution. I'm assuming, that the number of shares which are being there for the company which is being acquired, now those number of shares are same. So you can take good assumptions, no problem. It's okay to be. So for example, I'm company B, you're company A, and hence the things are. So now the combined EPS would be how much? Which is 1600 by this is coming out to be 5.33. Okay. So EPS of company A, which is acquired company, which is an acquisition company, equals to 5, I guess. Yes. Okay. EPS of company A equals to 5, and combined EPS is equal to 5.33. Correct. If the EPS after combination increases, that is known as accretion. If EPS after acquisition reduces, it is known as dilution. Okay. Companies looks forward for what? Increase in an EPS, which is accretion, which is known as the final synergy effect. So there's a complete leverage buyout model or an LBO model which takes place, which talks about these things, which talks about these EPSs and so on. Accretion and dilution. So there's a complete financial model which actually takes place, friends. Always keep one thing in mind, that what is the purpose of this? What is the purpose of this calculation? What we are understanding from, what we are gaining from? We are gaining that yes, EPS must be equal to or more than the acquired company EPS. So an acquisition or takeover is the purchase by one person of controlling interest in the capital or of all the substantially all the assets or liabilities of the target company. So as we know, target company, one company, another company. So acquisition, acquirer company, of course, Microsoft, target company is another, that is a LinkedIn and so on. Takeover may be friendly or hostile and may be structured either by way of agreement between the offer and the majority shareholders, or purchase of a share from open market, or by making an offer for acquisition of the target shares to the entire body of the shareholders. Different types of takeovers means it could be related to management buyout, could be related to leverage buyout, it could be related to the complete company acquisition, it could be hostile, it could be friendly. So generally that there are friendly takeovers, not an hostile takeovers. Means those are not forced takeovers. That definitely, if the company has given debt to another company, then another company will not hostile takeover until and unless it is allowed as per the terms. But generally hostile takeovers are not appreciated. So friendly takeovers are there for sure as per the deals which gets negotiated. So acquisition may also be made by way of acquisition of the shares of the target or acquisition of the assets and liabilities of the target company. So it could be a financial acquisition or a strategic acquisition. When I say financial, there could be some acquisition of the assets. Could be one plant I have acquired, not the whole business I have acquired. So like Tata Steel got an opportunity to acquire the complete business of Bhushan Steel in 2018. That's a live example I'm sharing with you. So at that time I was part of the Tata Steel also, so I knew that inside and out of the things. So they started the same thing in 2016, completed in 2018, and followed by in 2021 everything got finished. So the whole process got started in 18 finally. So Bhushan Steel has or had their plants in different locations. Excuse me. So one is in Sahibabad, which is just near to the Ghaziabad NCR of Delhi. Another is in Angul, which is in Orissa, and one more is on Mumbai Pune highway. In between to that, that's known as Khopoli. So the places are like that. So it was being given them an offer. If you want to expand, you can take one plant, one by one plant in next five years, like that, five years span. Or another thing could be that yes, if being given an opportunity, you can also buy the complete business. So Tata Steel took a call and understood their business and visited their plants itself, so that they would be able to take care and increase the capacity just by it. So they asked the Bhushan Steel that what you would like to go ahead with, whether you want to go ahead with a complete acquisition and selling the whole plant, or means a complete business, or you want to sell only a specific one. So it was depending on the deal itself. Tata Steel wanted to expand its capacity, and next 2 years they increased the capacity by 5.8 million tons just by acquiring all the different plants in the 3 different locations. So now Bhushan Steel doesn't exist. Tata Steel exists. It was earlier being named as Tata Steel Bhushan Steel. Hence, strategically they enhanced it and so on. And it was accretion rather than dilution. And accretion, as I just shared with you in the previous part of the session. So it has given that particular edge to the company itself. And in 2022, or I would say that 2022 was the best year of Tata Steel's financial health point of view. Comparatively lower debt, a majority of the debt was being paid through the earnings, the highest EBITDA ever, and it has performed so great that their immediate competitors were also now at the backstage. So 2022 was one of the dream year for Tata Steel. Not basis completion of Bhushan Steel acquisition, but smoothly completion, increase in the capacity, all profits put together, shown as a synergy effect. Many more things were there as per the part of the organization structure. So in the latter case, the entire business of the target may be acquired on an ongoing concern basis, or certain assets and liabilities may be checked, picked and purchased by the acquirer. So it is possible that, friends, I can just pick the cherry from the cake at the top of it, and definitely this is the most attractive thing, let me just buy it. Okay, so that's the way also the companies can also take care of the businesses, followed by a transfer. When a business is acquired on an ongoing basis is referred to as slump sale under the ITA section 2 subsection 42C of the ITA defines slump sales as the transfer of one or more undertaking as a result of the sale for a slump sale consideration without values being assigned to the individual assets and liabilities in such sales. So this how the things are taking place in this particular fashion. So more than an act or a law, it's important to understand these examples of acquisitions. Let's have a look at it. Examples of acquisition. MPL, which is Mobile Premier League, which is Gaming Monk. Cure Fit, Fraternity. And then we have Flipkart, Lenskart acquired what? Flipkart. These are and Scapic. So these are also the companies of this. So we could see that yes, how they are trying to build the business, enhance the business, and so on, taking care of the business in a better way. Acquisition. As I shared with you, friends, in case of an acquisition, the company which is target company still exists. So Flipkart still exists? Yes, it does. Fraternity, definitely it does. And Gaming Monk, of course. But these are whose companies? These are companies of the parent company itself, as the case may be.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, This course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Then now it comes, that is so why and how we do the valuation. So we do the comparable company analysis, which we popularly call it CCA. In the beginning of the session, or I would just say, the few modules in the beginning, we talked about the comparison of the fruits. You all remember, right? Can apple be compared with watermelon? Answer is no. It's just not like that they are fruits. Can apple be compared with an orange? Again, not, because of the different tastes. Apple should be compared with apple. So it is just like to like comparison. And when I say like to like comparison, that's the concept known as what? Comparable company analysis, CCA. Now, so the term comparable company analysis, or comps for short, refers to the way of valuing the business that looks at the ratio of others comparable public companies, uses those ratios to determine the worth of the different company. So those ratios must be comparable with each other. Correct. So it is not only the ratios which are just gross profit margin, net profit margins, and so on. There's a different ratio comes up together, and let's give ourselves an opportunity. You can also open an Excel sheet, which will be, of course, a good idea to go ahead. But also, if you would like to go ahead with the example, which I'll put it in the chat box, it will be highly preferred that you perform. So let's have a look at it. One example, which is related to enterprise value. This way, we can help ourselves to get the EV. So I'm just putting it through. Market cap 1,000 million. Okay, let me just put it through and let me just write EV directly. Don't worry. Let me just put it through and let me just write the EV directly. Friends, have a look at it. I'm sure you know the formula right now. So EV, the value of an EV is coming out to be, say, $5,000 million. It is an economic value, as we know. It is the value of a business today. Okay. There are many calculations which also takes place, which actually impacts the value. So enterprise value is also known as the economic value, which is $5,000 million. Followed by this, if I want to do a comparison, when that is an apple to apple comparison, friends, what I need to take care of, let it be a right ratio. So this number doesn't give me an answer. What gives me an answer? That is a right ratio gives me an answer. So if I'll give you sales, say $1,000 million, in that case, EV by sales will be equal to how much? 5 times, or we generally write it 5x. We popularly write it like that, which we call it 5 times. Okay. So EV by sales is 5 for your respective company. Industry, 4x. So we have generated 5 times of the sales basis our enterprise value. On an average in industry, it is 4. There could be some companies which are higher than me. There are many companies which are lower than me. Industry averages, and in average, my number is also included. So how we perceive? So companies are perceived basis these ratios. So when I say these ratios, friends, higher this ratio is good for the company in comparison to the industry average, not with respect to one company. Because if you do one company, you will be able to figure it out. With one company, it is higher, with another company, it is lower. How you've been able to take a decision? Decision taking takes place, or decision making takes place with the help of the average of the industry, and followed by, if you want to go ahead with comparing one company with another, like for example, Tata Steel should be compared with the JSW Steels, then their respective ratios to be taken care, followed by the industry also. Again, you do the industry analysis. So when it is comparable company analysis, this is heart of investment banking, friends, which I'm just sharing with you. When it is comparable company analysis, an analyst makes sure that he is doing or comparing the right companies. It means it is comparing all those companies which are in the same industry and which can be compared for the apple to apple comparison only. Could be of the similar size, could be of the higher or the lower size. So for example, there are 1600 plus steel companies in India. First of all of them are not listed. cannot be compared, and only those companies to be compared which are in top 50 to be compared with top 50 companies itself. Are you with me? Could be JSW Steel, SR Steel, could be SAIL, could be Tata Steel also. So these are top 50, correct? And another or next 50 to be compared with them, or the remaining companies to be compared. So steel industry to be compared in one go, it is just a call which an analyst actually takes, that in which big company or a small company you are actually investing. So let's have a look at it and let's take it forward. Comparable company analysis. Steps in performing the comparable company analysis. First, select the appropriate comparable business. That is first and the most challenging or arbitrary step is going the ratio analysis of the publicly traded corporation. This is one. And analysts should search up the firms they are trying to value on what? Capital IQ or Bloomberg as soon as possible to gain through the description and the company sector categorization. So when I say, friends, Tata Steels to be compared with, SAIL, which is Steel Authority of India, it is not to be compared. You'll be saying, Gaurav, these two are listed companies. These two have the same business altogether, and couple of more things. But still, I would say that it is not to be. You know why, friends? Good reasons. First of all, Tata Steels manufactures products which are into B2B, B2C both, but they take care of the things which targets to the automobile sector. They are into flat products, long products. What is B2B, B2C, friends? First of all, B2B stands for business to business. B2C stands for business to customer. Okay. Business to business means you're selling the things, products directly to their businesses and making a deal, means in the bulk sale. Business to customer means that whatever you are producing, it is going to the final consumer, final customer. Okay. So for example, if they are manufacturing some doors, which are steel and aluminum combined doors, then it is something which I can consume and you all can consume. That is known as B2C. But if they are manufacturing steel, which will be used, or steel sheets, which is known as the flat products, so long products need flat products. Okay. So those steel sheets are to be used by automobile companies, of course, to manufacture of their cars also. So they are into this business. So business comes with a different cyclical things. So SAIL is into understanding the governmental projects needs, where in many of the government projects, the construction project for sure, the steel would be used. So highly possibility that those, or the company SAIL, which is a public company, it means on which the companies, the government and has already invested in. Okay, so that will be highly preferred. Not Tata Steel. I'm not discounting Tata Steel for sure, but not. So though they are into the same industry, friends, their businesses or their target customers are different. So who is also doing the similar sort of business related to Tata Steel? That is none other than JSW Steel. So for me, the competition would be to take care of the companies which are into similar businesses, same industries, similar business, almost similar clients. And then I take it forward and take a decision. So Bloomberg and Capital IQ helps me to find out those companies, screen out those companies. So we do it on paid softwares which are there in the companies. So Capital IQ, Bloomberg, FactSet, Factiva, we do the same thing. We uses them and screen out the companies and then find out and share the answers. Following steps to search for one of those database for the businesses that are involved in the same sector and have comparable traits. Okay. And the match should be as close as possible for sure. So let's take it forward. Steps in performing comparable analysis. Again, the first step, appropriate comparable businesses. The analyst will run a screen based on the criteria that includes industry classification, for sure, geography, size, that's revenue, assets, employees. So majority of the tasks comes up, friends. Majority of the things comes up. So one fine day, maybe I could also show you the screenshots of the scene, that yes, how a Bloomberg or a FactSet or a Factiva or a Capital IQ looks like. Okay. And then we have a growth rate, we have the margins and the profitability. So these are the things which actually takes place, friends. Classification, industry classification. What is to be taken care in that? Which geography? When I say geography, could be Asia Pacific, could be APEC, EMEA. What do we understand by the EMEA? Europe, Middle East, and Africa. Could be US region, which is North and South. Could be Canadian region. So they need to identify in which one. When I say revenue size, could be 100 million to 500 millions, assets, employees, and so on. So those we put those filters into. The next would be that is gather information. That is, it's time to obtain their financial information once, and you have identified in the list of the organization you believe are most pertinent to the businesses you are trying to assess. And one more, that is, you will be likely to use Bloomberg Terminal or a Capital IQ book, for which to make it simple and import financial data into Excel. So once we go to the particular platforms, we click on that information, and that information gets fine-tuned and comes down. That's the job. Steps in performing, again, that is step 2. Gather information depending on the industry, the company's stages in the business life cycle, and the information you need will vary greatly. And likely metrics, that is EBITDA, EPS, are important to mature enterprises, but gross profit or revenue may be important for the startups. So what is EBITDA, friends? Anyone? 2023. I guess here is a profit before exceptional taxes, which is here, which is 18121. And we have finance cost, which is this 6298. We have D&A, which is 9335. So friends, basis this information. So other than the calculation, understand it. So basis this information, we have found out there are two different PEs. One is coming out to be 16 and something, and this. So PE means what? PE means that how much price people are ready to pay to buy that company share, basis how much company is earning per share. So earning per share, for example, is coming out to be 7.17 rupee. This is per share earning, and people are perceiving that the price must be around 111.17. So like that. So people are ready to pay you 16.3 times or 16 times. In case of JSW, people are. We perceive in this way that to earn 7 rupees 17 paisa every year, we have to wait for 16 odd years if the earning would remain same. Or people are ready to pay us the 16 times. Higher this is very good, but over than that, sometimes either the company is overvalued or sometimes the company is undervalued. The standard range is, I'll share it with you. The standard PE range is 5 to 15 times. More than 15, the company is slightly overvalued or highly overvalued. In case of JSW, you can just also think of, see, it is a good ratio. Higher the number is good, but how many people would be ready to pay you? And people are still paying. So from the finance point of view, from the investment point of view, investment means, when I say investment means from the investor point of view, who invest long term. For him, this ratio is bigger, larger. But for a day trader point of view, this ratio doesn't mean anything. They say that yes, we want to gain from the fall and rise of the markets. So though the ratio is good, even their EV by EBITDA margin was also very good, which was around 12 times. Okay, Tata Steels is this. So it is a growing company. JSW is a growing company in a steel industry, and henceforward. But how much we are valuing, whether it is overvalued in terms of couple of ratios or so. So one ratio doesn't define anything. That's why we use multiple of ratios, or we generally popularly call them multiples, which are being used for relative company valuations. There's a fundamental valuation also, which talks about a DCF valuations. So let's have a look at it and take it forward. So here also, it's saying the same. The metrics, like, depending on the industry and the company stage in the business life cycle, the information you need will vary greatly. And like metric like EBITDA, EPS are important for mature enterprises, but not for growth companies. You can manually acquire this information from annual and quarterly reports. If you don't have access, then you can have the sophisticated information like from Bloomberg and Capital IQ. So we have helped ourselves to download this financial statements and the calculations. Create comp table. You need to create a comp table. You need to build now a table in Excel that all the pertinent data about the business you plan to analyze. Following key details are included in the study of the comparable companies, like company name, share price, market capitalization, net debt, enterprise value, revenue, EBITDA, and EPS. So one table must be there. So we need to create one table in an Excel, which would talk about the company name, prices, and all of this stuff, and followed by the name of the companies which are part of in the specific industry itself. Okay. And analytics estimate could also be if it is required. Followed by this step 4, that is the comparable ratios. With the combination of historical financials and analyst estimates of populate in the comp table, it's time to start calculating the base ratios using the valuation. And the main ratios would include in comparable company analysis could be EV by revenue, gross profit, EBITDA, PE. NAV stands for net asset value, and PB, which is price to book value. Okay, so PB, you may also write it down. What is the meaning of this? It is price to book value. So if the market value is not available, we can use the book value also. If the market value is very under or very low, then we can again use the same thing. Okay. So P by B ratio is known as price to book. Always keep in mind, friends, higher these ratio is good for the company. There is no ratio if lower is good for the company. One of the ratio is debt equity ratio, but that is part of ratio analysis. This is not part of the comparable ratio analysis. Okay. So debt equity ratio, lower is good for the company. Lower the debt is good for the company, but higher these ratios is always good for the company, friends. Okay. Let's have a look at it. What the other step says and so on. To determine the worth of the company in the issue, use the multiples from the comparable companies, analyze from the use of sales, gross profit, EBITDA, net income, or other measures they presented in the comparable table, along with the average or median multiples of the comparable companies. So either we calculate the average or the median multiples using the formula, which is either the median or an average as the case. In order to come up with a meaningful average, they often remove or exclude outliers and continuously massage the numbers until this seems relevant and realistic. So, we popularly call it, that is, adjustments related to exceptional items. So note 48 says income recognized amounting 256 crores in relation to the compensation received and receivable in accordance with the provisions of the Coal Mines Special Provisions Act 2015 against the subsidiary claim pertinent to expenditure incurred on deallocated coal mine at this. So this is something which they have received. Income is recognized. Okay. Exceptional item for this, which is impairment provision 710 crores recorded towards the value of the property this, and hence the other values. So impairment provision, which is for the construction work in progress, 31 crores. So I know these terms are quite new to you, but this is something which is an exceptional, means it happened only in this year. If this exceptional item or an expense related to exceptional item, which is 591, would have not been there, don't you think so? There'll be better, since this is profit before tax, which is 5655. It is earlier, which is 5065, and if I subtract, we will get one particular number itself. We can see basis an exceptional item, how the numbers could increase or decrease. So at the end of the day, if exceptional item is higher, I would say, gain on sale of the assets. The company is not in the business of buying and selling the assets. There could be some gain or loss. Hence, this is not a regular business part. That's why we need to complete that particular thing. Okay, we need to understand what is so important. We need to understand that without the exceptional items, where the company actually stands, right? So excluding the outliers. Outliers means basis exceptional item if some numbers are higher or lower, and so on. So PE, like in case of a PE which we calculated for JSWC, it is very high. Sometimes it could be negative also. Can PE be negative? Answer is no. I'll just tell you why. And in which form the PE would be negative. If suppose EPS is negative, can PE be negative? Suppose EPS is coming out to be this much. I'll just write it in the chat. Have a look at it. Current market price is say 100 and EPS is coming out to be minus 20. Is it possible? Definitely possible. What would be the PE in this case? So friends, the PE in this case would be 100 over minus 20. It will be minus 5x. What does this mean? Are people supposed to take back 5 times of the earning? If this is 5 positive, it means, if this is 5 positive, it means people are ready to pay us 5 times of the earnings. But if it is negative 5, what does this mean, friends? Does it mean that people are ready to take back? Answer is no. In this case, friends, if PE is negative, means it is not meaningful. We popularly call it NM. If PE is negative, it means it is not meaningful. It has no meaning. Okay. Hence, it becomes what? An outlier. Could be this side or that side. Are you with me, friends? So while preparing the complete chart, we need to take care of these parameters in detail. Fifth part is done, interpreting the results. It's time to begin evaluating the data once calculations are finished and comparison table is complete. Finding organizations that are overvalued or undervalued is one of the approach to use the data. Comps can help to find the prospects, but they do not take into account any qualitative factors. The finding need to be carefully understood for sure. And you must comprehend why numbers are what they are in order to correctly evaluate the data in the comparison table. Okay. And why does company A trade with company B at lower EV by EBITDA multiple and so on? Is it a good time to buy because it's undervalued? So we need to also take care of these things, friends. Okay, yeah. And a couple of more things, or is it because it requires greater capital expenditure and has far? So there are many reasons, friends, which can help us to understand it. An application of CCA, that is comps, or similar company analysis or market multiplier, have a wide range of applications which are typically carried out by the financial analyst and so on. Typically carried out by financial analysts and associates. So after this multiples gets calculated, these things gets. So initial public offering, follow-on public offering, M&A advisory, fairness opinions, restructuring, share buyback, terminal value in a DCF model. These all are the outcomes or applications of the CCA, comparable company analysis. So we did one live example related to 2 companies that we helped ourselves to calculate and find out enterprise value plus the EBITDA margin, EBITDA not margin, EBITDA, and we helped ourselves to calculate the enterprise value by EBITDA multiple and increased and decreased plus the PE multiple also, right? Higher the multiple is good, but it should not be beyond the range. And third most important thing, can P multiple be negative? Answer is yes, mathematically yes. But what does this mean? It becomes a not meaningful number. So in that case, it will be out of the range for the purpose of comparison.
Let's have a quick quiz question, guys. What is the primary purpose of ISDA? Your options are regulating global financial markets, advocating for environmental sustainability, standardizing documentation for derivative contracts, or promoting international trade agreements. Please mention your answers in the comment section.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
So Zerodha provides you the trading platform, or It's an online thing where you just fill. So, see, I'm not marketing anything, but yes, when I was with, when I used to have the account with an angel broking, I used to get the terminal itself. So they asked me that, how come we can provide you with a particular terminal? I showed them a certificate that I'm an NSE certified authorized dealer for for equity, derivatives, mutual funds, bonds, and life insurance, all five. So I cleared their examinations, and hence I became that particular dealer, and I authorized to that. So I said that, okay, now we can provide you the terminal. You know how to trade and all everything. Yes, I said I'll be able to understand it. So I was less dependent on their calls. I used to see how the trading takes place. That is the that red and blue or red and green screen which actually comes up. So friends, the name of that terminal is, for NSC, it is known as NEAT. How many of you know it, that the terminal of an NSC is known as NEAT? The name of the terminal on which the trading takes place is known as NEAT on web, which talks about four different markets: equity, F&O, debt, currency. Perfect. And if you are trading on BSC, that BSC terminal is known as Bolt. Okay, friends. So NEAT on web and Bolt. These are two popular trading terminals on which nationwide trading takes place. Do we get an opportunity to work on this? No. This opportunity is being given to people who are the brokers with NSE or BSC. So with brokers. So for example, if I'm registered as a broker just by paying only 250 crore rupee as the security amount, not a fee, but a security amount. Okay. And I want to trade across India and many more things, so that I want to trade on my behalf as well as on my client's behalf. Clients means customers' behalf. Suppose if I'll open a company, namely like should be, could be a Zerodha or could be anything else, could be Angel Broking, Sharekhan.com, a couple of more could be. So if the moment I have opened the same thing, I can definitely ask people to also join hand with me, not to become a broker, but to become a trader. So there are two options, friends. One, I can provide you the calls which are there on the screen itself. Means you can come and visit the broking house and do the trading on your own, and you can sit along with the people and then get it done. Second thing is that I can also provide you this trading terminal on which you can trade on your own. There is no intervention. I mean, definitely you will get some calls or so, but there is no intervention. There won't be any intervention per se. So how to do the same thing? Let me just share with you. So they provide us the same screen of the terminal itself. So we are not working directly on the terminal. We are working on the part of the screen which is known as CTCL, which is, it's not there in the module, but it is known as computer to computer link. This means what? Like my own screen is here, which is just showing you, which is trading life cycle. Okay. This same screen gets split into, say, different small screens. Could be, say, 10, 15, 20, 100 screens of that. And small screens, access of those small screens would be given to the customer if they are interested in doing their own trading. So it's based on technology. That's why it is written as via computerized exchange. So I am actually not working on the NEAT software, but a replica of the same, which is part of the screen of the original software. And original is with the broker itself. Perfect. So face-to-face, telephone, computerized. So front office, it's an interface team between the trader and the other support functions. The prime responsibility of the front officers are booking trades, smooth processing, resolution and escalations, listening and reporting requirement. Okay, means popularizing the same trades also and everything. Yeah. And front office services could be client acquisition services, provide advice to the clients on complex strategies, decisions on M&A, and provides underwriting services to raise capital, and so on. So client advisory services would be like that. So broker can also provide a client advisory services, and also services related to M&A, and also can help them to get the IPO executed and raise funds through an IPO. Investment banking services facilitates to create demand for the stock in secondary market, that is market making. So they can definitely create the hype of the particular stock in the market, and hence the demand will rise so that everything will be sold out. And you can assume that the LIC, the IPO of an LIC, and couple of more IPOs. Asset securitization, capital restructuring, private and public equity placements. Asset securitization means that against the assets, they can issue some securities. Could be debt or could be anything. So for example, against the same thing, if I want to raise funds, I can mortgage it, I can sell it, but I don't want to sell it. I want to keep this asset with me also. So I can securitize it and then raise the funds. I can also go to the bank, and bank can also help me raise funds through that. That's the way it is. Capital restructuring means how the combination of a debt and equity would do, so that it will have a direct impact to the WACC. And private and the public equity placements means either you are placing your funds with private company or public company, and then getting the getting the returns from the same thing. Okay, so this is theoretical part. Understand it to the understand it at ease. Middle office responsibilities: trade capture, positions, risk management and compliance, confirmation, P&L account, and liaising with other support functions. So this is something from the middle office point of view. Correct? Let's take it forward. Front office, middle office, back office, all three works together as per this particular thing. Okay. So the back office responsibilities: settlement on time, very important. Cash movements are funded, monitor cash settlements and reconciliations. So at the end of the day, you should be able to see that, yes, if I have taken care of the cash settlements, if I have I'm completed with my trade, then what are the things which need to be taken care of? It should be timely settled. It should be reconciled on daily basis. Reconciled means that whatever the number of stocks which are being sold, what are the number of stocks which are being purchased by the client, the customers itself, those should get matched as per the trading. Generally, the system actually matches. And at the end of the day, whosoever has purchased, you should be asking a payment from your client. Whosoever has sold, the same thing should get credited to the client side. So this is how the things takes place from the back office point of view. So TLC participants, the primary participants in TLC are investment banks, brokers, custodians, banks, exchanges, clearinghouses, depository and document standard providers. So ISDN is again, that is document standard provider. Could be clearinghouse is something keeps the or I would say the depository who keeps the hard copy of the documents with them. For example, the hard copy of the ownership with them and so on. And types of TLCs: the trade life cycle of securities differ by product and place of the trade. And the main type of TLCs are over the counter and exchange traded. So two main, that is over the counter. It means the trade life cycle, which could be there over the counter. That is exchange. That is something which is there on the stock exchange inside itself, but it is not regulated. But exchange traded means those particular things are more standardized and regulated. And regulated by whom? By the SEBI itself. Let's understand these differences. So sometimes people ask that what are the differences between OTC as well as the exchange traded? So for all products that are traded over the counter, this is something which is known as for the OTC and includes both vanilla and customized structured product. Vanilla means the plain vanilla products. It means as it is, it is being sold out. Customized means that they can also create their own lots. They can also create or try to fix their own prices over the counter and so on. Has a very low degree of the straight through processing, which is STP, owing to the customization. So straight through processing means immediately it will not get processed, but yes, based on the customization, we need to understand that how the things takes place. Though it is very less popular, but we need to understand one thing, friends, that yes, these things exists. even if it is less popular. So on all the regionalized stock exchanges, OTC takes place. All the on both the nationalized stock exchange, which is NSE and BSE, exchange traded takes place. So for all products that are traded in centralized exchanges, includes only vanilla products such as equity, futures, options, commodities, etc., and has a very high degree of straight through processing. It means they will be processed within T+2 days and many more. So trade lifecycle steps. Let's have an understanding. What are these steps and how we can just enhance and understand on the same. Trading activities, trade execution and trade captures could be front office, operational related activities, trade enrichment, validation, agreements, transaction reporting, and settlements instructions. Very basics. Okay. But let's have a look at it one by one. Execution and order from institutional client. Who is an institutional client? Can I just hear from all of you? Who could be an institutional client? That who are with heavy funds and they do deal in those particular funds on day in and day out. For example, banks, insurance companies, mutual fund companies, private funding companies, hedge fund companies. These all are the right examples of the institutional clients, including the insurance companies. So they are every time on heavy on cash and they seek opportunities to invest with different companies altogether. Okay. Then, so an order is required to buy and sell securities given by an investor, such as an institutional client, to an security token offering, which is STO, or to an agent for investors. So an STO provides a token of a token, a code that you have an opportunity to invest this much of the amount or this much of the lot size at one point of time, and you can take the maximum benefit out of it. Basis the pricing also, because the number increases, then the pricing also gets modified also. So order features, have a look at it. Order features: buy or sell a specific quantity, specific security, and order until executed or until an expiry date is reached or until the order is cancelled. Additionally, partial executions may be possible depending upon the types of an order. So if I have put an order which is buying 100,000 shares, 1 lakh shares, 100,000 shares at 100 each, it means I have this much of the money with me. Sometimes the price is 500 also, 1000 also. In case of an MRF, it is 100,000. The price in itself is 100,000. I could land up buying more. I could land up buying a proportion of it. So this is how what it is trying to tell you, that buy or sell could be specific quantity for a specific security itself. Next is for institutional client, order contains a number of features that are relevant to the price, including limit, that is price is specified. When buying, pay no more than the stated price. When selling, accept no less than the stated price also. Right? So one is known as a limit price, friends. If you have experienced this, so I have experienced this a lot. It means I have put a limit to that. If the price is increasing or decreasing. Okay. So I want to buy at a specific price itself. So suppose the price is going on at 200 and it is increasing. I don't want to land up buying at a highest price during the day. I'll put an order which is a 201. That's it. 1 rupee increase for say 100 securities. Just listen to this carefully, okay? I want to put an order. The price currently is 200 and it is increasing. So I'll put an order which is 201. The moment it hits 201, my order will get executed. And I don't want to continue carry it forward for the next day. I want to close it for the today. I can, the moment I am entering in the market, I am also putting a price, say, which is 205. This is my sell price. So I bought it at 201. I sold it at 205, which is 4 rupee gain during the day. It could be 1000 shares of 4,000 rupees. So when selling, accept no less than the stated price. Even if it is falling, it will get closed at the price which is there, or I can simply tweak it a bit as per my comfort zone also. At best means available price, also known as at market order. At best means what is available immediately, I want to buy it. Like it is available at 200, I want to buy it at 200. That is something which is also there. Stop loss. What do you understand by the stop loss? Anyone? I'm sure a couple of you must have heard about this. Understand it, okay? 200 price at which you bought, you would be happiest person if it is rising. It is rising, okay, it is bullish market, it is increasing for sure. You'll be gaining per share, that's the case. Loss taking capacity is 5%. It means 205% is 10 rupee. The moment it should touch or it touches, so automatically you will be putting an order also for what? For 10 rupee less. It means you don't want to lose more from it. 10 rupee less, and that will be simply 200 minus 10, which is 190. Automatically put a stop loss. The moment, the meaning of stop loss is the moment it touches 190, immediately the order will get order will get placed, and instantly it will see from where it can get matched. So stopping the loss for the day. Correct? And that's what's simple. It could be on the other side also, friends. Now, suppose you have sold stock for rupee 500 and let's say not 500, let's say 300. So process of trade execution, these are the steps, institution client decides to buy or sell specific security and contract one of the STOs with whom it normally trades, and detail of the order are normally placed with STO by the relevant salesperson. So this is all theoretical, friends, okay? So please I'm just giving a small reading to that. So these are just the steps. So STO salesperson records the details of the clients and either manually or electronically within order management system, and order details are forwarded by the salesperson or are fed automatically by the order management system to the relevant trader or market. So either we will be doing or on our behalf the broker will be doing. So sometime when we get a call from the broker itself, so they ask us, this is a good order and would you like to place an order related to that, and hence we can see a good potential into that, and we can so they are tracking the same thing on our behalf on daily basis, hence they are putting orders on our behalf using our client code itself, and the trader assesses the order and decides whether they wish to execute the trade on such terms. On the other hand, a market maker must execute a trade providing that the order price is within the market maker's published price. That's the whole thing. And there are more steps also. There are 8-9 steps. And the trader or the market maker responds to the salesperson who placed the order on behalf of the client, advising them they have to or have not executed the trade, and if so, on what terms. So trader used to call me and ask me. I have also done the same thing with the trader also, but initially 2-3 orders. So they used to double check with me that sir, is this a price? This is a price, and it is increasing. Shall we put this price? I said yes, put this particular price. If you are doing trading, friends, choose a month data, 3-month data, 6 months, and year data. I'm just choosing a month data, so they automatically select it. And once you click on this filter, but before the filter, so you can click on this and to download it. Okay. But have a look at it, friends, the price. 25th August, 24th, and so on. Open, high, low, close. We popularly call it open, high, low, close. Open stands for at what price the first trade of the stock took place. It was at 21.85, and that was the highest one. After that, it must have been dipped. So it is 217.20 and previous close, which is 220. And last traded price, which is 217.60. Last traded price means exact the last trade of the day. And then we have the close price, which is 217.90. This close price gets declared at the end of the market close for the day, which is nothing, which is the last half an hour trade weighted average price of the day trade. I repeat, close price, and there's a difference in close price and the last traded price. So why there are two columns? So close price, friends, is the last half an hour weighted average price. Okay. And then we have volume weighted average prices. So there's something which we don't use. Important for us is the close price, and also see some differences. If I just increase the zoom size of this. So do you see any price which is in 1 paisa or combination of that? So generally the price difference is, or I would say if the price is say 221.85, then immediate next highest price would be what? 221.90. You know why, friends? Please listen to this carefully. So the next highest price would be 221.90, which is the 5 paisa difference. So that 5 paisa is popularly known as 1 tick, equals to 5 paisa. So how many ticks in 1 paisa, in 1 rupee? So there will be 20 ticks. Okay, so the same way we call it. So NSE BSC, the prices are like this. So increase and decrease in the price happens basis 1 tick or multiple of 1 tick. Correct? So no 1 paisa trade. But at BSC, you would be able to find out some stocks, friends, which are 1 paisa also. So stock prices or stocks which has a price up to 20 rupee is known as penny stock at BSC. So you may write down this thing for your reference. Price up to rupee 20 at BSC, known as penny stock, and tick size is 1 paisa. So you will be able to find out there are many stocks with 1 paisa tick size differences. Could be 11 rupee, 14 paisa, 18 rupee, 7 paisa, something like that. You would be able to find. But at NSE, irrespective of any stock, the tick size is 5 paisa. Today, of course, say today is Friday and the market is closed. Now you have got the prices. Tomorrow, which is say on Monday, the market opens. Tomorrow, definitely the moment you will open a door, open refrigerator again in the morning, again you will find what 8, because that's something which was the close of the previous night, and today morning is something which will be there in that. It goes with everything as something which is inventory. It should not get confused with a stock. Okay, inventory, it means something which is tangible. You kept it, and the moment you will see it again, you will be able to see it, that same quantity itself. Are shares inventory? This way the things takes place, and hence to take it forward, the salesperson contacts the institutional clients typically by telephone or to advise whether the order has been fulfilled fully, partially, or not at all. So components of trade capture, the basic component that are typically recorded by the trader or the market maker: trading book, trade date, time, value, operation, quantity, security, price, counterparty. It means within 2 brokers. So from whose broker account the trade took place, not the parties. So in a trading, they keep it absolutely transparent, but not from the point of view that who is buying, who is selling. So I will not come to know that from whom I have bought. Even the person who has sold out the stocks, you will not come to know to whom you have sold. You will reach out to your broker that where is my money. Broker will reach out to you that where is the check, like that. So they know that with whom it is being traded with another broker, and they know this is the client ID. So I will not come to know that from whom client ID that the trade has taken place, or with broker has the right to actually have a look, so that they helps us to get it settled. Correct? Settlement system of the trade captures if the counterparty agrees to detail of the trade and is willing to enter into a deal, the trade gets executed. The front office forms the stage where the trades get executed, and a trade is then captured in the trading desk, usually using a deal capacity system, and validation, trade events, acknowledgement, and all these things take place. Okay, and following the collection of the fundamental trade details, the trade enrichment entails the selection, calculation, attachment to a trade pertinent information required to carry out a number of critical operations. And in a fully automated settings, which is STP, effective clients servicing, avoiding operational risk, lowering operational cost cannot be properly performed unless the trade enrichment is exact and finished within the required dates. So these are more system-based things, how you want to smoothen down the system. That's why it is known as enrichment. Automated environment, the trade enrichment is accomplished by automatically selecting pertinent information from the database to information selected in static data at a process called a data default. And trade enrichment whether carried out manually or automatically refers to the improvement of the trade. So that's something which is enrichment means improvisation of that. Static data is only used when data enrichment is automatically achieved. Okay. So for that, there are steps. Basic trade details to be captured. Basic trade details are compared with the information held within the static data. Select the defaults are attached. So this is more related to trade from the broker point of view. I'm just talking about. So it's more basis the unchased basis more some dependent supply also how to encash the news and understand it. So they use some technical analysis tools rather than algorithms to that. So calculation of the cash values, selection, custodian, and many more. So this is more theoretical, friends. I'm just not reading each and every word. After a trade has been conducted, captured, and enriched, the various responsibilities include issuing a trade confirmation, issuing settlement instructions, reporting the trade to regulatory authorities, and can now be auctioned also. And the trade validation is the term for the activity which serves as a risk reduction and control methods. So following risk exists if the STO does not execute the trade information at this step of this. With this timely and accurate client service, minimizing operational cost and avoiding operational risks must be there. There is a complete module on risk. It is not related to stock market or investment in stock markets. It's related to a couple of more things, friends, which we'll be discussing in a while. Okay. Trade validation components could be related to trading book. Trading book may be restricted to specific transactions types, including principal only, specific instruments, including Swedish equities, and to specific trades. So a trading book would talk about it, how much you have invested, could be related to specific instrument groups, could be that if you have invested something which is outside that particular part, then it can also take place, and so on. Trade date should be that is today, or a new trade date cannot be in future. Of course, a trade date must be today's date, because it will talk about something which is traded today rather than something which you are planning to do it. Okay. Trade time cannot be in the future or retrospective. That's an important point. So even cannot be in future or cannot be at the back date. Trade validations include again the value date. Typically, it follows a securities group typically settles such as T+3 for Canadian stocks. So maybe either shorter or longer than normal if the trade has agreed or a trade execution has recorded a date. Should be a business day in the location of the settlement and cannot be earlier than the trade date, cannot be earlier than the primary value. All basics, all basics. Operations, that is typically this cannot be validated. Settlement personnel usually have no mean of knowing whether the trade should be buying or selling or lending or borrowing. So understand this. Settlement personnel usually have no means of knowing it, whether the trade should be for buying or selling. So person who is settling it, that is, it's transferring from one to another. So their purpose is to settle the transaction. The purpose of the bank is also to settle the transaction. That is from where the money is getting received, from where it will be going. So they would be least interested, rather not interested in knowing that from who is the person and what is the intent behind. Okay, so everyone knows that what is the intent, that is to gain from the market itself. And then we have a quantity and a security and so on. So I'm not reading all the things, but yes, let me just, it cannot be less than the minimum denomination of a bond if it is there. And it must be multiples of the minimum denomination of a bond and could also. Let's take it forward in the price and the counterparties. It must be expressed according to the security group, which is share price must be an amount per share and bond price must be either a percentage relevant to the face value or a yield. And counterparty, that it means it must be clearly distinguishable from any other counterparty and must include location of the counterparty, where they are actually located. So not only the city, but country is also important, because the trades are allowed from different countries also. The next and important, that is a trade agreement. Once a trade has passed validation, number of actions can commence. That is, an action is regarded as being most urgent to complete is the act of gaining agreement of the trade details with the counterparties. So, act of gaining agreement, it means that we will be understanding and gaining from them that yes, the trade has taken place. The trade agreement can be achieved through issuance of outgoing trade confirmation to the counterparty, receipt of incoming trade confirmation from the counterparty. Okay, issuance of outgoing and receipt of the same. Trade matching, that I sold at 100 and you also bought at 100 rupee. I sold at 100 rupee, hence it is matched. That detail can also be shared. Trade affirmation, that yes, now it is being confirmed that yes, now the trade has already been taken. So these are the 4 points which need to be taken care of. Method of trade agreement from the perspective of STO, the risk and the requirement to reduce it are constant. But the process of agreement of trade details between the parties to trade changes according on the local laws, market customs, and kind of the counterpart. So gaining a consent on the deal performed by other STOs is generally going to be handled differently than dealing with the institutional clients. So friends, it's as simple as that. Dealing with retail and dealing with institutional investors, these are the two different deals which takes place. The prices which I just showed you, which is NTPC's price, which is on the screen itself, this is for whom? This is for retail buyers. This is for us. And if we are a financial institute, could be a bank, could be an LIC company or so, then the price will not be this. The price will be absolutely different. A company would be, or I would say, that particular financial institute would be buying the same thing in bulk. Could be 7.4 million stocks in one go. At what price they would be? We would land up buying the same thing, which is 100 stock, 200, 500, 1000, 2000 stocks at a price of this. Okay, but they buy in bulk. They buy in bulk and they also trade in bulk for sure. Let's have a look at it. So this is retail. Transaction reporting, which says within each marketplace, a regulatory environment exists in order to ensure that the market operates in a fair and an orderly manner. And this encompasses a number of facts of operating relating to stock exchange, market maker, including STOs such as transaction reporting, trading rule breaches, position taking disproportionate to the member's financial position, which is capital adequacy, and so on. And the guidelines established by the market makers are made to ensure an investor protection, the interest of the members, protecting the reputations of the marketplaces, and so on. Okay, and there are few more rules that within. Yeah, sorry, I think so. We are already through with this. The purpose of transaction reporting could be for sure. Stock exchange or market participants are typically required to report the specifics of each transactions, and they have been done within a determined time frame from the time the deal was executed to relevant regulator, and provide specific about each transaction you pick. So stock exchange typically participates, and regulator can evaluate and monitor the business being conducted in market by specific companies using this information. So how the transaction has taken place, and regulators can also double check with the financial institutions and the companies if there is a bigger deal or so. Within the regulatory environment, this work is frequently referred to as supervision or surveillance. That's the whole story. And last is a settlement. The term settlement instruction is a generic term used to describe only mechanism by which trade settlement or exchange is initiated between seller and the buyer. And for each trade, an STO issues a settlement instruction to the relevant custodian. And the term custodian is used within this book as a generic term by many types of organization that provides the custodial services. So custodial services means they have the physical form of the securities with them. NSDL and CDS, they perform. So if I have sold and you have bought, friends, so with the custodian, the hard copy of the shares in front of those hard copies, the number, the name would get updated. So even if from the 100 shares I have sold, say 80 to you and 20 still I'm keeping, so all those 80 shares will be now in your name. So job of a custodian is to keep, intact those names as well as the trades which has taken place within themselves. So that tomorrow day after, if you want a hard copy of your own shares, which is a share certificate, how would you be able to get? You need to reach out to your broker, and the broker will reach out to the NSDL or CDS. Settlement instructions are normally generated by and transmitted from STO settlement systems by a secure method, and the destination being appropriate custodians depending upon the security that has been created.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Have a look at it, friends. I think so. You guys are a bit near to that. So, what is risk, friends? So, when I say risk, it's a situation involving exposure to danger, and it is the possibility of losing something of value. Okay. And the value can be gained or lost when taking risk resulting from given action or inaction, foreseen or unforeseen. So, is driving a risk? I ask this question majority of the time to the people or from the people like, who drives the car. And it's easy to understand from that. Is driving a risk? So, my point over here is, if we drive carefully, of course, there's no risk. I won't say it's not a risk, but yes, there's a risk which is being reduced to the best possible. Driving with a safety, with belt, as well as, the airbags opens and many more things which are there. It is to reduce the risk which is inside the car, not outside the car. It is to protect you, not to protect the car. Okay, but what if it happens on the other side? If it gets heavily damaged and you land up paying the damage and so on. So, that's something which I call it, this is risk. Two types. So, let's understand it. And there are n number of types of risks which are there, friends. Understand from this point of view, driving is not a risk until unless it is something, because of that, there will be some loss of an uncertain future event. And that's something which is going to pay from your pocket. So, there are events which happen. So investing in stock market is not a risk. Investing in stock market without a knowledge is a risk. If you invest with good knowledge, of course, there are many people who earn from the stock markets. Though we call it stock market is risky. Why? Because it attracts more people, because it provides you returns in 10%, 12% in a month also, which we generally don't be able to get it within a year. If you're taking more risk, then that's why there are higher returns. But sometimes it is not to gain more returns, it is also to protect the existing. So that's why there are hedging strategies. Okay, so let's take it forward, friends. Can also be defined as international interaction with the uncertainties, and risk management is the process of identifying, assessing, and controlling threats to an organization's capital and earnings. So what is risk, friends? That is, threats or risk could stem from a wide variety of the sources, such as financial uncertainty, legal liabilities, as well as strategic management errors and accidents and natural disasters. So these things also leads to some sort of risks. Thank you. So risk management is something, the way that a business is consciously choosing the kind and the degree of the risk that is appropriate for them to assume is through the risk management. So first is right risk identification and then managing it. First is rightly diagnosing it. Majority of the business decisions involve giving up current resources in exchange for uncertain future profits. So taking risks and managing them are the two sides of the same coin. Okay, and all successful organizations' management processes are built around the ability to make decisions regarding the risk in relation to reward and to assess the performance. So let's have a look at it, different types of the risks. So we have prices can be decomposed into general market risk components, specific market risk components. And These are unique to the particular financial transactions under the considerations for sure. And in trading activities, risk arises both from open, which is unhedged position, and from imperfect correlation between the market position that are intended to offset one another. Right, friends? So risk could be related to unhedged positions. Okay. So do you think so, friends, that for every asset there is an insurance which is available? For house, home, it is. For your mobile phone, it is. For your vehicle, it is mandatory. Do you think that every asset is insurable? So another risks are interest rate risks. So the simplest form of the interest rate risk is a risk that values of a fixed income security and will fall as a result of an increase in the market interest rates. And equity price risk, that is, this is the risk associated with the volatility in the stock prices, and the general market risk of the equity refers to the sensitivity of the instruments or portfolio value to change in the level of the broad stock market indices. So equity price risk, stock market interest rate risks, that is increasing, decreasing in the interests. So interest rate risks, it means if you have invested in a fixed income and over the period of time the market is increasing, hence the rate of interest available in the market is increased, you are still at a fixed income, it means that is interest rate risk which is available. And the other way around also. Foreign exchange risk, as we have already mentioned, that foreign exchange risk arises from open or imperfectly hedged positions in particular foreign exchanges, denominated assets and liabilities, leading to fluctuations in the profit or values of stock. Equity price risk, that is same, that is price of commodities differ considerably from interest rates and foreign exchange risk, since most commodities are traded in the markets in which concentrations of the supply is in the hands of the few suppliers who can magnify the price volatility. So foreign exchange risks, equity, commodity, interest rates, these are the risks which are being very popular and being closely watched by the company. Then next is the liquidity risk. The name in itself, friends, that is, there is a liquidity crunch. So liquidity risk comprises both funding liquidity and the trading liquidity. Funding relates to the firm's ability to raise the necessary cash to roll over its debt, meet the cash margin, collateral requirement of counterparties, and satisfy the capital withdrawals. And funding risk, liquidity risk, can be managed through holding cash and cash equivalents, setting credit lines in place, and monitoring buying powers. And buying powers refers to that amount of the trade counterparties can borrow against assets under the stressed market conditions. Liquidity, it means how much money you have. The liquidity means that the cash in hand and at bank combined together, and cash and cash equivalents. So like yesterday we understood that is what is cash in cash equivalent as per the EV calculation. In this case also the same thing, that is how much liquidity the company has. See friends, there is a high possibility that the company has done a profitable business during this quarter or the year itself, but company is low on cash. There is another possibility that company is into losses and company is heavy on cash. It means there is no liquidity problem with the company, and company is buying another company also, maybe investing in another company also. Correct. So we need to take care of these things in such a manner that the liquidity risk is not arising, right? So this way the things will take place. Then comes the legal and regulatory risk, arises for a whole variety of reasons, and it is closely related to operational risk as well as to the reputation risks. So legal and regulatory risks, and it is possible that the counterparty lacks the necessary legal or regulatory authorities to conduct dangerous transactions, and under Basel II Capital Accord, legal and regulatory risks are categorized as operational risk. What is Basel II? What is that Capital Accord? I'll be talking about the same thing. We'll be learning it together in the upcoming slides once the risk part will get over. So when a counterparty or investor loses money on a transaction and decides to sue the provider firm to avoid fulfilling its obligation legal problem, So a big investment bank, for instance, sustained significant losses when a British government amended the tax code to eliminate a specific tax benefit in the summer of 1997. So regulatory risks. So regulatory means if the tax rates changes, if tax regime changes, again, whether it is favorable to the industries, it is not favorable to the industries, and how the industry is going to perceive the same thing. So this is how the things takes place. Okay. So let's take it forward. Then we have business risks, classic risks of the world of business, such as uncertainty about demand for product, price that can be charged for those products, cost of producing and delivering the products. Before I go to the next slide, let me share some practical example with you. How the companies define the risks under the business for sure, for their business completely, and what sort of mitigation strategies they are using to take it forward, to take care of it. If I'll take you to the slide, the specific slide, and on the slides we could see the content, and one of the content says that do we have some things which is known as the risk management. If I click on the risk management, we'll be able to reach the right slide, but yes, let's wait. First of all, so every company finds out some risks. How they find out some risks, there is a methodology they actually follow. But yes, let's have a look at it. If I'll go to the page number 30 and click on that. Safeguarding our future growth. And please have a look at it, what they say basis this one. You may also open this thing for your ref, but yes, I'm just helping you to understand this. So at Tata Steel, we have deployed a structured and uniform enterprise risk management framework to proactively identify, assess, monitor, and mitigate risk across the company. And this framework is essential in driving business resilience in a VUCA world. VUCA stands for volatile, uncertain, complex, and ambiguous world. Another common word, common in the business. So let's have a look at it. What the first one says. Financial risk, macro and market risk, macroeconomic and market risk, regulatory risks, and so on. So how they are identifying it, I'll just read it loud for all of you. Okay, and I'm increasing the zoom size for the better thing, so that better zoom size. So Tata Steel has 84,893 crores of the debt of as of March 31st and aspires to nearly double its capacity in India to 40 million ton per annum by 2030. And the plan is to deleverage further the pace growth in the line and the incremental accruals. However, high cost of borrowing due to the tightening of the policy rate cycle coupled with the geopolitical and the energy crisis in Europe may impact our capex and deleveraging the plan. The company is exposed to currency volatility. In addition, evolving climate change regulations and disclosure standards, and could reduce access to capital and increase the cost of funding. Okay, and we have cost of funds. So this is something which they have actually talked about. Okay, now the next is, friends, mitigation strategies. Mitigation strategy, balance between the growth and the deleveraging, focus on driving operations efficiency and cash generation, robust capital allocation strategy, improvement in ESG. What is ESG, friends? ESG disclosures, anyone? Another risks. So have a look at it. Other risks, there are many to talk about, and every organization identifies them. If I'll just take you to the top of it, another is macroeconomic and market risk. Prolonged inflationary pressures and dynamic macroeconomic scenarios may have an adverse impact on the global steel demand. Changing customers' preferences are triggered by adoption of newer grades of steel and sustainable steel products, like that. So mitigation strategies, redistribution of sales mix at this. So I'm not reading all, but yes, company is providing what for it. Talking about the risk and the mitigation strategy, like the way we did. You know, friends, Driving safe is good, with right intent is good, but we know that it is not only we who can drive differently, but it's a risk which is from the other parties, which is not in control of us. How to mitigate it? Not only by putting the seat belt or being dependent on the airbags or so, it is important to take the insurance, a cover, a hedge against the risk which could come up and which could lead to a reduction in the value, a loss. I'll talk about another one. Okay. Regulatory risk, like we have already talked about, related to regulations, and this has come up as environmental, social, and governance. This is a different department which is now coming up, and which has become a mandatory for the manufacturing companies to talk about it. Okay, so let's take it forward. Now, let's take it forward what it says. And there are many more. If I'll just put it on the right hand side, then we have operational risk, community risk, we have supply chain, and the list is huge. And they have the mitigation strategies also. The safety risk, commodity, information security risks, and they have identified 9 of them so far. And let me just check on the left hand side, and so on. So, for example, related to credit risk, what the company is actually thinking of. So, credit risk is a risk of financial loss arising from counterparty failure to repay the services. Of course, this is as per the definition. And if we'll just go a bit up, you would be able to see that how they are identifying the same counterparts. So carrying value of the financial assets represents the maximum credit risk. The maximum exposure to credit risk was this, and this crores. So which was 59 and 53 crores as at 31st March 23 and 22 respectively, being the total carrying value of the trade receivables, balances with the bank deposits, investments in debt securities, mutual funds, loans, derivatives, assets, and other financial assets. So they have identified that not only we are talking about a credit risk, that this is something which is a counterparty, but what is the amount which is with the counterparties? So the moment we sell goods to our clients on credit or customers on credit, that is something which is an exposure towards the credit risk. Correct? That exposure leads to non-payment, and if it lead to non-payment for a longer period of time, then at what pace and at what value we could be able to, we are going to lose it, and what's the hedge we are actually providing ourselves to or against that particular credit risk. So company comes up with those things that we have identified: credit risk, liquidity risk, market exposures, and many more, and what we are going to do with that particular thing. Okay, so live examples are already here, which companies comes up with a value, that is amount of loss which we are going to incur and how to mitigate the same thing. So first identify the risk, second identify the financial loss, third identify or use a mitigation strategy to reduce it to the best possible we can. Business risk, classic risk of the world of business, such as uncertainty about the demand for products, price that can be charged for those products, and the cost of producing and delivering the products. Strategic risk, that is risk of significant investments for which there is high uncertainty about the success and the profitability. It can be related to change in the strategy of a company, its competitors. If the venture is not successful, then firm will usually suffer a major write-off and its reputation among the investors will be damaged. Would like to share one more thing with you. Like, we have the company shares strategic objectives. So strategic objective ensures alignment of our business goals with our vision and values. ESG principles are integrated with all the aspects of our business. So strategic roadmap for this company, which says this. So SO1, here SO1 stands for strategic objective 1. Leadership in India, increase capacity of India operations through organic and inorganic growths like crude capacity. So the target is 40 million ton per annum by 2030. Attain and retain the leadership position in chosen segment, which is current and new, and enter new segments and sustain number 1 position in existing chosen segment. So that is something which is one of the strategies. Another thing is SO2, which says that maintain cost leadership at the market price of the raw materials. Right? This is something that the Tata Steel is doing since long, because they get the mining licenses to mine the things and so on. Cost reduction and value enhancement. So how to achieve? There must be some strategy to achieve there. How you will be able to achieve? It is not about talking and putting it through. It is something which the management should think through and talk about that. Yes, we have this strategy by which we would be able to achieve it. So if they want to increase it, one of the things which they did, which I shared as another example, that Tata Steel was existing at 15 million ton. Now, after acquisition of Bhushan Steel, they increased to 20 million ton. Another thing is that they have a plant which is the latest steel plant ever in Asia, and which has a capacity from 3 million ton to 6 million tons. Currently, it is 3 million. In next 3 to 4 years, could increase to 6 million, means double the capacity. How to do it? What are the things which are required? So this is something which we are going to achieve with the help of the cost reduction and so on. So basis this, and if I'll just go on the right hand side, so these are the strategic objectives, and we talked about which is 4 strategic objectives and so on, and hence the things are. So they have all those things. Could be KPI. So KPI is something which we will be talking about, which is key performance indicator and the goal to reach to that. So how to reach to the revenue levels and how to enhance it at some. So these all things becomes what? A part of the strategy and a part of the strategic risk. Once we talked about, and we have supply and many more, operational risk, community risk, and so on. So that's a thing related to the strategic risk. So next comes the reputation risk, that there are 2 categories of reputation an organization need and will keep its obligation. Will keep its obligation to creditors and counterparties, and company deals fairly and upholds moral standards. So following accounting scandals that misled the shareholders, bondholders, and employees of many prominent firms during the late 90s boom in the equity market, the second primary kind of the reputation risk assumed a new dimension around the turn of the millennium. So this how the things takes place, and this how the basis of scandals, the reputation gets lost, and many more things. Think about 2 companies. You think that yes, their reputation is now lost. So they were doing good, but now today's time their reputation is completely lost. The breakdown or collapse of business sectors, financial institutions, or entire economy is known as what? The systematic risk. So systematic is something which is related to the outside world. Okay, this is system which cannot be controlled by us. So if there's a war-related situation, warlike situation, then how would you be able to control? This way. And the risk of a significant financial system failure comes when capital providers such as depositors, investors, and capital market lose faith in the capital users such as banks, borrowers, leverage investors, etc., in a specific medium or exchange. Medium of exchange, which could be in USD, could be in Japanese yen or so. It cannot be avoided because it is inevitable in a capitalist system, and the risk spreading by a transmission mechanism from institutions to comparatively healthier, from ill institutions comparatively to healthier organizations, is the most crucial aspect of systematic risk. So transmission is happening. People are shifting to the healthier institutions rather than to the ill institutes or so. Okay. Now, next could be, that is operational risk, which we have already talked about. Potential loss resulting from a range of operational weaknesses, including inadequate systems, management failures, faulty controls, frauds, human errors, and so on. And in the banking industry, operational risk is also often taken to include natural and man-made catastrophes and other non-financial risks. So how risk is identified and captured within the banks is a different way. That is something which is related to Basel, which we'll be talking about in upcoming slides or so. So this is related to the operational risk also. Then operational risk could also be taken from the point that yes, is both, that is, the old and the newest threat faced by financial and non-financial institutes, specifically by financial institutes. And banks have to protect themselves from the key threats to their operators, such as bank robbery, white-collar frauds, or so. So there are many white-collar fraud which takes place. The latest white-collar fraud which took place in which bank? And that's very popular bank. Not the latest, I would say, last 2-3 years. ICICI Bank, more than 5,000 crore, the fraud. Along with her husband, she did that. So factors causing operational risks, increasing the complexity of the financial instruments, greater dependency on information system, and lack of familiarity with the new financial instruments or so. So this is something which leads to a fraud. So factors causing operational risk, that is, could be the misuse of the financial instruments, mispricing or inefficiencies hedging, operational error in the data feeds could be like that. And the most important force in changing attitudes to operational risk in the early years of the millennium was the Basel II Accord, and this obliged banks to set aside specific risk capital for operational risks. So but ICICI did a fraud for that. So from ICICI Bank point of view, Rashmi, it took a fraud. It was intentional. That's why it is fraud, because every bank manager, and so you cannot do a fraud all alone. There are many people you need to involve, the operational, the ops people who knows in and out, because everyone is responsible for one or the other way. That's why it's a fraud from the bank. Management of the operational risk and different types of risk we are talking about. So management of operational risk is all theoretical, and please give yourself a chance to read it through. I'm not reading it through one by one each and every point. There are 10 points simply. But from the bank point of view, the risk parameter actually changes. And what is so important from the bank point of view to take care of, let's have a look at it. So, regulatory environment Basel Accord. Basel Accord refers to the Banking Supervision Accord. Basel 1, 2, 3, issued by the Basel Committee on Banking Supervision, which is BCBS. And they are a tool of risk management in financial sector. So they are named so because of BCBS maintains its secretariats at the Bank of International Settlements in Basel, Switzerland, and the committee normally meets there. That's why they named it as Basel. And formerly, the Basel Committee consisted of the representatives from the central bank and the regulatory authorities of a group of 10 countries plus Luxembourg and Spain. Since 2009, all of the other G20 major economies are represented, as well as some other major banking locales such as the Hong Kong and the Singapore. So like that. So Basel is a place which is in Switzerland, and hence majority of secretariats used to sit there, and they made it a committee, and then from the committee they are actually following the same thing too. So BCBS, which is Basel Committee on Banking Supervision. So Basel norms are set by the BCBS based on the risk management guidelines, mainly focusing on the three risks, which is credit, market, and operational risk. And they focus mainly on the capital adequacy ratio, which is CAR, or liquidity ratio. That's how much a bank can lend. Example, a bank owns a capital of say 10, which is equity, and bank borrows capital, which is 10, which is fixed income, savings, and deposits. Total is coming out to be 10. So CAR would be 10 into 100. So which is CR, which is own capital, divided by 100, which is a total capital, into 100, which is to calculate the same thing in the percentage. So own capital divided by total capital is something which is there. So if the own capital is say 20, the total capital is 100, so it is coming out to be 20%, as the case. So that is capital adequacy ratio. So Basel 1, BCBS introduced Basel 1 in the year 1988, and India adopted Basel 1 guidelines in 1999. So after 11 years, India adopted and focused almost entirely on the credit risk. Defined capital and structures of the risk weights for the banks, and the minimum capital requirement was fixed at 8% of the risk-weighted assets, or RWA. So generally, we understand RWA from our day-to-day conversation point of view, which is known as the Residential Welfare Association. Let's grow up from that, okay? It is known as risk-weighted assets. RWA, basically, means assets with different risk portfolios, like an asset backed by a collateral. Okay, so RWA in banking is risk weighted assets and like that. Basel one, for example, a home loan would carry less risk as compared to a personal loan, which have no collateral. So companies needs to take care of RWAs. So Basel 2, so that was the only thing which was there in Basel 1. But it needs to be improvised. It was supposed to be improvised, and hence gradually it improvised further. So let's have a look at it, what it says. So three pillars of the Basel in Basel 2. And those three pillars are, so they increased those three pillars and they wanted to understand it. One is the minimum capital requirement, MCR. Another is supervisory review. And last one is the market discipline. So Basel 2, which is minimum capital requirement, which said that the first pillar deals with the maintenance of regulatory capital calculated for three major components of risk, which is credit, operational, and market risk. So the first pillar will deal with that, which is minimum capital requirement. And other risks are not considered fully quantifiable at this stage. Basel 2, which is supervisory review. After in this, which is the second point, it is a regulatory response to the first pillar, giving regulators better tools over those previously available, and provides framework for dealing with systematic risk, pension risk, concentration risk, strategic, reputational, liquidity, legal, which the accord combines under the title of residual risk. So like in case of a first pillar, it was only, or there were only three, which is credit and market and operational. In this, they have added residual, which is something which includes systematic, pension, concentration, strategic, reputational, liquidity, and legal. All things together got included. Banks can review their risk management system, the internal capital adequacy assess process ICAP, in a result of Pillar 2 of the Basel 2 Accord. So they improvised the Basel 2 Accord by understanding that yes, banking system can also fail. If the banking system fails, then where people will go, and it is not only the retail customers. Banking system is being also driven by the people or the companies who invest good, who keep their money for the rotation purpose, and many more things which are there. So banking system, of course, it's a heart of the economy. It must be as smooth as possible, and it must be, free from errors and considering the risk factors to the best possible. So the Basel 2 talked about the market discipline. That is, this pillar aims to complement the minimum capital requirement and supervisory reviews process by developing a set of disclosures requirement which allow the market participants to gauge adequate capital adequacy of an institution. And market discipline settlements regulations as sharing of information facilitates assessments of the banks by other, including investors, analysts, customers, other banks, and rating agencies, which led to good corporate governance. So they talked about these things: corporate governance, market discipline, supervisory, and many. So the different leg also came up, right? And so on. And the aim of Pillar 3 is to allow market discipline to operate by requiring the institutions to disclose details on the scope of application, capital, risk exposure, risk assessment processes, and capital adequacy of the institutions. All these things put together. All these things. Then came the Basel 3. So Basel 3 is something which is better capital quality. One of the key elements of Basel 3 is the introduction of much stricter definition of capital. Better capital means higher loss absorbing capacity. This is in turn will mean that bank will be stronger, allowing them to better withstand periods of stress. And capital conservation buffer. So another key feature of Basel 3 is that now banks will be required to hold a capital conservation buffer of 2.5% and aims of asking to build conservation buffer to ensure that banks maintain a cushion of capital that can be used to absorb the losses during the period of financial and economic stress. So just like how much the cushion, like we did one stop loss related thing today, how much we can absorb, say for example, 5%, 2%, 10%. So we kept that same. If it goes haywire, then we will take immediate action. 2.5% loss we can definitely absorb. But conservation buffer, we should always have that same thing available to us. And basically, of course, talked about cyclical buffer. This also one of the key elements of Basel III, and counter cycle buffer has been introduced with objective to increase the capital requirement in good times and decrease the same thing in bad times. Increase capital requirement, decrease in, like we have monetary policies, fiscal policy in India, which helps to maintain the capital adequacy in India. And the buffer will slow down the banking activity when it heats, and thus encourage lending when times are tough, specifically during bad times. So when the time is tough, then they can lend more, so that when people have more money even at a tough time, then there will be a better demand and supply. In case of already existing economy, they can definitely reduce the same thing, so that they can maintain the supply also, basis of supply also, they can maintain the highest prices also. So even if you give more money to the people in the developed economy, even then there will be more demand, and hence the prices will rise. You won't be able to control it. That's the whole purpose of it. The buffer is likely to range from 0 to 2.5%, consisting of the common equity or other fully absorbing capital and so on. So, and the minimum common and the equity and the tier 1 capital like that, and hence tier 1 capital, which is 2 to 4.5% of total RW, which is risk-weighted asset. Tier 1 capital, so the overall tier 1 capital requirement consists of not only common equity, but also the other qualifying financial instruments, which would increase the minimum capital requirement. And also, although the total capital requirement will remain at 8%, the required capital might be between 10 to 10.5% when they combined with the conservation buffer. So conservation buffer, if 8% is total capital requirement, and total money which a bank must have at every point of time, is including the conservation buffer, which would, it was actually working good. 2008 crisis came down, and even the Basel III got specifically questioned that yes, is the system is foolproof? Liquidity ratio played a role in that. Leverage ratio played a role into that. Leverage ratio is the relative amount of the capital to the total assets, and this aims to put a cap on swelling of the leverage in the banking sector on a global basis. So this is how the leverage ratio generally works, and it takes place too. Liquidity ratio under Basel III framework for liquidity risk management will create, that is, new liquidity coverage ratio and new stable funding ratio are to be introduced in 15 and 18 respectively. So that was related to Basel 1, 2, and 3. This is applicable to the banking framework. So other than the banking, if any other company is there on that particular company, the Basel framework doesn't work. So even if you download any of the company's financial statement, you would be able to see that whether the Basel word is there or how the Basel would work. That's something which you also need to take care of. Act, which is commonly known as Dodd-Frank, was signed into federal law by President Barack Obama on 21st July 2010 at the Ronald Reagan Building in Washington, D.C. And it was passed as a response to the Great Recession. So it was after 2008. Okay. So it brought significant changes to financial regulations in the United States since the regulatory reform that followed the Great Depression. And it made changes in the American financial regulatory environment that affect all federal financial regulatory agencies, almost every part of the nation's financial service industry. So if financial services industry is badly impacted, then the whole economy gets badly impacted, because everyone is so interrelated and dependent on the financial services. So they came up with that as various titles of the Dodd-Frank could be financial stability, end to big to fail, and end to OTS, hedge funds regulations, insurance, and also I'm not going to read all paid back contracts, miscellaneous, predatory lending, and so on. So to promote the financial stability of the US states by improving accountability and transparency in the financial system, and to big to fail.
Let's have a quick quiz question, guys. What is stock borrow lending or SBL? Your options are a type of savings account, a form of short selling, a government tax incentive, or a retirement savings plan. Please mention your answers in the comment section.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out the testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
So enforcement director, ED stands for enforcement director, has made a fresh arrest in alleged rupee 354 crore bank fraud linked money laundering case involving Ratul Puri and businessman nephew of the senior Congress leader and the former Madhya Pradesh minister, which is Kamal Nath, and others. Officially, source said on Wednesday, which is Wednesday, and Nitin Bhatnagar, a former relationship manager of the Bank of Singapore, was taken into custody under the provision of the Prevention of the Money Laundering Act, that is PMLA, on Tuesday, and he was produced before a local court by the agency that sent him to ED custody till 31st August. It's just a recent case. The money laundering case stems from the August 19 and the FIR of the CBI, where it was alleged that the company Moser Beer India Limited (MBIL) and its promoter allegedly cheated and defrauded a loan taken from the Central Bank of India to the tune of 354.51 crores, and the case was registered after the bank sent a complaint to CBI. Both CBI and ED had booked Ratul Puri, his father Deepak Puri, and mother Neeta, Kamal Nath's sister. Ratul Puri was arrested by ED, and the Puri family was alleged conspiracy, cheating, forgery, and corruption. Okay. And Ratul Puri was also booked in case of in the capacity as an executive director of a firm promoted for his father Deepak. And the company was involved in the manufacturing of the optical storage media like compact disc, DVDs, solid state storage devices, and so. Ratul had resigned from the post of executive director in 2012, where his parents continued to be on the board, and the bank had said in statement and the complaint to the CBI. The company Moser Beer was taking loan from various banks since 2009 and went for the debt restructuring a number of times, the bank has alleged in the complaint. By any chance, have you ever heard about this Moser Beer company name? I have heard and I have seen. Some CDs were also there, which were already recorded CDs, like the CDs, the blank CD. So blank CD in which that you can do. Oh, that was a CD deck. So it either a CD deck is there or a CD recorder is there. You remember our old days, that old big computer along with that CD burner, that CD recorder. So Moser Beer like that. I'm sure that was around 15 years back, like when I was in college. That time I was in college. So when it was unable to pay the debt, a forensic audit was done, and the account was declared as fraud by Central Bank of India on April 20th, 2019, and it has alleged. But now the ED told the court facilitated opening a bank account for a company called Pristine River Investment Limited in the Bank of Singapore, as he was its relationship manager, and the company was owned by Swanat Trust, of which Ratul Puri was the settler, the ED said. And it alleged that the company Pristine River was used for layering proceeds of the crime, and Bhatnagar knowingly assisted in doing so for the main accused, and which is Ratul Puri. And it claimed Bhatnagar was instrumental in doing certain other acts which do have a bearing in connection to the presence of case. Ratul Puri is facing investigation of the three main central probe agencies, which is ED, CBI, and Income Tax Department, and Nath has denied any wrongdoing in this case. Key elements of money laundering offenses are the act of laundering itself, that is the provision of financial services, and a requisite of a degree knowledge or a suspicion, either subjective or objective, relating to the source of the funds or conduct of the thing. So it's simply saying that yes, the source from where you are getting, if that is illegal, or you are going to use that money in an illegal form, either ways could be. Okay, so let's have a look at it, what it says further. So like someone also mentioned a terrorist financing. So anti-money laundering and key norms, which is money laundering and a terrorism financing. Okay, let me just put it this way. Money laundering is a process of disguising the illegitimate source of criminal proceeds, and the case of money laundering, the funds are always of illicit origin. Okay, what would be in the terrorism finance? Terrorism financing is the collection or of the provision of funds of illicit purpose, which is terrorism. They know that this is the purpose. And in case of terrorist financing, funds can stem from both legal and illicit sources. These are the two differences. So for specific act, and it could be for anything, right? That's why these two are differentiated. Okay, let's take it forward. Of course, so disclaimer, friends, we are not motivating anything. Okay, so this is something that we are all mature enough to understand the same thing. Anti-money laundering objectives, that is hit organized or criminals where it hurts the most, that is their wallets. Of course, hit those particular criminals and hurt them on their wallets, of course, and contribute to the prevention of the crime by reduction of the incentives. Protect the integrity of financial system by preventing use and abuse of the criminal and launderers. Okay, so three things. One is hit somewhere where it will have an impact on their inflows, that is their wallet or their savings. Contribute to the prevention of crime by reduction of incentives. So you can definitely reduce those particular things, that is incentives and cash incentives per se. Generally, the people prefer to have cash incentives. And protect the integrity of financial system and put it here. So anti-money laundering objectives. So these are not the anti-money laundering objectives. And so focus areas of the anti-money laundering would be, in practice, most serious crimes includes drug trafficking, terrorism, fraud, robbery, and prostitution, illegal gambling, arms trafficking, okay, and bribery and corruption are capable of predictating money laundering offenses in most jurisdictions, right? So this how the things takes place, and the objective of criminalization of money laundering is to take the profit out of crime. So while doing a crime, then they would be able to generate a profit. And the rationale of the creation of the offense is that it is wrong for individuals and organizations to assist criminals to benefit from the proceeds of their criminal activity, or to facilitate the commission of such crimes by providing financial services to them. So this how they try to rationale between it, and focus areas are these three particular points. How it takes place, some serious crimes we have already taken care of, and the rationale would be to creation of an offenses that is just wrong for the individuals and organizations to assist the criminal offenses. So stages of money laundering. Collection of dirty money could be, so it is anti-clockwise, okay? Then the placement of bank dirty money enters into the financial system, and then here the transfer funds between the various offshores and onshore banks, which is layering. So they layer it, and then integration, that is purchase of luxury assets, financial investments, commercial, industrial investments, and so on. Like it was being rightly said in two words, that black money to a white money specifically. But that money is coming from the criminal activities and they are converting it to the white money just by buying some assets or the other. So that's why most of the people have huge assets because they have converted the money into the assets itself. So stages of money, that is, first is the placement, involves placement of the bulk cash into the financial system without appearance of being connected to a criminal activity. And the simplest way to place such is to deposit cash into the financial institution, and it is one of the riskier way to laundering money as it can be easy to get caught, of course. And in an attempt to conceal their activities, that is, to put their activities together, money launderers will often resort to smurfing activities to get illicit funds into the financial institution. And smurfing is a process of using several individuals to deposit illicit cash proceeds into many accounts at one or several financial institutions in a single day. I hope it is clear that what is smurfing means doing n number of transactions in a single day by majority of the people, and hence it is something which is getting collected at one place, and hence it could be right. So let's take it forward and feel free to ask questions in between. Placement methods adopted. Cash can be exchanged for traveler's check, food stamps, or other monetary instruments, which can then also be deposited into financial institutions. And placement can also be done by purchasing high ticket goods or services. So many companies would like to understand that from where you are getting the money to purchase this costlier car or a luxury car. But some companies are not interested. They are saying that our product is getting sold, so what else we would do. But there are companies who try to go ahead, just by popularizing their product itself. For example, companies like Ferraris. If anytime you are interested in buying a Ferrari, they not only check your bank account or credit worthiness, they also would like to check, and they check it very commonly, that yes, to whom we are selling. Are you a celebrity or a politician per se, or anyone? So who is very famous, and basis the person is a celebrity or a person whom everyone knows, it means a person once go in the car and once market it or just put one small picture on a social media, then it will be a synergy marketing, okay, which is the marketing of the car, the brand itself, by the person who is already a celeb. So this way they also do it. They also try to leverage it. But what you are doing here is, understand it. So you are buying goods and services which are of high ticket, high amount. So we try, and even if we have good money, we won't be able to buy some luxuries because they have some standards to be followed. So goods and services can then be returned to the place of purchase in exchange for fund check, which can then be deposited at the financial institute with less likelihood of detection as being suspicious. Excuse me. So this way the placement methods adopts and so on. And let's have a look at it further. Smuggling cash out of country and depositing that cash into a foreign financial institution is also form of placement. So where you are placing the money. Illegally obtained funds can also be funneled into the legitimate businesses as cash receipts and deposits without detection. Then comes the layering. It is the process of moving and manipulating funds to confess their sources and complicating or partially eliminating the paper trail. Fourth point, wire transfers to account under the customers and business names to other financial institutes. What are wire transfers? Anyone? Any thoughts? Wire transfers. You must have heard about it, right? Business names at other financial institutes. Exchanging cashier's checks and other monetary instruments for other cashier's checks, adding additional cash, and performing interbank transfers between accounts owned or controlled by the common individuals. Correct. So this way the things takes place, and this how they try to adopt this particular method, which is related to layering. Then comes to integration. These transactions provide the criminal with plausible explanation about the funds gathered to purchase assets and shield the criminal from any type of recorded connection to the funds. Okay, and during the integration stage, the funds are returned in a usable format to the criminal source. Okay, so I'll share one example. You just tell me that whether this example qualifies uh, for the money laundering or not. Everyone, please listen to this carefully.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
So let's have a look at it. When I was in L&D, and I was the part of the L&D which was a profit center. Profit center means we used to not only provide a training internally but externally also to generate revenue, and which is at the end of the day, once the PL is created, or then we are able to find out the profits. So I was part of the team, and used to conduct the finance session internally and externally for the clients also across India. So once the payment came, then one of the client, which was my client, and I newly joined that time around six years back. So that time, one of the employee told me that, sir, how you have asked for the payment? Even I approached that particular person. So he was handling the other account, and I asked the person that, boss, my client is asking that the fee of the training, where we should be putting it to, and what is the account number where we should do. And he said, you know what he said? He said, or sir, you have your bank account? For sure, I get a salary. Let's share your bank details. Let it get transferred in your account. And as per your comfort, say next 10 days, 15 days, 20 days, or maybe after 30 days, you can transfer it back to the company's account. Okay, and I was listening. And I said, is this something which is a process being followed here? He said, no, Gaurav, sir, we don't do this. But I also asked my clients to pay me the money, and I'd get it transferred to the bank account, or with the bank account of the company. I said, okay, and since how long? Since day one. And he was in the organization since 5+ years. I said, do you have anything documented related to that? That if client doesn't have the company bank account number, we can give our own account number and get it transferred here, and then as per our ease or comfort, say next 1 month or 2 months or 3 months could be, we can transfer it back by saying that this is the money which we have received from the client, and this is the amount, and this is the transaction. He said that we are doing it. I said, what? Okay. And so what I responded, definitely, so I'll be sharing it with you, but would like to hear from all of you. Do you think that is this an example of money laundering? Yes or no, and why? So friends, this is a clear case of that. So for example, today I have just taken it. It is again my choice that whether all facts are not clear, but yes, I'll come back to you, Pradeep. So today I'm clear about it, that money will come to my account first, and then I will get it transferred, because this is the same account which I've already shared with the client. Client is genuinely making you payment to you. You are not. It is not a way to make the client feel more comfortable with you, just by sharing and asking for the payment. If advance is received, then get it transferred in your own account. No, not at all. So if something which is documented, who has given me this authority? So I just asked that particular person that, do you have something in writing like that? He smiled and he said, no, sir, we will just do it as per our own call. And then I went to my boss, and then I shared the same thing with him. Then he said that, what you replied to that person, Gaurav? I said, only my salary comes in my bank account, nothing else, and nothing else will come in near future also. Even if it takes 40, 50, 60 days, for the money which would come to the company's bank account, that's okay to be. It will be as per the policy, but only company bank account will be shared. Secondly, it will not be one training which we'll be doing with the client. It will be like we need to get the client registered as a vendor. So that's a whole process which should come up, right? So if you are getting it registered as a vendor and many more things which are happening, then you should follow the same process. Even if there is a loophole in a process, address that loophole. Bring more clarity, more transparency, more detailing to the process so that everyone is interconnected rather than people are just trying to use that loop. And after 1 month, the whole process got refined, and none of the payment is get missed. The moment the training is done, the invoice immediately gets generated and being sent to the client immediately. In up to 45 days, they are supposed to make the payment. That's it, right? So once we see some things like that, first of all, as a genuine employee, it's our also duty to take some necessary corrective actions also, not on the person but on the process itself. You must have also, if being asked maybe later on, you must have been asked that let us know what is the loophole, why people are being able to do like that, blah blah blah. You must have been given an opportunity to suggest something that how we can improvise it. Seize the laptop, everything closed, taken back the car, means everything which they have. It was just a 1 hour, means 15-minute conversation with the, not with the client, but with the employee, with two vice presidents and all of the stuff. One from the legal team also was there, one from the HR, and one from the compliance. So everyone, and they said, and he accepted it, and they said, okay, the door is there, please. They seized the laptop, everything got seized. He entered in the office at 10 o'clock and he was out by 10:30. Thank you so much. Go back home. So like that. So anyways, let's take it forward. Sorry. I'm sure there must be many examples which we all can share among each other. The process of integration can be achieved through various schemes such as inflating business receipts, overvaluing and undervaluing the invoices. That is, integrate process of integration can be achieved through this integration process, and creating false invoices in shipping documents, establishing a phony charitable organization along with the establishing the foreign trust account. So these are the ways that people actually do, and these few examples, uh, possibilities are limitless. I mean, sure. So these are only three. There could be 300 examples like that. Stages of money laundering, and we have seen that yes, placement, that is bank, which is the dirty money, integrates into the financial system, and layering, that is transfer on the bank account of the company percentage wise. And then we have wire transfer, when we talked about offshore banks, loans to the company, wire payment by of false invoice to company X. Are you with me? So it is a payment of that particular thing. Then follows the integration, which is purchase of luxury assets, financial investments, commercial and industrial instruments, investments. Lastly, collection of the dirty money. A typical money laundering scheme would work like that. So people have their ways of doing it. Okay. So we are not motivating this, but we are telling you that how it takes place so that we should remain prevented from the same. And if someone is actually doing it, we can report, or we must report, not should, we must report immediately, so that a necessary team would take or a right team would take a necessary action along with it. Okay. Anti-money laundering schemes are there. Now, the next part is how to reduce it. So anti-money laundering schemes, that is, sanctions may be comprehensive, prohibiting commercial activity with regard to an entire country. And so financial sanctions must be, and sanctions includes travel bans, asset freeze, arms uh, em- embargoes, as well as capital restraints, foreign aid reductions, and the trade restrictions. These are some sanctions basis how much you are sanctioned for and for what particular purpose. Let's have a look at it. So some US sanctions are there. US sanction resolutions must pass the 15-member Security Council by the majority vote, and without a vote, without a veto from any of the five permanent members: the United States, China, France, Russia, and the UK. The most common type of the UN sanctions, which are binding on all member states, are asset freeze, travel bans, and arm embargoes, right? And in case of UN, sorry, EU, European Union, sanctions policies must receive an anonymous consent from the member state in Council of European Union, the body that represents EU leaders. So some sanctions comes up, and how those particular sanctions comes up. So for example, the US presidents typically launch the process by issuing an executive order, which is EO, that declares a national emergency in response to an unusual and extraordinary foreign threats. The 26 existing US sanctions programs are administered by OFAC, while other departments, State Commerce, Homeland Security, and Justice, and may also play an integral role. Lastly, that is KYC, of course, must be there. Primary objective is to prevent banks from being used by criminal events for money laundering activities, like what Rashmi also shared an example. KYC enables banks to know, understand their customers and their financial dealings better, and Basel Committee states the need to implement the effective know your customer standard as an essential part of the risk management practice. And faulty KYC risk management programs may lead to the significant risk, especially legal and reputational ones. So Basel Committee, we studied in the previous session also that there is Basel 1 and 2 and 3, and there is an improvised version of the Basel 3, which is already existing, which came after 2008 crisis. And KYC is considered a core feature of bank risk management. Okay, so I'm not reading all, but yes, and they reduce the likelihood. I'm just reading from here. They reduce the likelihood of banks becoming vehicle for money laundering, terrorist financing, and other unlawful activities. Lastly, the initiatives to reinforce actions against terrorism have underlined the importance of banks' ability to monitor their customers wherever they conduct a business. So, of course, in these terrorist activities, the money is always a black money, which is being given rather than any sort of a transaction which takes place. I'm just guessing it, and it must be like that. Key components: customer identification, acceptance, verification, transaction monitoring, and risk management. These are very basic things. And KYC component, that is customer identification and key. So I'm not reading all. Okay, I'm sure we are already through with the KYC somewhere or the other. In such, so notify the customer. That is provide the adequate notice to the new customer on information required. Gather information, which is minimum requirement of the CIP information. That is customer information. Something I'm sure Rashmi must be knowing the full form. So gather that particular information from the for individual and non-individual customers also. Then comes verify information, conduct sanction screenings as per the information, and maintain the records. Sorry, I'm just reading the headings, but yes, important for us. So banks should have customer acceptance policies and procedures. So factors considering in CAP are customers' background, country of origin, that is public or high-profile position, linked accounts, business activities, and other risk indicators could be. And customer acceptance policies should be commensurate to the level of risk of customers, high risk customers such as high net worth individuals. So care should be taken to ensure that the customer's acceptance policy does not become restrictive, that it results in a denial of access for people who are financially or socially disadvantaged. Then decisions to enter into business. A bank should also establish a risk-based systematic process, relevant information, and bank should obtain the appropriate identification information and maintain such information in readily retrievable format. How you can retrieve this information, how fast you can retrieve this information. Okay. So these are KYC components, the customer acceptance and all. Key component, customer due diligence, that is bank may need additional information depending on the specific facts present. All of this information goes into creation of customer profile model against which the activity is measured and the determine. So, sorry. And suspicious transactions then can be easily identified using anti-money laundering software models and products. To determine the relevant risk, information is needed on the customers, that is nature of business, the purpose of the account, and so on. Someone has written something, okay. Scrutinization of the financial detail could be, okay, and so on. And expected pattern of the activity, which is volume, nature, transaction, amounts, all things to be taken into consideration, okay. Let's take it forward. Yeah. So customer, then politically exposed person, PEP. Politically exposed person is an individual who is or has been entrusted with prominent public function. The potential risk associated with PEPs justify the application of additional anti-money laundering or CFT preventive measures with respect to the business relationship with the politically exposed. So, as we know that individual who is or has been entrusted with prominent public functions, right? To address the risk that FATF recommendations 12 and 22 requires countries to ensure that financial institutions and designated non-financial businesses and professionals, which is DNFBs, implement measures to prevent the misuse of the financial systems and non-financial businesses, professions by PPs, and to detect such potential abuses if and when they are. Okay, so it is customer identification process. Okay, it's easy. So I was able to figure out a customer identification and maybe the process also. So this is more theoretical, friends, and then it is political exposed person does not always mean an individual who directly holds public office. It also includes their immediate family members, close business associates, as well as any senior executive of the state-owned enterprise. Correct? So these are the things takes place, and higher risk customers and the transaction should be reviewed more closely to account opening or more frequently throughout the terms of the relationships. So these are just a preventive measures. Okay, so we can take it forward, and this is the process. Politically exposed person. It's simple here. When AML or CFT risk of the customer is low, it is simplified. When it is it could be standard, like when AML risk of the customer is medium and risk of the customer is high, that is enhanced. So this is how we further classify it, the PEP basis low, medium, and the high.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
First is income statement. The income statement is a financial statement that shows the profitability of the company. It begins with the revenue line and works its way down to net income after various expenses are deducted. The income statement is for a set period of time, such as a quarter or a year. Second is balance sheet. The balance sheet does not cover the entire period, but rather provides a snapshot of the company at a specific point in time, such as the end of the quarter or the year. The total number of assets and liabilities must always equal the total amount of equity and liabilities. Third is cash flow statement. A cash flow statement is a magnified version of the balance sheet's cash account that accounts for the entire period, reconciling the cash balance at the beginning and the end of the period. Next question is, what is the difference between enterprise value and equity value? So enterprise value is the company's overall current value, whereas equity value is the value of the company's shares and loans, which can provide an indication of the company's current and future value. Third question, what is beta and how to calculate beta for a company? The beta of investment security is a measure of its volatility of returns in comparison to the market as a whole. It serves as a risk indicator and is crucial to the capital asset pricing model. A higher beta means a greater risk and higher expected profits for the company. Because 1 is the benchmark for beta, everything above 1 is more variable and carries more inherent risk. Next question, what is the difference between a merger and an acquisition? A merger is a combination of two or more commercial companies to form one joint entity with a new management structure, ownership, and name that capitalizes on its competitive advantage and synergies. In contrast, an acquisition occurs when a financially powerful entity acquires all or a portion of the total shares of a less financially powerful commercial firm. Next, what is DCF? The term discounted cash flow refers to a valuation method that determines the value of an investment based on its expected future cash flows. The purpose of a DCF analysis is to determine the current value of an investment based on projected future earnings. It can assist those deciding whether to acquire a company or buy securities in making the decisions. Discounted cash flow analysis can assist business owners and managers in making operational and capital budget decisions. Next question, how do you value a company? A company can be valued in three ways: comparable company analysis, discounted cash flow analysis, and precedent transaction analysis. First, comparable company analysis. It entails locating companies that are similar to the one under consideration and comparing their EBITDA, stock price, and price to earnings among other variables. Next is DCF. The discounted cash flow analysis uses the amount of money that the company is expected to make in future, discounted to present values. Finally, precedent transaction analysis. Precedent transaction analysis is similar to comparable company analysis, in which you look at how much similar companies have sold in order to determine the value of the company you're valuing. Next question, how do you calculate terminal value? Terminal value is the estimated value of a company after a certain period of time and is a key component of DCF analysis. There are two methods for calculating terminal value. First, the growth in perpetuity method and the exit multiple method. The growth in perpetuity approach assumes that cash flows will grow at a constant rate indefinitely. The exit multiple approach does not assume perpetual growth, but rather examines the net value of a company's assets at a given point in time. It is used to describe a company that will be acquired or liquidated in the future. Next question, when should a company issue debt instead of equity? Because the cost of debt is typically lower than the cost of equity, there are many situations in which issuing debt makes more sense than issuing equity. Issuing debt rather than equity makes sense if the company can benefit from the tax breaks by issuing debt, the company has consistent cash flows and can pay interest. As a result, the WACC is lower, and with more financial leverage, the company can get a better return on investment. Next question, what is the PEG ratio? The PEG ratio is an abbreviation for the price earnings growth ratio, which includes the PE ratio as well as the EPS growth rate of a company. Rapidly growing stocks have higher PEG ratios, whereas conservatively priced stocks have the same PE and PEG ratios. If a company has the same PE and PEG ratio, one could argue that its stocks are overpriced when compared to companies with the same EPS but a lower PE rate. Next question, what is net working capital? Net working capital is the amount of money a company has after paying off all current short-term debts. So it is given by current assets minus current liabilities. So current assets include balance sheet items such as accounts receivable, inventory and prepaid expenses, whereas current liabilities are short-term debts such as accrued expenses, deferred revenue and accounts payable. Now we're going to look at investment banking intermediate interview questions. Starting with the first one, what does negative working capital mean? When a company's existing liabilities exceed its current assets, it has negative working capital. This means that liabilities paid within a year outnumber monetizable working capital during the same time. Buyers frequently regard a target company's negative working capital as negative because it represents the additional capital required to operate the company after the transaction is completed. A buyer prefers a working capital ratio of 1 to 1.5, which means at least $1 in current assets for every $1 in current liabilities. This gives the buyer confidence that the company will be able to meet the seller's and payroll obligations in the short term. Second question, what is the difference between cash-based accounting and accrual accounting? So cash-based accounting records revenue and expenditures only when cash is received or spent. Accrual accounting, on the other hand, records revenue when it is reasonably certain that it will be collected and expenses when they are incurred rather than when cash is actually spent. Because credit cards and lines of credit are so widely used for payment these days, most large organizations use accrual accounting. However, very small businesses may choose to use cash-based accounting to simplify their financial statements. Next question. Two companies are identical except one has debt and the other does not, which will have a greater WACC. The company with no debt will have a higher WACC because debt is less expensive than equity. Debt interest is always tax deductible. Debt is ranked above equity in a company's capital structure, which means that debt holders would be paid first in the event of bankruptcy or liquidation. Contrary to popular belief, debt interest rates are typically lower than equity cost of equity figures, which are typically higher than 10%. As a result, the cost of debt component of WACC will account for a smaller portion of the total than the cost of equity component. Fourth question. Give an example in which you encountered a difficult situation while working in a group. So you can frame your answer in a way by saying, during my senior year internship in financial management, I worked in a variety of small groups. Each student had a very busy schedule and I took the initiative to help everyone reprioritize their schedules and find areas to compromise. This aided in the group in balancing workload and work quality. In the same situation, there was a member of the group who was not carrying out his responsibilities, and I contributed to the solution by assisting him in discovering his strengths and allowing him to focus on them while the others filled in the gaps. Next question. What is terminal value and how do you calculate it? So terminal value is the value of a company, project or asset after a period for which future cash flows can be predicted. So terminal value assumes that a company will continue to grow at a certain rate indefinitely after the projected period. The terminal value is calculated using the following formula, where FCF stands for free cash flow for the last forecast period, G stands for terminal growth rate, and D stands for discount rate. Sixth question. How is the balance sheet adjusted in an LBO model? The additional debt is first added to the liabilities and equity sides, and then the shareholders' equity is wiped out and replaced with the maximum equity contribution from the private equity firm. After cash on the assets is adjusted for and any cash is used to fund the transaction, goodwill and other intangibles are used as a plug to make the balance sheet balance. Depending on the transaction, there may be additional implications such as adding capitalized financing costs to the asset side. Moving on to the seventh question. What is the difference between high-yield debt and bank debt? Some of the major differences are, high-yield debt has a higher interest rate than bank debt. Bank debt interest rates are not fixed like high-yield debt rates. They fluctuate based on the Fed interest rate and LIBOR. Maintenance covenants apply to bank debt, whereas incurrence covenants apply to high-yield debt. The main difference between the two is that incurrence covenants prohibit you from taking certain actions, whereas maintenance covenants require you to maintain a certain level of financial performance. For example, the debt or EBITDA ratio must always be less than 5 times. And finally, in case of bank debt, the principal must frequently be amortized over time. However, in the case of high-yield debt, the entire principal is payable at maturity. Eighth question. Determine if an acquisition is accretive or dilutive. So this is an important question whenever a company considers acquisition. Fundamentally, any transaction that increases the buyer's earnings per share is accretive. Any transaction that reduces the buyer's earnings per share is dilutive. So here's a quick rundown of how to respond to this question. Inquire your interviewer if the deal is all stock, and if the transaction is all stock, it is simple to determine whether it is accretive or dilutive. It is accretive if the buyer has a higher PE ratio. It is dilutive if the seller has a higher PE ratio. Ninth question. What is an LBO and what are its value drivers? A leveraged buyout is a debt-financed acquisition, typically a very high percentage of debt. The following are the primary drivers of an LBO's success or failure. First, the cost of acquisition, then the amount of debt used and the debt cost, and finally, the anticipated exit price. It is also worth noting that the actions taken by the acquiring firm to increase the exit price of the target business have a significant impact on the success of an LBO. Successful LBOs, for example, typically involve expanding or restructuring the business to increase its value. 10th question. What is the difference between goodwill and other intangible assets? When a company is purchased, a goodwill premium is paid over the fair value of assets. As a result, it is linked to a company or business and cannot be purchased or sold on its own. Other intangible assets such as licenses and patents can be sold and purchased separately. Moving on to investment banking advanced interview questions. Starting with the first question, what is the distinction between capital and operating leases? Operating leases are used for short-term leasing of property and equipment and do not involve any ownership. Operating lease expenses are shown on the income statement. Capital leases are used for long-term items to provide the leasee with ownership rights. They depreciate, require interest payments, and are classified as debt. Second question, explain an IPO valuation for a firm that is about to go public. We only consider comparable public company IPOs as opposed to traditional valuations. We choose comparable public companies, apply the most relevant multiple, and base our estimate of the company's enterprise value on that multiple. We can calculate the equity value by working backwards from the enterprise value. We also consider IPO profits because they are new funds. The price per share is then calculated by dividing the total number of existing and newly issued shares by 100. This is what it means when people say an IPO is valued at. Third question, tell me about major items in shareholders' equity. The first is common stock. The most common type of stock in which most people invest is called common stock, which represents a portion of a company's ownership. Second is retained earnings, the amount of net income that the company has saved up over time. Third is treasury stock. The monetary value of the corporation's shares are purchased. Finally, additional paid-in capital. This accounts for the number of new shares issued as a result of employees exercising their stock options as well as the amount of stock-based compensation granted. It also considers how much additional money a company receives from an IPO or other equity issuance. Next question, in a DCF, why would we use the mid-year convention? This is because a company's maximum cash flow does not always occur at the end of a fiscal year, but can occur evenly throughout the year. We would use the discount period numbers of 1 for the first year, 2 for the second year, 3 for the third, and so on if there was no mid-year norm. Instead, with the mid-year convention, we use 0.5 for the first year, 1.5 for the second, 2.5 for the third, and so on. Next question, what are your strengths? If you are asked this question, this is one of your best chances to demonstrate why you would make an excellent banker. Your analytical, quantitative skills, communication skills, the ability to learn quickly, detailed orientedness, and ability to work extremely hard are likely to be highlighted. You should be prepared to back up what you say about your strengths with 1 or 2 concrete examples from previous jobs or school. Next question, explain the use of revolver in an LBO model. A revolving credit line is used when you need more money to make your mandatory debt repayments than you have available. The revolver, like credit cards, begins undrawn, which means you don't borrow money and don't accumulate debt unless you need it. Before calculating mandatory and optional debt repayments, add any required revolver borrowing to your running total of cash flow available for debt repayment. You assume that any revolver borrowing from previous years is paid off first with surplus cash flow before any term loans in the actual loan repayments. 7th question, why are deferred tax liabilities and deferred tax assets created in the merger and acquisition transactions? These are generated as a result of the writing up and writing down of assets in a transaction, which include both tangible and intangible assets. An asset write-down generates a deferred tax asset, while an asset write-up generates a deferred tax liability. Because of the frequent differences between an asset's fair market value and its book value, which appears on the balance sheet, the asset must be written down and written up. A write-up of an asset results in a deferred tax obligation because the new item will have a higher depreciation expense, which means you will pay less in taxes initially, but will have to pay them back later, resulting in the liability. For an asset, write down annual deferred tax asset, the inverse is true. 8th question, how do you approach problem solving in a complex financial scenario? You could answer this question by saying, when faced with a complex financial scenario, I follow a structured approach to problem solving. First, I gather all the relevant information and data. Then I analyze the information to identify the root cause of the problem. Finally, I evaluate various options and make a recommendation based on my analysis. I always ensure that my solution is feasible, practical, and aligns with the client's objectives. Next question, can you walk us through a recent transaction you worked on? So you can answer this question by saying something like, yes, I worked on a deal for a company and my responsibilities included conducting due diligence, developing financial models, and negotiating the terms of the transaction with the counterparties. The transaction was completed successfully and it was a valuable learning experience for me. And for the final question, what are some of the examples of non-recurring charges that are reflected in the company's EBIT or EBITDA when reviewing its final statements? First, goodwill detriment, then charges for restructuring and asset depreciation, legal expenses, expenses related to bad debt, accounting procedures have changed, expenses associated with a disaster.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.